Okay, so welcome everyone. This is Bhavik Chokshi here and welcome to this session for your Ind AS financial reporting discussion. So we would be trying to cover almost everything in terms of the concepts for your Ind AS. So all your standards as well as important topics like financial instruments, business combination, consolidation, etc. So I'll be taking the help of this notes, and largely these notes have been from the Institute ICAI material. So if you look at the charts which are there in the ICAI material, you can even refer that so that this is available and easily accessible to everyone. Nevertheless, we are not going to focus on reading each and everything, but we are going to get a very quick overview of everything in our syllabus. We are going to touch upon almost every area of this really big subject. Not really doing any kind of problem solving, but concept coverage is what we want to focus on. So we have all of these standards and let's get started. Okay, so if you have any queries, you can put this in the comment box and I'll try to revert back. Okay, so let's get started. Any problems, any issues? Can we start? I'm unable to see the chats, honestly. Can you please? अरे कुछ रिस्पॉन्ड तो करो यार. चलो ठीक है. So let's get started. We'll go with the standards in a chronological sequence. So we'll start with Ind AS 1. So what is there in Ind AS 1? Is it an important standard? No. In terms of exam coverage, this is not really important. It covers presentation of the important accounting policies and other disclosures in the financial statements. So it covers a lot of things on what are the important principles of accounting, like consistency, accrual, going concern, etc., which you have been doing since quite a long time. Not really important from an exam standpoint. But it adds one more layer of disclosure in the financial statements. That is, if entities are preparing financial statements as per Ind AS, they have to give an explicit, that is, it has to be specifically written, and an unreserved statement of compliance with Ind AS. Apart from that, it gives you additional guidance on what do you mean by current and non-current. So current over here is defined as those items which usually settle within the operating cycle or within 12 months, whichever is shorter. So over here, non-current is defined as every item which is other than current is defined as non-current. Apart from that, there are some general principles which are given about the disclosure and presentation, like we have to give the significant accounting policies as a single part in the notes to accounts. The most significant part of this standard, one can say, is the accounting of a special case which involves, let us say, there is a loan which is taken and then there is a breach. If there is a breach of a material condition, so for example, a loan is taken, it's a loan with a tenure of 10 years and there is a breach of a material condition, like we had to maintain, for example, a debt to equity ratio of 2:1, and then there is a breach. We are unable to maintain the debt to equity ratio at 2:1, in which case the loan becomes repayable on demand. It's a 10-year loan, so by default it is a non-current liability, but the moment it becomes, if there's a breach, as per law, it becomes repayable on demand, and if it becomes repayable on demand, this is to be shown as a current liability. Okay. However, what will happen is, if we have really good relationships with the bankers, we can go to the banker and we can request the banker to waive off the breach, not to waive off the loan, to waive off the breach. One last chance. Okay, we can say that we want to waive off the breach, in which case if the banker agrees to waive off the breach, then the banker cannot demand immediate repayment. Banker can demand repayment but not immediate, in which case the loan can be reclassified back into the non-current liabilities. It was a 10-year loan which became repayable on demand and hence it became a current liability. However, since the banker waived off the breach, this will again be reclassified to a non-current liability. Sir, when can the banker waive off the breach? Well, if the breach is waived off before the balance sheet date, excellent. However, what if the breach is waived off after the balance sheet date? So the standard over here mentions, read with Ind AS 10, that if the breach is waived off even after the balance sheet date, as long as the breach is waived off during the post balance sheet period, it is treated as an adjusting event. And because it is treated as an adjusting event, we will show this as a non-current liability on 31st March, even if the waiver is obtained in the post balance sheet period, that is a period before which the accounts have been signed. Similar logic also applies for items of grace period. Just a second. So similar logic can also apply for grace period. So if a grace period is given during before the balance sheet date, then we have to look at the tenure of the grace period to figure out whether it is current or non-current. So if, for example, in the month of March you get a grace period for 15 months, in which case a banker cannot demand immediate repayment for 15 months, in which case the classification will be taken as non-current. In all other cases it will be taken as current, because when you get a grace period, the banker does not waive off anything, he just gives you more time. So you have to look at the term of the grace period. If the grace period is less than 12 months, it is considered to be a current liability. If the grace period is beyond 12 months, it is considered to be a non-current liability. So this is one really important case which you should emphasize, and this is with Ind AS 10. It's a fairly important case which can come in your exam. So this is where you should put your pressure point. There's also one more case in case of loan refinancing. What do you mean by loan refinancing? For example, it's a 6-month loan. There's a loan which is repayable within 6 months. What will be the classification? You guys tell me. What will be the classification if a loan is repayable within 6 months? Well, it will be a current liability. If it is a current liability, the classification in the balance sheet will go as such. However, if you have agreed with refinancing means you have agreed to roll over this loan into a new loan. So over here, this is a 6-month loan. You tell the banker, okay, I'm not going to have money to pay after 6 months. You continue this loan for another 5 years at the same rate of interest. Banker agrees. In which case, do you have to repay anything after 6 months? The answer is no. Since you don't have to repay anything after 6 months, this loan can now be categorized as a non-current liability, because after 6 months, this loan will be rolled over into a new loan, and hence it will be a non-current liability. However, if this refinancing is, let us say, arranged with a different bank, in such a case, what would happen is you will have to repay. For example, you have taken the existing loan from SBI, you will have to repay SBI after 6 months, and the money for that will come from, let us say, HDFC Bank. So actually you have to repay after 6 months. And as a result, in such a case, if refinancing is agreed with some other bank, then the classification will continue to be current, not non-current. So these are various cases. Institute has asked a lot of problems in Ind AS 1. If you see in the illustrations as well as test your knowledge, you should refer them, because if something comes from Ind AS 1, it is very likely that it will be from this section: the loan and breach of a material condition, and in case of refinancing. So these are the two things which you should focus on. Okay, next we go to Ind AS 2. Now this is an average category important. Ind AS 1 is not as important. Ind AS 2 is average category in terms of importance. We are going just in the chronological sequence. Ind AS 2 has, what does Ind AS 2 cover? Well, it covers inventories. Inventories may be raw materials, maybe work in progress, maybe finished goods, maybe stores and spares. All of these items go under inventory. Usually these are items which are held for the purpose of sale in the ordinary course of business, or for the purpose of consumption in the ordinary course of business. That is what you call as inventory. So when we are looking at inventories, within inventories, what is the core principle? Well, we are going to study about 3 specific things. First is the cost, second is the cost flow, and third is the valuation. So these are the 3 important parts that you should be aware of when you calculate anything regarding inventory. What all should form a part of the cost of the inventory? Well, the cost of the inventory will comprise of the purchase price, the non-refundable and non-creditable taxes, like GST. If you get credit, will not be a part of cost. If you don't get credit, like basic customs duty, that will form a part of your cost. Then you will add the directly attributable expenses which are incurred to get the inventory in the location and condition as desired by the management, and any other directly attributable expenses will be added to the cost of the inventory that you are purchasing. Trade discounts, if any, will be subtracted. If you look at, let us say, inventory which is manufactured, then your prime cost like the material, labor, direct expenses will be added. Over and above that, overheads, which can be fixed overheads as well as variable overheads, as long as they are production overheads, will be added to the cost of the inventory. Remember, selling and distribution overheads will not be added to the cost of the inventory. It is only the production overheads which can be added into the cost of the inventory. Okay, next, what should you do with losses? Well, losses can be normal loss, it can be abnormal loss. If it is a normal loss, will not be added to the cost. Normal loss will implicitly be a part of the cost, whereas abnormal loss should be expensed to the profit and loss account. Any other expenses like storage expenses, administrative expenses, selling and distribution expenses, abnormal losses should never form a part of the cost of the inventory. In case there are joint products and byproducts, you will allocate the joint cost in the ratio. You will allocate the joint cost in the ratio of their sales value at split off point. If there's any byproduct as well, then you will subtract the NRV of the byproduct and then find the net joint cost, and that net joint cost will be taken for the purpose of your inventory valuation. Okay, so that largely takes care of the cost section. What is cost flow assumption? The assumption on how cost will flow. So in case inventory units are not interchangeable, so for example valuable paintings, ornaments, etc., these inventory units are not interchangeable. If these inventory units are not interchangeable, then you will use the specific identification method. For specific items you will find the cost, and based on that you will find the total cost of the inventory. However, for items which are interchangeable, so for example if you are a seller of tires, all the tires that you have of a specific grade are interchangeable with each other, and as a result the standard says you can either follow FIFO or you can follow weighted average. Remember, LIFO is not permitted as per Ind AS, cannot be followed. In certain exceptional cases like manufacturers having a long production history, standard cost method can also apply, or for retailers or departmental stores, then in such a case the retail sales price method, that is the selling price minus gross margin method, can also apply. This is regarding the cost flow. And the last part is valuation. How do you value inventory? Well, the inventory is valued at the lower of cost or net realizable value. This is typically the finished goods inventory and the work in progress, valued at lower of cost or NRV, where net realizable value is calculated as the estimated selling price minus the estimated cost to complete minus the estimated selling expenses. On the other hand, raw material inventory is measured at cost. Raw material inventory is measured at cost only, because you don't hold raw materials for the purpose of sale in the ordinary course of business. However, in certain exceptional cases, that is, if the cost of the finished goods is greater than the NRV of the finished goods, typically these are loss-making finished goods. In certain cases like these, the raw material cost will be valued at the lower of the cost or the replacement cost. So typically valuation will be at the lower of cost or NRV. However, in certain exceptional cases like in raw materials, the valuation will be at cost only. Just that in case it is at in case these are raw materials which are used in a loss-making finished good, then you will value the raw material at the lower of cost or replacement cost, because we don't know if the finished goods is loss-making. You might have to sell the raw material and not really use it. Okay, so this largely takes care of the basic workings for an inventory. Then you have Ind AS 7, which is on cash flow statement. Now we are not going to prepare the entire cash flow statement over here, but we are obviously going to discuss the basics of cash flow statement for a quick understanding. So we will kind of glance through every standard, so you get kind of an overview of each of them. So when we look at Ind AS 7 for the cash flow statement, what is cash, and more importantly, what is a cash equivalent? Cash equivalent have three important features. Cash, you are aware, would be like your money, which is legal and tender. However, when we look at cash equivalents have three important features. First, they are highly liquid, so you can exit them when you want to, having a very short term maturity, which is defined as less than 3 months from the date of acquisition, and something where the value is determinable. The amount does not fluctuate a lot. The value is determinable. So investment in equity shares, though considered to be liquid, will not have a determinable value. The value will change dramatically, and hence it cannot be taken as a cash equivalent. However, a 2 or 3 month treasury bill will have a fairly determinable value, and as a result can be taken as a cash equivalent over here. Now, what is a cash flow statement? Cash flow statement, simply stated, is a vertical presentation of the cash account, where you divide the expenses as well as incomes that have gone in your cash account into three main headings. That is a cash flow from operations, where expenses as well as incomes which are linked to your operations, like sales, like administrative or selling expenses, will all go, let us under that direct method, under the cash flow from operations. In the cash flow from investing, you will take all the expenses or all the incomes which are for investing activities. So something which is like purchase of assets, sale of assets will go over here, and attached to that corresponding investment income from investments or sale proceeds from the sale of fixed assets will also come over here. Cash flow from financing will have cash flows which are linked to your financing, in the sense loans taken, loans given, shares issued, shares bought back, dividends paid, etc. will all come under the cash flow from financing section. After that, you show the net changes in cash and cash equivalent. To that, you add the opening cash and cash equivalent, which will give you the closing cash and cash equivalents as appearing in your balance sheet. When we prepare the cash flow from operations, you can prepare it using one of the two methods. There's something called a direct method and then the indirect method. Within the direct method, you will start with the sales, or rather cash collection from debtors, subtract the cash payment to creditors and the cash paid for other expenses, cash paid for taxes, etc. to find the cash flow from operations. On the other hand, when you take the indirect method, which is a more important method from an exam standpoint, you will start with the net profit. And this is the net profit which is as per the income statement. To this you will adjust, add or less as a case, maybe non-cash items. So these non-cash items may be like depreciation or amortization, because they don't really have a cash outflow attached. Add or less non-operating items like interest, etc. have been subtracted while calculating net profit, but interest is a financing cash flow and hence it has to be added back. And lastly, you will make adjustments for working capital or operating assets and liabilities, that is debtors, creditors, etc. The general principle over here is the net profit is calculated based on accrual. So when you have made sales of goods, whether the sales have been collected or not, sales has gone in the net profit working. However, if debtors are increasing, that is sales have not been collected, then cash collection is lower. And hence the rule that you have to remember from an exam standpoint is, if the current assets are increasing, let's say that is debtors are increasing, less cash must have been collected and hence you subtract. Whereas if current assets or current assets are reducing, then more cash must have been collected, you add. So there's an inverse relationship between the movement in the current assets with that of the cash flow. When you look at current liabilities, on the other hand, there's a direct relationship. So when the current liabilities, for example, are increasing, like creditors are increasing, you are paying less cash as compared to what you have booked as an expense, and hence the cash in your hand is higher. Basically, for current liabilities, if the current liabilities increase, you will add. If the current liabilities reduce, you will subtract. Are we clear with this? Okay, so this will give you the cash flow from operations. Obviously, you will subtract the tax paid and you will get the cash flow from operations. So this is the difference between the direct and the indirect method, which affects only the cash flow from operations. Cash flow from financing, cash flow from investing largely remain the same. A few special cases that can be asked by the institute pertain to, let us say, accounting for an acquisition in a cash flow statement. So if you have acquired another company, you have paid PC for that. Where will the PC go? Well, the PC will go as a cash flow from investing, because acquisition of a business is like an investing activity. So that PC that you have paid in cash will go in the cash flow from investing. And apart from that, all the assets and all the liabilities that you have taken over will be adjusted. So for example, if there's a fixed assets of 100 and you have acquired another 40 of fixed assets under the acquisition, that means effectively 140 of fixed assets are there, and if your closing fixed assets, for example, are 160, then 20 rupees over here can be taken as new fixed assets purchased over and above the fixed assets that have been acquired as a part of acquisition. A few adjustments over here in the cash flow statement can be also linked to consolidation and business combination. So in case you acquire a business in the standalone financial statements, that is taken as an acquisition of investment, whereas in a consolidated financial statements, it is treated as acquisition of the entire business. So that, I guess, briefly takes care of the working regarding cash flow. Usually you subtract tax while you calculate the cash flow from operations. However, if tax is taken as a separate item like capital gains or dividend distribution tax, then it will go in the relevant cash flow where it pertains to. Okay, next, so this is a summary. Next is there is Ind AS 8. Ind AS 8 is on accounting policies and accounting estimates. So over here there are three main things. First is accounting policy, then accounting estimate, and then there is errors. The general rule over here is, if there's a change in accounting policy, you will adjust it retrospectively. That is, you will restate the past financials. If there's a change in accounting estimate, you will change it prospectively, because judgments are bound to change. And lastly, if there are errors, then these errors have to be retrospectively restated as if these errors had not happened. Now, what is an accounting policy? Accounting policy is a method of applying an accounting principle. So like inventory is an accounting principle, the policy of measuring this inventory either at FIFO or weighted average is the accounting policy. Now, can you change accounting policy? Well, yes, provided the standard permits or a law requires, or if you think it results in better presentation, then you can change accounting policy. If you change an accounting policy, then the accounting treatment will be, you will have to retrospectively restate. You will have to retrospectively restate the financials as if the new policy had always applied. Like if you were following FIFO and now you move to weighted average, then the current year's financials will obviously be as per weighted average, but the last year's column that you prepare in the current year's annual report, the last year's column will also be restated as per the new policy. In fact, the standard believes that all the other periods will also be restated. But in your financial statements, you don't show all the periods. You show the current period, you show the previous period, and then you show the opening balances. So the standard says, well, if you are not showing the earlier periods, then let us make the changes in the opening balances. So you'll, for example, change the opening retained earnings, and then the corresponding effect will be given in the opening inventory as well. A retrospective restatement means you will actually change the numbers. But sir, we have already filed the annual report. Let that be. We will explain in the notes that why we are changing the financial statements, because there's a change in accounting policy. You have to be able to differentiate a change in accounting policy from a different policy applied to a different transaction. So for example, if I'm Reliance Industries Limited, I have petroleum as my main product, and earlier I used to measure petroleum using FIFO. Now I measure it using weighted average. That is the same transaction, that is petroleum, being measured using a different method. However, if Reliance was earlier into petroleum, it used to measure using weighted average. Now it closes the petroleum business and it starts, let us say, with retail business. The retail products it wants to measure using FIFO. Is that a change in accounting policy? Answer is no. It's basically a new policy, that is FIFO, applied to a new set of transactions, that is consumer products. Change in accounting policy which requires retrospective restatement is the same policy which is applied to a different policy which is applied to same set of transactions. So the same, let us say, valuation of the same petroleum, for example, is measured using a different method, in which case a retrospective application is mandatory unless it is considered to be impracticable. And when is it considered to be impracticable? It is considered to be impracticable when you are unable to restate it even after applying the best of the efforts, like loss of data can be impracticability. A change in accounting estimate is considered to be something like change in the useful life. This will apply prospectively. So you will not require any retrospective restatement. Changes in accounting estimates are changes in the method of depreciation. Changes in the useful life of the assets are changes in accounting estimates. The changes in accounting policies can be changed from FIFO to weighted average for inventory, or change from the cost model to revaluation model, let us say for PP. This can be accounting policies. And lastly, errors. What are errors? Errors are mistakes, omissions, or misstatements. These are clerical mistakes. These are based on facts or not based on your judgments. So these are errors which are based on facts. And these errors, maybe double counting of sales, maybe omission of sales, these are errors. So in the year when the error is detected, the standard says you have to retrospectively restate the past year's financials had the error never happened. So over here, a retrospective restatement is required. If the error pertained to the last year, you will restate the financials of the last year. If it pertained to a period prior to the earliest period presented, then you will restate the opening balances. But a retrospective restatement is a must, and you will have to give a disclosure for the error and its accounting as well. Okay, next we go to Ind AS 10, which is, now these are the simplest standards now getting done. After this, you have the slightly more complex ones. So Ind AS 10 is events occurring after the balance sheet date or events occurring after the reporting period. So over here, what is a post-balance sheet period? Well, post-balance sheet period is a period which starts after the balance sheet date, immediately after the balance sheet date, and it continues up to the date when the financial statements have been approved by the board of directors, signed by the board of directors. All other dates, like the dates when audit committee finalizes it, or auditor's report is finalized, or an accountant finalizes, or shareholders approve, or you file it with the regulator, all of them are irrelevant. The only date that is relevant is the date when the directors approve the financial statements. So if in that intermediate period, let's say directors approve the financial statements in May, so from 1st April to, let us say, 31st May, if there are certain events that are happening, when should they be recorded? Well, they should be recorded in the next year. However, if this pertains to conditions which are already existing as on the balance sheet date, so for example, there was a sale that you have already made in February where the credit period is expiring in April, So on 31st March, you have shown debtors. However, when you see in April, these debtors have actually gone bad. It means that even on 31st December or 31st March, these debtors did not have the ability to pay, just that you were not aware. Now that you are aware, you can create a provision for bad debts even on 31st March. This is called as an adjusting event. So what do you do with adjusting events? You create an entry to adjust the financials, provided they pertain and they give you additional information of a condition which is already existing as on the balance sheet date. That is what you call as an adjusting event. What are the examples of adjusting events? For example, the subsequent insolvency of a debtor which was existing on the balance sheet date, or the estimated selling price at which inventory has been sold in the post balance sheet period, or the subsequent settlement of an ongoing litigation which was there on the balance sheet date, are all examples of adjusting events. Adjusting events are adjusted for in the books only. On the other hand, what do you mean by non-adjusting events? Non-adjusting events are those events which do not pertain to any condition which is existing on the balance sheet date. So for example, when you look at an amalgamation that is done after the balance sheet date, it's an important event, it's a material event, but it does not pertain to any acquisition which was already done as on the balance sheet date, or dividend declared in the post balance sheet period. All of these are material events. Major asset purchases or major asset disposals are all material events, and these material events have to be disclosed in the notes. They should not be accounted for in the current financial year. They can be accounted for in the next financial year. Are we clear with this? Yes, okay. So this takes care of Ind AS 10, and then you go to a fairly important standard which is Ind AS 12 on income taxes. This is tier 1 category, a very important standard. Okay, so when we look at Ind AS 12, this is on income taxes. What do you cover under this standard? Well, how should income tax expense be recorded in your books of accounts? Now, why do you need a separate standard for this? Because income tax expense, as we know, the current tax that you have to pay is actually calculated as per the Income Tax Act, not as per books of accounts, as per Income Tax Act. However, we don't present our computation of income to the readers of the financial statements. We just show our income statement as per Ind AS. So what is happening is a mismatch. You're showing the profits as per books, but the tax is calculated as per Income Tax Act. Now, there are differences in the working as per books as well as per Income Tax Act. Maybe because books have SLM depreciation, income tax has WDV depreciation. Or maybe because in the books deduction is availed for interest as and when it is accrued, but as per section 43B of the Income Tax Act, deduction is availed for interest paid to a scheduled commercial bank only when the payment is done. So there may be certain differences, and because of this there is a difference between the tax that is appearing or that should appear based on your profit in the books and the tax which is appearing as per Income Tax Act. Some of these differences are considered to be temporary differences. That is, they are created in one of the periods and they will reverse in the subsequent period. For example, when you look at depreciation, if the asset is worth 100, whether you take SLM, whether you take WDV, the total deduction through depreciation that you get for an asset is going to be 100 only. So if books allow a 25% SLM depreciation, whereas income tax allows, let us say, 50% SLM depreciation, in the first 2 years you will get much higher deduction in income tax, a much lower deduction in the books. However, in the subsequent years, when the asset is fully written off under income tax, there will be no depreciation, but in the books depreciation will still continue. So basically we are trying to say that depreciation ka aapko deduction milega, maybe not at the same time, but you will get the deduction. These are called as temporary differences. There may be certain differences which are other than temporary, loosely called as permanent differences, like donation to unregistered charitable institutions. These are never going to be allowed as a deduction under Income Tax Act. In the books, we don't care whether it is registered or unregistered, you will show this as an expense, but under income tax, it will never be allowed as a deduction. And as a result, these are called as permanent differences. Now, permanent differences do not create any timing mismatch, which means you pay something now. If you're not going to get a deduction, you are never going to get a deduction. So there's no point creating what you call as a deferred tax. However, temporary differences are temporary in nature, which means you probably get a deduction now. You'll have to pay more tax in the future. You probably don't get a deduction now. You'll have to pay less tax in the future. So these are temporary differences. The standard segregates temporary differences into two types. There's a taxable temporary difference, which is a temporary difference due to which you'll have to pay more tax in the future years. Like the depreciation example, you might pay lesser tax now because of the higher depreciation rate, but you'll have to pay more tax in the future years, deferred tax liability. On the other hand, there can be deductible temporary differences. For example, there might be section 43B items or preliminary expenses where in the books you will get full deduction in the year when you incur the preliminary expenses, but in the Income Tax Act, 1/5 each year. So in the first year you might have to pay more income tax because you're getting only 1/5 of the deduction, but in the future years you'll get more deductions and hence you might pay lesser income tax, and hence this is a deductible temporary difference. And for a deductible temporary difference, you create what you call as a deferred tax asset. For deductible temporary difference, you create a deferred tax asset. Okay, now when you create a deferred tax liability or deferred tax asset, what do you debit? Well, for a deferred tax liability, a liability is created, so deferred tax expense will be debited. For a deferred tax asset, asset is debited, to deferred tax expense / income will be credited. Where do these expenses and incomes go? Well, these expenses and incomes will typically go to the profit and loss account as long as the underlying items like sales, purchases, rent, etc. goes to the profit and loss. However, if the underlying items go to the other comprehensive income, like for example, if there's a FVOCI equity item, in which case fair value through other comprehensive income, if there's any change in the fair value, it will go to the fair value reserve, which is a part of other comprehensive income. So if there is any tax implication due to that, that will also appear in the other comprehensive income because the underlying gain or loss is going in the other comprehensive income. On the other hand, if there are certain taxes which are pertaining to items which are recorded directly in equity, so for example, in the earlier days there was dividend and then a DDT. Now dividend is directly deducted from retained earnings. It is not shown as a part of the income statement, not shown as a part of other comprehensive income. It is directly deducted from equity, in which case the DDT that you pay will also be deducted directly from the equity section only. Okay, so that is about the recognition of these tax items. Now, how do you calculate deferred tax? If you just take the basic steps for deferred tax calculation, first you will try to calculate what is called as a carrying value. Before that, you will try to identify what the underlying asset or liability is. So for example, if it is depreciation, the underlying asset is a PP. If there is let us say interest, then the underlying item is, let us say, a loan or an interest payable. If there is let us say development cost for an intangible asset, then it is intangible asset. If it is interest on loan, it is loan. So you will have to figure out what the underlying asset or the underlying liability is. So for example, if we take depreciation, the underlying asset is a PP. First step is calculate the carrying value. What do you mean by carrying value? Carrying value refers to the value as on the balance sheet date as per Ind AS. So over here, the institute expects you to apply Ind AS principles, and based on the Ind AS principles, it expects you to calculate the carrying value. Second, you calculate what is called as a tax base. Now there are various ways in which you can think about the tax base, but one of the most easiest way to think about tax base is if you were to hypothetically prepare a tax balance sheet, then what will be the value that will appear in the tax balance sheet? So for example, if the asset is purchased at 100, so the entry is asset account debit to bank in your tax balance sheet, and then if income tax allows a 50% depreciation, then the entry will be depreciation account debit to asset of 50 rupees in your tax balance sheet, which means in the tax balance sheet your tax base will be 50, that is 100 originally minus 50. That is the tax base. If in the books the depreciation was 25, then 100 minus 25, 75. Then 75 minus this 50 will be shown as a difference, and this difference gives birth to a deferred tax asset, or this difference gives birth to a deferred tax liability. Now, how do you calculate a deferred tax asset or a liability? You will take the difference into the tax rate, that will give you the deferred tax asset or the deferred tax liability. Now, this deferred tax asset or liability determination is based on some rules that you can remember at this stage. The rules are, if the carrying value of the underlying asset is greater, or the carrying value of an underlying item is greater. So if you have a situation where the carrying value of the underlying item is greater than the tax base, it is more than the tax base, the answer is always going to be opposite. So an underlying asset will create a liability, an underlying liability will create an asset. So if there is a PPE, which is an underlying asset, and the PP has a carrying value which is 75, which is greater than the tax base, for example of 50, then the difference over here will create a deferred tax liability because the carrying value is greater than the tax base. Then the difference of 25 into the tax rate will be the deferred tax liability. On the other hand, if there is an underlying liability like a 43B item, like an interest payable. So if the interest payable in your books is having a 10 rupees value, tax base is 0, for example, because you have not passed any entry, then the carrying value is greater, in which case it creates a deferred tax asset. So this is a general rule. We will, you can remember this rule or any other method that you have used to remember it. If the carrying value is lower, the answer is always in the same direction. So if you have an underlying asset, you also get a deferred tax asset. You have an underlying liability, you also get a deferred tax liability. When the carrying value is equal to tax base, well, there is no difference and hence it does not create any deferred tax. This is to be accounted subjected to certain exceptions. Exceptions on creation of deferred tax asset are you should have sufficient benefits against which you can create a deferred tax asset. Remember, when you pass the entry for deferred tax asset, the entry is deferred tax asset account debit to, let us say, profit and loss. So when you credit the profit and loss over here, you are creating, let us say, an income. And since you are creating an income, this is on account of a contingent item. So the standard says we will not allow you to recognize it unless you can show us that this deferred tax asset is capable of being claimed as a deduction in the future years. When can you claim deduction? Loosely speaking, you can claim deduction if you can earn sufficient profits in the future years, against which you can claim deduction. आज हमको deduction नहीं मिला, future में मिलेगा. अरे but जब ही मिलेगा, will we have enough profits to utilize it? Or can we implement certain tax strategies through which you can earn those profits to implement it? Or are there taxable temporary differences whose reversal pattern matches the reversal pattern of deductible temporary differences? So these are the benefits that the standard outlines. If you have sufficient benefits, only then can you create a deferred tax asset. Next you go to the determination of tax rate. Which tax rate should you use for deferred tax workings? Well, you should use the tax rate for the current tax working of the year which is in consideration. But deferred tax is a tax of the future years. Now you cannot predict the future tax rate. It is based on the government. So what you will do is you will look at laws or budgets or notifications which have been enacted or substantively enacted till the balance sheet date. So for the year 21-22, in the month of February 22, the budget for the next year had come in. So if I had to create the deferred taxes at the end of the year, I will create it based on the tax rates which are given in the budget for the subsequent year. That gives me a peek into what the government expects the tax rates in the future to be. Okay. Now, deferred taxes to be created at tax rates which have been enacted or substantively enacted till the balance sheet date. Okay. In certain cases, the institute might ask you cases regarding carry forward losses. Now, what do you mean by carry forward losses? Well, carry forward losses over here are those losses which under the Income Tax Act you can carry forward, let us say usually for a period of 8 years. In books of accounts, there is nothing called as carry forward losses. If there is a net loss of 50 in the current year, it is recorded as a loss of 50. In income tax, if there is a loss of 50, it is carried forward to be offsetted in the subsequent years. So carry forward losses always create deferred tax assets because they will give you a lower tax or a deduction in the subsequent years, and hence deferred tax asset is created for carry forward losses. In certain cases, there are exceptions even in case of liabilities. So in case of business combination, when you take over the assets and liabilities, you will try to calculate deferred tax based on the differences between the fair value and the old carrying values or tax basis of these net assets that you are taken over. That is required to be calculated. However, on goodwill, the standard exempts you from creating any deferred tax liability. So the standard says in case there is goodwill, you do not need to create any separate deferred tax liability on goodwill. A few other exceptions are also given on liabilities, where if you are making an investment in a subsidiary, in your income tax, that investment will continue at cost. However, in your books, the value of investment may change because when you do consolidation, you kind of even add the post-acquisition profits. When will the reversal happen? For such cases, a very special case, not very important though. The reversal will happen when dividends will be paid by the subsidiary. But the payment of dividend by the subsidiary is actually controlled by the parent company, and since the parent can control the timing of the payment of dividend, the standard exempts you from creating deferred tax liabilities or differences which are arising due to investments in subsidiaries. However, in investments in associates, etc., such an exemption is not available because associates, you cannot control the timing of the deduction. So this takes care of Ind AS 12, a very important standard and a fairly detailed one as well. Next you go to Ind AS 16, which is on property, plant and equipment. So what is a PP? PP is something which is tangible, which is held for your use, and which typically has a life of more than 12 months. You will recognize PP if it is capable of giving future economic benefits and the cost is measurable. Now, at what value will you recognize a PP? At initial recognition, you will recognize a PP at the purchase price plus non-refundable taxes plus directly attributable expenses plus borrowing cost if it pertains to a qualifying asset plus the present value of site restoration obligations, if any. All of these together will give you the cost of the PP. Again, over here, the standard has mentioned that normal loss can be a part of cost, though abnormal loss cannot be a part of cost. A few items like inauguration expenses, training expenses for your employees, relocation expenses, losses before commercial production, all of these are not to be taken as a part of your cost of the PP. Directly attributable incomes like let us say sale of debris in the course of a redevelopment project can be reduced. However, if incomes in the course of construction like rental income from a car parking lot are not directly attributable to construction, then you will take these incomes to the profit and loss account. You will not reduce it from the cost of the asset. A few special cases have been given by the standard. First, pertaining to deferred payment, that is payment which is at or beyond 12 months, and second, pertaining to barter. So if the payment is made at or beyond 12 months, if the payment is made at or beyond 12 months, which is what you call as a deferred payment, in such cases you will recognize the asset today at cash price equivalent. You will recognize it at present value. So if you are purchasing the asset today, it will cost you 20,000. If you purchase it today but payment is made after 2 years, you have to pay 24,000. Then you recognize the asset today at 20,000. The remaining 4,000 will be recognized over 2 years in the form of interest. Then you have barter. Barter over here can have commercial substance or it can lack commercial substance. Assuming it has substance, that is it is a real barter, you will recognize it at the fair value of the asset given up unless the fair value of the asset received is more reliable. The hierarchy which is followed by the institute over here is sub point 1. It has to be based on the fair value of the asset given up. If that is not available, then the fair value of the asset received. If that is also not available, then the WDV of the asset given up. Okay, so this is about initial recognition. When we look at subsequent recognition, the subsequent expenditure like repairs and maintenance will be taken to the profit and loss account. Day-to-day repairs and maintenance, minor replacement will be taken to the profit and loss account because these are expenses after the asset is ready for use. However, if there are expenses which increase the life or increase the efficiency beyond what is originally assessed, then these items which increase the life or efficiency beyond what is originally assessed will be taken as will be capitalized. So if you install a CNG system in your car which improves the efficiency of the car, you will add that to the cost of your car. If you do a change in your air conditioner from, let us say, a copper from an aluminum based system to a copper based system which increases the life by 2 years, then again you can add it to the cost. If it increases the life or efficiency, you can add. A very special case over here is on major replacements, major inspections and major overhauls. If it is major, so for example for Indigo, inspections and overhauls are major. If it is major, then the standard says that if you have to do regular inspections, then you will add the cost of the new inspection or the cost of the new overhaul or the cost of the new part replaced and then subtract the WDV of the old part. How do we calculate the WDV of the old part? Well, it is based on the breakup available in the supplier's invoice. If that is not available, then based on the fair value. If that is also not available, then based on the written down value of the old part, which is based on assuming that the cost of the new part is equal to the cost of the old part and then doing time value as well as depreciation related adjustments. So this is regarding major replacements. You add the cost of the new part, subtract the WDV of the old part. Then you go to subsequent valuation in the balance sheet. in the balance sheet you can measure the PP either using the cost model or using the revaluation model. Under the cost model, you will show the PP at initial cost, less accumulated depreciation, less accumulated impairment. On the other hand, under the revaluation model, you will show the PP at fair value, which is to be determined at sufficient intervals, less subsequent impairment or depreciation. Now, when can you apply the revaluation model? Well, revaluation model can be applied. Revaluation model can be applied if you believe that it will show a better picture to the readers of the financial statements. The revaluation model has to be decided if you apply to a class of PP. Class of PP refers to assets having a similar nature and a similar end use. Like all assets under the commercial land will be similar class. However, they will be different from the machineries that you hold. So machinery can be valued using, let us say, the cost model, whereas land, urban, commercial land can be valued, let us say, using the revaluation model. These revaluations have to be done at sufficient intervals, and the sufficient intervals are defined to be a period of 1 year for volatile assets and period between 3 to 5 years for largely stable asset values. Next, you go to the accounting treatment for revaluation. If there's an initial upward revaluation, the initial upward revaluation will be adjusted against the revaluation surplus, which is a part of other comprehensive income, whereas an initial downward revaluation will be adjusted against the profit and loss account. So if there's an initial upward revaluation which will go against the revaluation surplus, and then there is a subsequent downward, then you will first adjust the balance in the revaluation, excess if any against the P&L. If there's an initial downward and then a subsequent upward, then you will first adjust the balance against the P&L, and then excess if any will go against the revaluation surplus. The balances that go in the revaluation surplus will be a part of other comprehensive income, and you will continue to show them at other comprehensive income till the time of disposal or derecognition of assets. At that point, you will transfer the balance in the revaluation surplus to the retained earnings directly, not through the statement of profit and loss, to the retained earnings directly. An option has also been given to transfer the balance in the revaluation surplus to the retained earnings in the ratio of depreciation as well. When we look at depreciation can be calculated using the SLM method, WDV method, units of production, etc. The estimates that go behind the depreciation calculation, as useful life, salvage value, have to be reassessed at each year. Also, an important point to remember is that if you want to change the method of depreciation from SLM to WDV, that is treated as a change in accounting estimate, not a change in accounting policy. The standard says that the component method of depreciation is something which is mandatory. What do you mean by component method? If your asset comprises of major components, like an aircraft comprises the internal seating, which is a major component, which is a life which is different from the life of the asset. So for example, internal seating in an aircraft has a life of 5 years, whereas the aircraft has a life of 20 years. Then you have to use a component method, which means you will depreciate the seating, the cost attributable to the seating, for a period of 3 years, whereas the cost attributable to the other parts of the aircraft will be depreciated over, let us say, 20 years. So this is the component method of depreciation which is there for property, plant and equipment. Site restoration is an important thing in property, plant and equipment, and if there is a site restoration obligation, it is to be recognized at present value initially, along with the cost of the asset. Subsequently, this site restoration obligation can change due to the passage of time, which is what we call as unwinding of discount. This unwinding of discount can be taken in the P&L as finance cost, or it can change due to changes in your estimates. If estimates change, then the present value of those changes will be adjusted against the cost of the asset in case you are following the cost model, or it will be adjusted against the revaluation surplus if you are following the revaluation model. Okay, so that is about PP. Another complex standard will be Ind AS 19, which is on employee benefits. This standard covers all employee benefits, all of them. It covers all the employee benefits except for ESOPs, which are covered under a separate accounting standard, Ind AS 102 on share-based payments. So the standard divides the employee benefits into 4 main categories: short-term employee benefits, post-employment benefits, other long-term benefits, and termination benefits. What are short-term employee benefits? These are benefits which are like salaries, wages, bonus, etc., which are payable in less than 12 months. you will record these expenses on an undiscounted basis. You don't need the help of an actuary or anyone. You will record this on an undiscounted basis as and when the expenses are incurred. However, post-employment benefits like gratuity, pension, etc. are payable at or after retirement, and hence to record them, you need to predict how much will be the liability. Well, the standard over here has two types of plans. There is something called as a defined contribution plan, and then there is something called as a defined benefit plan. So when we look at the defined contribution plan, this is a plan where the amount of contribution has been defined. Like a provident fund plan, the employer has to pay 12%. That's it. After that, the employer is not bothered. In which case, the expense that has to be recognized in each year is 12% of the salary. You don't have to predict that when an employee retires, what will have to be paid. However, something like gratuity or something like pension, if you just contribute money, that is not sufficient, because you have to pay 15 by 26 into the last one salary into completed years to an employee. You must have thought that the employee, when he retires, will have a salary of 10,000. If he has a salary of 20,000, you will have to pay based on that, and hence the amount of liability has been defined. In such cases, you will have to use the projected unit credit method to find the value of the liability. If you are not able to do it, you can even take the help of an actuary for this valuation. So defined contribution plans, the expense will be based on the contribution amount, whereas in defined benefit plan, the expense will be based on the liabilities. The changes in liabilities will determine the expense. The accounting for a defined benefit plan is a lot more complex because it has items like current service cost, interest cost, past service cost, curtailment gains or loss. All of these have to be calculated in order to find the defined benefit liability, like a gratuity. Sometimes to meet these liabilities, you might also have assets, which are also called as plan assets. You might invest them in, let us say, a plan assets, like you will have, let us say, investments in bonds, in debentures, etc. These investments are to be shown at fair value, and if these investments are to be shown at fair value, you will show them at the fair value opening and then the fair value at the closing. The difference is over here. It can be due to returns. These returns can be due to dividend, due to interest, due to realized gains or losses, or even unrealized gains or losses. There are three items of all of these which can go into other comprehensive income, that is changes due to actuarial estimates which are changing in liabilities. So if an actuary changes his estimates, it will be taken in the remeasurement reserve as a part of OCI, or it may be due to changes in the expected return versus the actual return, which will also be going in the other comprehensive income. And lastly, there will be changes due to the effect of asset ceiling, in which case they will also go into the other comprehensive income. Okay, so in the balance sheet, you will show the net defined benefit liability. From that, you subtract the net defined the plan asset, and that will give you the surplus, which, loosely speaking, subject to asset ceiling, will be shown in the balance sheet. So this is fairly complicated working. You will have to glance through the workings for the defined benefit liability. We have just tried to give a summary over here on what will be shown as a part of liability. Like there is an opening liability over here, and this opening liability will increase, let us say, due to interest, that is due to passage of time, will increase due to current service cost, that is the cost which is incurred due to the current year service, due to past service cost if there was a change in plan, due to curtailment if there are reduction, and it will reduce due to the benefits paid. Apart from that, there will be a change due to actuarial assumptions as well, which can be taken over here. When we look at plan assets refer to the opening fair value, to which you adjust the interest, subtract the benefits paid and contribution, and then you get the closing fair value. So these numbers will go in your calculation. So your closing liability will come over here, your closing plan value of assets will come over here, and that is the net number that will be shown in the balance sheet. Post-employment benefits are basically benefits which are paid at or after retirement. On the other hand, if you look at other long-term benefits, these are benefits which are paid beyond 12 months but before retirement. Like a jubilee benefit, for example, is paid on a silver jubilee that an employee completes. So it is paid before retirement, but it is paid beyond 12 months. So this is another long-term benefit. The accounting for other long-term benefit is exactly the same as accounting for post-employment benefits. You have to remember that in case of other long-term benefits as well, you will do the actuarial valuation. Just that the only point you have to remember is there will be no other comprehensive income impact in case of other long-term benefits. So changes in actuarial assumptions, changes in return of plan assets, everything will go in the profit and loss account only. Okay. And lastly, there is termination benefits. Termination benefits refer to benefits that you're paying on account of termination, which can be voluntary like VRS, or involuntary like retrenchment, you fire an employee. In which case, if you are under an obligation to pay a compensation, that compensation will accrue the moment you decide to terminate the services of an employee. Okay, so that is regarding Ind AS 19. Next we go to Ind AS 20, which is on government grants. Next we go to Ind AS 20, which is on government grants. Now what is a government grant? Grant is actually a monetary value or a quantifiable amount of benefit that the government gives an entity. There's also something called as government assistance. Government assistance is something which is like a support which the government gives you, but it cannot be quantified. So if there's a government assistance, that is something which cannot be quantified, you will disclose it. But if there's a government grant, you will actually quantify it and you will record it. So when we look at a government grant, it has to be accounted for in the books. Government assistance is merely to be disclosed. Government grant can be a grant which is linked to assets or a grant linked to income. How do you define a grant linked to assets? If a grant is given which is directly attributable to acquisition or construction of an asset. So if you are constructing a windmill and if you have a grant which is directly attributable to the acquisition of the asset, then this is a grant which is linked to assets. On the other hand, a grant linked to income is defined as a grant which is other than a grant linked to assets. So anything which is other than a grant linked to assets is considered to be a grant which is linked to income. Now, the grants which are linked to assets can be accounted for either using the net method or the gross method. What do you mean by net method? So if there's a 300 rupees asset and you have a 200 rupees grant, you can record the asset directly at 300 minus 200, that is 100, that is the net method. Or if you want to show the asset at the full value, the gross method, then you show the asset at 300 and 200 will be shown as deferred grant. What do you do with the balance in the deferred grant? It will be written off to the P&L in the ratio of depreciation. So if the depreciation is straight line, then on a straight line basis, even the balance in the deferred grant, let us say 200, will be written off. Income linked grants are grants which are other than grants linked to assets. For income linked grants, you will recognize the grant based on the type of the expense it is intended to compensate. So for example, if it is intended to compensate for past expenses, past losses that have already been incurred, then the standard says that you will recognize it immediately. So if there is a flood or an earthquake which has happened and this is a grant which is given to compensate that, then you will recognize in the P&L immediately. However, if it is a grant which is given to compensate for future expenses like training expenses in the future, then you will recognize it in deferred grant and then defer it in the P&L as and when those expenses actually happen. The presentation of these grants can be in terms of an asset linked grant. You can reduce the value from the cost of the asset or you can show it as a deferred grant. In case of income linked grant, you can show this as a deferred grant in the balance sheet while you are preparing the P&L. You can either show the grant amortized as a reduction, so training expenses minus grant amortized, or you can show training expenses and expense separate and then you can show other income separate. So that is a presentation. Okay, next is a standard on foreign exchange, that is Ind AS 21, an important standard. This standard rests on the concept of what you call as a functional currency. What do you mean by functional currency? Well, it is a currency of the primary economic environment in which you operate. So largely if I am an Indian company, I have my sales which are denominated in rupees, my expenses are largely in rupees, my competitive environment, my regulatory environment is in rupees, then my functional currency is the rupee. However, so I have to prepare my accounts in rupees. However, if I'm an Indian company, but largely my sales are in dollars, my expenses are in dollars, I have my customers, etc. in the US, then even though I'm an Indian company, my functional currency is the dollars. I have to prepare my accounts in the functional currency. What is a foreign currency? Foreign currency is a currency which is other than the functional currency. So if I'm an Indian company with rupees as my functional currency, every currency other than the rupee is the foreign currency. And the presentation currency is a currency in which the financial statements are presented. So over here, the financial statements for a company like Coca-Cola, which is a US company and an Indian subsidiary, Coca-Cola India Limited. Coca-Cola India's functional currency is the rupee. However, it's a private company. The only objective of preparing accounts is to consolidate with the parent. Parent you wants in dollars, so you present it in dollars. So presentation currency is a currency in which the financial statements are presented. Functional currency is a currency in which entries are passed. Foreign currency is every currency other than the functional currency. Okay, now what are the conversion principles that you have to remember for your own transactions? So if you were to enter into transactions directly, what are the principles you have to remember? At the time of initial recognition, you will always convert at the spot rate prevailing as on the date of transaction. At every balance sheet date, depending on whether an item is monetary or non-monetary, you will take the principles. What are monetary items? Monetary items are those items which give you a fixed or a determinable amount. A fixed or a determinable amount at each date. So something like debtors, loans, creditors are monetary because they give a fixed or a determinable amount at each respective date, whereas non-monetary items are those amounts like land, building, intangibles, etc., which do not give a determinable amount at each date. So when we look at monetary items, the standard says they have to be converted at the closing rate, whereas non-monetary items have to be usually converted at the historic rate, that is the rate on the date when the cost was determined. This is provided you are following the cost model. However, if you are following the revaluation model or a fair value adjustment, then you will recognize the non-monetary items at the rate on the date when fair value is determined. So for example, if the asset of PP has an initial cost of $5,000, now its fair value is $6,000, then you will convert the 6,000 at the rate on the date when 6,000 was determined. So if 6,000 was determined on 31st March 22, then you will convert the 6,000 as on the rate on 31st March 22. Where do foreign exchange gains or losses determined as above go? Well, if the foreign exchange gain or losses is on monetary items, they will always go to the profit and loss account. However, if they are for non-monetary items, they will generally be going to the profit and loss account unless the underlying gain or loss goes to OCI. So for example, in case of an upward revaluation, the underlying gain or loss on the fixed asset will go to the other comprehensive income revaluation, in which case the foreign exchange gain or loss will also go to the other comprehensive income because the underlying gain or loss is going in the OCI. The foreign exchange gain or loss will also go to the other comprehensive income. Next, you go to foreign operations. So foreign operations means if you have a foreign branch or if you have a foreign subsidiary and you want to convert the financials of the foreign branch into your own currency, then how will you convert it? Now before that, what is a foreign operation? Foreign operation is an operation whose functional currency is different from your own currency. For example, a foreign operation may be a largely independent operation. So for Tata, Jaguar and Land Rover, which is a British company, is a largely independent foreign operation capable of financing its own operations, not as much dependent on Tata Motors, in which case the functional currency of Jaguar is pounds, the functional currency of Tata Motors is rupees, so it is a foreign operation. However, when I prepare consolidated financial statements, the entire balance sheet of Tata Motors has to be converted into rupees. Now, how will you convert this into rupees? For which you will have to apply the translation principles. Over here, all assets, all liabilities, whether they're monetary or non-monetary, are all converted at the closing rate. That historic, etc. is only in case you are doing a direct transaction. So you are buying a machinery, then that historic, etc. principle applies. However, if you have a foreign branch and those financials have to be converted, you will directly convert them at the closing rate. Incomes and expenses are usually converted at the average rate, and share capital will be at the historic rate. Reserves will be at the rate as on the date those reserves have been earned, for the periods for which they've been earned, the average profits. Now, when we look at the balance sheet, we are using some places closing rate, some places historic rate, some places average rate. How will it tally? It will not tally, and as a result, there is a difference which arises because you use different rates, and that is called as foreign currency translation reserve, FCTR, which is to be shown as a part of other comprehensive income. This amount will continue to remain in FCTR till the time of disposal of the foreign operation. The moment you sell the foreign subsidiary, the amount in the FCTR will be transferred in such a case to the profit and loss account. Okay, now that is largely about the translation principles. Can you change functional currency? Yes, you can change a functional currency provided there is a change in the primary economic environment in which you operate. So earlier you were teaching Indian students Indian courses in rupees. Now you are teaching foreign students foreign courses whose payment and faculty charges are in dollars. That is a change in the primary economic environment, in which case functional currency can change. Remember, this is a change of facts, has to be prospectively applied. It's not a change in accounting policy, and hence there will be no retrospective application over here. So that takes care of Ind AS 21. Next you go to Ind AS 23, which is on borrowing cost, another important standard. Now what do you mean by borrowing cost? Borrowing cost refers to interest, or borrowing cost over here refers to the finance charges that you are paying in case of, let us say, a lease liability or exchange differences to the extent they are attributable to borrowing costs. So these are basically borrowing costs. And what do you do with borrowing costs? Well, typically you take them to the profit and loss account unless they are attributable to a qualifying asset, in which case you capitalize them. Till when can you capitalize them? Well, till the time the asset is ready for use. After that, capitalization cannot happen. After that, any borrowing cost, if any, will go to the profit and loss account. Now, what is a qualifying asset? It is an asset which necessarily takes or ordinarily takes a substantial period of time to be ready for its intended use, which is typically a time period of beyond 12 months. But that is not mandatory. 12 months is not a mandatory condition. If it takes a substantial period of time, you can treat it as a qualifying asset. And if there's a borrowing cost which is incurred for a qualifying asset, it has to be capitalized till the time the asset is ready for use. So from when can you start capitalizing the borrowing cost? Well, you will start from the commencement date. Commencement date is the date which is the later of the date when loan is taken, or date when activities commence, or date when expenditures are incurred. You will continue capitalization till the time substantially all activities which are necessary to get the asset in the ready to use condition have been completed. That is, the asset becomes ready for use. In the middle, can you suspend capitalization? Well, yes, if there is an interruption which is happening due to an extended period of time, due to factors which are abnormal or beyond the control of the entity, something like a lockdown due to COVID, borrowing costs during that period of lockdown can be suspended from being capitalized. Instead, they will go to the profit and loss account. What are the types of borrowings? Well, there are specific borrowings and general borrowings. Specific borrowings are like you have a house which is a qualifying asset and you take a housing loan. So specific borrowings are those borrowings which are specifically for a particular purpose. What do you do with borrowing cost on specific borrowings? The actual borrowing cost on specific borrowings will be capitalized. The actual borrowing cost on specific borrowings will be capitalized minus income on temporary investment of surplus funds, if any. So the net borrowing cost after deducting income on temporary investment of surplus funds can be capitalized. What about general borrowings? Now, general borrowings are not directly attributable to acquisition of a particular asset. However, since the general borrowings are available for the company at large to be used, we can consider that after money has been utilized out of specific borrowings, it can also be utilized out of general borrowings. So we don't know how much money is going to be utilized, and hence we calculate what is called as a weighted average borrowing rate. For calculating weighted average borrowing rate, you will take the interest cost of all the general borrowings in the numerator and the time-based average of all the borrowings in the denominator. That will give you the weighted average borrowing rate. Multiply the weighted average borrowing rate with the expenditure incurred on each qualifying asset. So to find how much expenditure or how much borrowing cost is attributable to qualifying asset. If a lot of expenditure is incurred, you can allocate more borrowing cost. If lesser expenditure is incurred, you can allocate lesser borrowing cost. So this is something which is slightly important. Again, it requires a fair bit of practice for borrowing cost. Questions can come along for borrowing cost along with PP questions as well. The next standard is on related parties, which is an average important standard. This is a disclosure standard. Now, what is the significance of having related parties? Well, related party report has to be disclosed in the notes to accounts. This is primarily so that the readers of the financial statements are aware that certain transactions which are done with related parties should be investigated upon, or may be viewed with suspicion, or the management should be questioned, because there's a possibility that if the transaction is happening with the related party, it may not be at arm's length. Remember, you don't have to check whether the transaction is at fair price or not. Irrespective of whether the transaction is at fair price or is not at fair price, you will have to show the transaction in your books of accounts. You will have to show the transaction in the related party report. So if the question tells you that the accountant believes that since the transactions are at fair price, you don't need to disclose it, that is a wrong contention. Irrespective of whether they are at fair price or not, you will have to disclose them in the books of in the related party report. But transactions with whom? Well, with related parties. Now, related parties can be of two types. These related parties can be parties which are with persons. Now, persons can be individuals who are controlling, individuals along with their close family who are controlling, jointly controlling, or significantly influencing the entity, or individuals who along with their close family members are actually key management personnel. Now, who is a key management personnel? He or she is a person who is responsible for planning, directing the affairs of the entity. Someone like a CEO, CFO, CEO, directors are considered to be key managerial personnel. So the KMP of the entity as well as the reporting entity as well as the parent entity will be taken as a key managerial personnel for related party disclosure. Close family members refer to the immediate family like spouse, parents, children, brothers, sisters, etc. It also includes domestic partner, like your live-in partner, for example, is also included over here if it can be detected. Next, you have company relationships. Now, these are important. These are relationships between two companies. So, when we look at corporate relationships, every entity which is in your group, so your subsidiaries, sub-subsidiaries, co-subsidiaries, all of them will be your related parties. Entities which are joint ventures or associate of the entity will also be a related party. Entities which are two joint ventures having the same partners are related. Entities where one is a joint venture, one is an associate of the same party are also related. What is not related is two associates of the same party. Co-associates are not related parties. So, what about individual relationships? Well, individuals who have control or joint control at one of the places, and at some other places they have control / joint control / significant influence, or they are KMP, then both these parties. So if there is a Mr. X who is controlling or jointly controlling X Limited, and he is having either control or joint control or significant influence, or is a KMP of Y Limited, then both of them are considered to be related to each other. Apart from that, certain other relationships which are not as important, like an entity with its employee welfare plan, or key managerial services, or key managerial entities like key managerial personnel are also related parties. If there is a related party relationship, then in the related party report there are two disclosures. First, you have to give the name and the nature of relationships. So you will give the name and nature of relationships of all parties where we have a control relationships, and where there is no control relationship, you will give the name and the nature of relationships if there have been transactions during the year. If no transactions, no disclosure needs to be given. Apart from that, you will also give a disclosure of the transactions and the outstanding balances that have been done with the related parties during the year. When we look at the related party report, then there is a specific exemption which is available for government companies. So if two parties are related to each other only because they are controlled, jointly controlled, or significantly influenced by the government, then transactions between them need not be disclosed. So for example, in the earlier days, Air India was controlled by the government. Indian Oil is also controlled by the government. So if Air India has purchased fuel from Indian Oil, it's actually a related party transaction because both parties are subsidiaries of the government. However, since both of them are controlled by the government only, the law gives you an exemption that you may skip the disclosure because they are related to each other because of a common government relationship. The standards clarified and said that there are a few relationships which are not related party relationships, like co-associates, co-venturers, a major lender, or a major lender, or a major let us say supplier. Merely because they are a major lender or a major supplier does not mean that there is a related party relationship. Okay, so that takes care of Ind AS 24. Next you go to Ind AS 33. This is a standard on EPS. Now EPS is to be shown on the face of the income statement, and over here on the face of the income statement you have to show the basic as well as a diluted EPS. You have to show both the basic as well as the diluted EPS. So how do you calculate basic EPS? It is calculated as the profit attributable to the ordinary shareholders in the numerator divided by the weighted average number of equity shares. Now profit attributable to equity shareholders is calculated after deducting all expenses, all taxes, preference dividends, everything. In the denominator you take the weighted average number of equity shares, and these weighted average number of equity shares are time based weighted average. So you take the time as a base, and based on the time you take the time based weighted average. That will be the weighted average number of equity shares, but the number of months or days for which shares are outstanding are taken as weights. Sometimes shares are partly paid, in which case you will convert them into equivalent fully paid shares and then adjust them into the weighted average number of shares calculation. Sometimes these shares are issued without consideration, like bonus or share splits, in which case the standard says you will take them from the date which is the earliest reported date. So the date of the bonus issue or the date of the share split is irrelevant. These shares, for better comparison, are to be included from the earliest reported date, that is the first date of the earliest period presented. A very interesting case for basic EPS will be rights issue. In case of rights, we need to make 3 steps because rights might have a hidden bonus. You will first try to find the theoretical X rights price. This is the weighted average price. In the numerator, you will take the price of the shares prior to the rights issue into the number of shares that are required for one right plus the rights issue price into the right share divided by the total shares over here. So this will give you the theoretical X rights price or the post rights price. You calculate the rights adjustment factor as the cum rights price or the fair value prior to rights divided by the X rights price. That will give you the rights adjustment factor, and that rights adjustment factor considers the hidden bonus. So these rights adjustment factor will be multiplied to all the shares which are outstanding and in existence prior to the date of rights. So calculate the theoretical X rights price. Second, calculate the rights adjustment factor and multiply the rights adjustment factor to each number of shares which are outstanding prior to the date of rights. There is also a special appendix which the Ind AS has given for participating preference shares. Now these are preference shares which participate in the profits. After a flat equity dividend and preference dividend is paid, they participate in the profits along with equity shareholders. So the participating preference shares, how do you find the EPS? Well, the standard says you find the EPS by first finding the undistributed profit. So that is the profit minus the fixed preference dividend minus the fixed equity dividend. Whatever is left over is to be shared by preference and equity in case of participating preference shares. So you'll find the undistributed profits and then formulate an equation in the second step. So you can say let the amount paid per equity share be X, in which case the amount paid per preference share, let us say depending on the agreement, is let's say 50% of X, then 0.5X. You will formulate an equation and then find X, which is the share in the undistributed profit for equity shares as well as preference shares, and the total EPS is the distributed profits plus the undistributed profits. That will give you the total EPS. Now this is about basic EPS. Then you go to diluted EPS. In case of diluted EPS, we include potential equity shares. What are potential equity shares? They are like convertible loans, convertible bonds, convertible debentures, convertible preference shares, options or warrants, or contingent shares. These have the potential to become equity shares, though they are not equity shares, at least not during the year. They have the potential to become equity shares. So what do? Well, you will adjust the EPS calculation, whereby in the denominator you will theoretically, hypothetically assume that if these shares were converted into actual ordinary shares, then how many shares will be added in the denominator? You will add that, but When will these convert? Well, the standard assumes that they will hypothetically be converted at the start of the period or the date of issue, whichever is later. So you will add it in all likelihood for the entire period. However, if they were converted at the start of the year, then you will not have to pay them any dividend, any interest, and hence in the numerator, the interest or dividend that was paid to them will also be added back. If there's interest, then the tax savings that interest gave you should also be reversed, and hence interest into 1 minus t is added back. Preference dividend does not give you tax savings, so preference dividend is directly added back. Acha, what about options or what about warrants? Well, in case of options or warrants, you cannot directly add back the number of shares, because unlike preference shares and debentures, when the options or warrants are exercised, actual money comes in. And hence the standard says you'll have to make certain adjustments. So for example, if there were 1000 options whose exercise price was 50, then if these 1000 options were exercised at the start of the year, you will get capital worth 50,000. However, this is just a hypothetical assumption. You have not actually been exercised and you have actually not received capital. So you'll have to consider that वो 50,000 जो हमको मिला उसका हम क्या करेंगे. So the standard says that okay, you are issuing 1000 shares and getting 50,000 rupees. That 50,000 rupees you'll use to buy back your own shares. Let us say at the rate of rupees 80 per share. Then 50,000 divided by 80, let us say 625 shares will be bought back. So what will happen is 1000 shares will be issued, 625 shares will be bought back, and hence the net 375 will only be added in the denominator. This is not done for convertible preference shares or debentures, because on their conversion, the entry is directly debentures account debit to share capital. There is no new money that comes in. In options or warrants, new money comes in, and hence this adjustment has to be done. Sometimes it might happen either for debentures or options where there are multiple conversion ratios. The standard over here says that you will take the conversion ratio that results in the maximum possible dilution, that is the highest possible ratio should be taken for your workings. Again, sometimes it might happen that on inclusion of these potential shares, your EPS increases. The standard says that this is called as diluted EPS, not potential EPS. This is called as diluted EPS, which means if the EPS increases, you ignore them in the working. If EPS reduces, you can consider them in the working, considering them to be dilutive securities. Lastly, there is contingent shares, which may be contingently issued depending on satisfaction/non-satisfaction of certain conditions. The standard says that these contingent shares should be included in the basic EPS calculation if and only if the conditions have been fulfilled. If the conditions have not been fulfilled, the shares are not issuable, should not be included in basic. However, in diluted, they can be included considering the current period to be the end of the contingency period. So if the conditions are hypothetically fulfilled in the current year, we will assume that if the current year was hypothetically the end of the contingency period, will the shares become issuable? If your answer is yes, you include them in the diluted EPS calculation. If the answer is no, you don't include them in the diluted EPS calculation. It's a fairly complex discussion. This will largely take care of your basic EPS workings as well. Next thing that you go to is interim financial reporting. Ind AS 34, which is on interim financial reports. This is not a really important standard. So in interim financial reports, what is an interim period? Interim period is a period which is shorter than a financial year. Financial year usually is 12 months, but even if the financial year is 9 months, if you want to change an accounting year or you have been incorporated in the current year, if the financial year is more than 12 months, it does not really matter. Interim period is a period which is shorter than the financial year, and hence if you are preparing financials for an interim period, the standard over here mentions that you can either prepare complete financial statements like you do in the annual financial statements, like the complete balance sheet, complete P&L, complete notes to accounts, detailed disclosure, or you can prepare a condensed financial statements which comprises of just the headings and subheadings. There is a condensed balance sheet, condensed P&L, condensed notes to accounts, etc. Significant notes only. This is only applicable to companies which are preparing interim reports. Not every company prepare it. Like listed companies do, but the standard mentions that the presentation requirements of listed companies are already given under clause 41 of the listing agreements, and hence the provisions of Ind AS 34 do not apply to these listed companies. So if other than listed companies, if there are some other companies, then the provisions can apply to them, provided they are preparing an interim report and claiming that this report is as per Ind AS. Now, how will you measure and account the items in the interim report? Well, the measurement usually is using a discrete view, which means you consider the current period, current quarter, let us say, as you can consider the current quarter, let us say, as the entire financial year. So if an expense is to be recognized in the quarter, you can recognize it. However, can you defer the expenses over multiple quarters? The standard says, well, if they can be deferred over 4 financial years, they can also be deferred over 4 quarters. If they cannot be deferred over 4 financial years, they cannot even be deferred over 4 quarters. So for example, when we look at let us say advertisement expenses, you can't spread advertisement expenses over 4 years, then you cannot even spread it over 4 quarters. The only exceptional point or the important point over here is income tax. You have a lot of questions on income tax, and income tax, the standard believes, should be accounted for what you call as an integral view. Integral view means you view the entire year, and based on that you determine the income tax. So what do we mean by that? Well, we calculate the estimated accounting income, we calculate the estimated annual tax based on Income Tax Act, and you calculate the weighted average tax rate. The weighted average tax rate is calculated as having the estimated tax amount in the numerator and then having the estimated accounting income in the denominator, that is the weighted average tax rate. This weighted average tax rate is going to be multiplied by the accounting income in order to find the tax that is to be recorded. Various special cases can come over here, which can be linked to carry forward losses, or in sometimes special items like capital gains. So the standard over here says if there are multiple tax rates at which incomes can be taxed, like capital gains at a different rate, other items at a different rate, then we have multiple weighted average tax rates. Different tax rate for WATR, a different tax rate for capital gains, different tax rate for business income. Okay, so this is something that you should focus on, the tax rate in the Ind AS 34. Okay, so I guess we have done a lot of theory. I'm really sorry, but there is very limited time. I know it is a little dry when there is so much of theory, so much of literature thrown at you, but with the time that you have and the coverage that we want to do, rather than covering a very small percentage, we want to kind of touch upon everything that is there. So when you sit to revise for your main paper, you are at least having bits and pieces recollected. So we are just spending a lot of time just throwing theory. I know it gets a little mundane, but if we invest a lot of time in solving, explaining examples here and there, discussions, we will not be able to complete such a vast subject. So please bear with me for these few hours. It is my humble request. Okay, so I'll just give you a 5-minute breather. Or it is 7:33 or 7 minutes breather, let us say. It's 7:33 in my clock. So we'll start back at 7:40 sharp. So just take a quick breather, wash your face, and we'll be back in around, we'll be back by 7:40. Okay? Okay, so we'll go to the next accounting standard. The next accounting standard over here is the standard on impairment. This is Ind AS 36. So what is impairment? Impairment refers to the reduction in the earning capacity of the asset. Impairment refers to the reduction in the earning value that an asset can generate. So how will you calculate impairment, and when will you calculate impairment? Well, impairment is calculated whenever there is a indicator of impairment. Indicators of impairment can be external, indicators of impairment can be internal. So external indicators of impairment can be like a legal ban, internal indicators of impairment can be like a physical damage or a short circuit, etc. When we look at let us say the impairment testing, you compare the carrying value and you compare this with the recoverable value. So what do you mean by carrying value? Carrying value refers to the ledger balance that an entity has. So just a second. So over here, impairment, when we want to calculate the impairment testing, we compare the carrying value with the recoverable value. Carrying value is your ledger balance, whereas the recoverable value is defined as the higher of the net selling price or the value in use. The net selling price over here is calculated as the fair value minus the cost to sell, whereas the value in use is calculated as the present value of the future cash flows. When we calculate the present value of the future cash flows, this is the present value of the cash flows from operations. So you will not subtract interest, you will not subtract tax over here. However, when we do these workings, consistent Assumptions have also to be taken in the discount rate. So your discount rate will always be the WACC, the weighted average cost of capital, because that is the required rate of return for both debt and equity, because interest is not subtracted while calculating the cash flows. Again, the WACC is to be calculated pre-tax, because tax is not deducted while calculating the cash flows. So you will compare the net selling price or the value in use and select whichever is higher. So whichever is higher will be the recoverable value, and carrying value, if the carrying value is 100, the recoverable value is 80, then the impairment loss is 20. The impairment loss of 20 will first go to the profit and loss account. However, if there is a revaluation, then first we will adjust the impairment loss from the revaluation, and excess, if any, will be taken against the profit and loss account. Next, when we go further, we want to see if the impairment loss which is recorded once, can it be reversed? Well, the impairment loss which is recorded once, it can be reversed provided it results in improvement in the service potential of the asset. For example, if there was a legal ban and subsequently there is lifting of a legal ban, then the lifting of legal ban is an indicator of reversal of the impairment, and as a result, this lifting of the legal ban can be taken as an indicator of reversal of impairment, and this will be permitted. So while you are doing reversal, remember, reversal of impairment on goodwill is prohibited. You cannot reverse impairment on goodwill. For other assets, you can reverse up to the recoverable value as on the date of reversal, or the carrying value had there been no impairment. You can't reverse beyond that, because if you do that, that will result in an indirect upward revaluation. Now, this is impairment in case there is single assets. The more important section of impairment is if there is a group of assets. Group of assets is called as a cash generating unit, a CGU. What is CGU? CGU is the smallest group of assets which are capable of generating a largely independent cash flows. So if an individual asset is not capable of generating an independent cash flow, then we do the impairment testing on a group basis. So the group of assets should be capable of generating a largely independent cash flow, in which case you will try to calculate the carrying value of the entire CGU, compare it with the recoverable value of the entire CGU, and say that there is an impairment for the CGU. Now, this impairment is for the entire group of assets. How will you allocate this impairment? Well, the first part of this allocation will go to goodwill. If there is any allocable goodwill which is a part of the carrying value, the first part of the impairment will go to goodwill. The remainder of that will go to all the other assets in the CGU which are eligible under Ind AS 36, all the other assets in the CGU in the ratio of their carrying values. So over here, these other assets can also include common corporate assets like common research and development centers, common head offices, common office buildings, common training centers, all of them on a proportionate, on a pro rata basis will be allocated. After this allocation, one has to remember that the carrying value cannot fall below the carrying value had there been the recoverable value. So, for example, the net selling price of an individual asset is 20 rupees. The carrying value less the impairment cannot fall below the net selling price or the value in use of an individual asset. So, this is impairment for a cash generating unit. Again, if you are doing reversal, the reversal of impairment is prohibited for goodwill. You cannot reverse impairment for goodwill. For other assets, you can reverse up to their individual carrying value had there been no impairment, or the recoverable value as on the date of reversal. Recently, Institute has been asking a lot of questions on the impairment in case of subsidiary. So, in case there is a subsidiary, there will be goodwill in the consolidated balance sheet which is attributable to the subsidiary. Now, there are two methods. There is a partial goodwill method and then there is a full goodwill method. When you look at partial goodwill, you will recognize goodwill only to the extent of the parent's share. However, all other assets and liabilities you have 100% fully consolidated. However, the goodwill is attributable only to the extent of the parent share. In which case, how will you do the impairment testing? Well, you will take the carrying value of the entire subsidiary, all the assets and liabilities 100%. However, if you have an 80% stake in the subsidiary, goodwill will be only for 80%. In which case, if you compare that carrying value of the subsidiary with the recoverable value will be for the entire business of the subsidiary, and as a result, you will compare the carrying value of the subsidiary after grossing up the goodwill. So, if the goodwill is for 80%, you will also recognize the unrecognized goodwill which was attributable to the NCI. So, if 80% is, let us say 800, then 100% is how much? Let us say 1000. So, you will recognize that find the total carrying value, compare it with the recoverable value and figure out what is the impairment. So the impairment over here will be the difference between the total carrying value minus the recoverable value. This impairment will be attributable to first the goodwill and then the other assets. When you attribute it to goodwill, let us say if parent has an 80% stake, whatever is the impairment loss, 80% of that will be attributable to the parent's goodwill which is recognized, 20% to the NCI's goodwill which is not recognized and hence there will be no separate impairment as such. Next, when we go to the working, there can be other assets and these other assets can be of any category. So these other assets over here will be 100% consolidated. So 80% of that is attributable to the parent, 20% of that is attributable to the NCI. So this loss will be attributable between parent and NCI both. This will arise in case of partial goodwill questions. In case of full goodwill questions, the 100% of goodwill is recognized and hence the carrying value will include 100% of the goodwill, 100% of the other assets. So you don't need to separately do any grossing up. Compare that with the recoverable value, find the impairment, allocate the impairment loss first to goodwill, then to other assets, and part of this will be attributable to the parent, part of this will be attributable to the non-controlling interest. There's also a section over here in case of impairment loss allocation for an unallocable asset. If there's an unallocable corporate asset, then you will first do impairment testing at a smaller level, at the smaller CGU level. After that, for the company as a whole, you will allocate the unallocable asset and then do the CGU testing for the company as a whole in case there are any unallocable corporate assets or if there is any unallocable goodwill. Achha. Next, you go to the next standard which is provisions and contingencies, Ind AS 37. This is the standard which is linked to the liabilities. Now, the obligations over here can be present obligations, the obligations over here can be possible obligations. These create liabilities. Now, liabilities can be certain, in which case you can show them as liabilities, or they can be subjected to certain measurement uncertainties where you create provisions, or they can be possible obligations where you give a disclosure like a contingent liability. So, what is the general principle? You will create a liability or a provision if there is a legal or a constructive obligation. Legal obligation arises due to a law or a contract. Constructive obligation arises due to past practices or published policies which create expectations in the minds of affected parties. When you create when there is a contingency results is due to a possible obligation, not due to a present obligation. Now, contingency over here may be a contingent liability or it may be a contingent asset. If it is a contingent liability, the standard says that if it is probable, that is there is a more than 50% chance that a payment will have to be made. If the contingent liability is probable, you will recognize you will create a provision for the same. However, if the contingent liability is uncertain, then you will merely give a disclosure. If the contingent liability is remote, then you will ignore it. Sir, when is it probable? If there is greater than a 50% chance, then it is probable. When is it uncertain? Equal to 50 or less than 50 is uncertain. Remote is something which is even less than 5% chance is considered to be remote, where you ignore it. So typically, if nothing is given, contingent liability has to be disclosed. If it is specifically told that it is probable, it has to be recorded in the books. When we look at contingent assets are subjected to prudence and conservatism. So if contingent liabilities, you create a provision for contingent assets, you do not necessarily create a provision. In fact, you will merely give a disclosure if it is probable, because it is an asset. You do not want to account for it till the time you are virtually certain. Virtually certainty arises out of facts. It is absolute certainty, not based on estimates and judgments. So when there is virtual certainty, then you can recognize an asset. Before that, you will at best give a disclosure. If it is uncertain, you will ignore altogether. Sir, when does virtual certainty arise? For example, if there is an insurance claim that you have filed, when the insurance company actually gives a formal confirmation, that is when virtual certainty arises. When insurance companies gives a formal certification, before that, your agent tells you that it is almost sure that aapko paisa mil jayega. That is not virtual certainty, that is probable, not virtual certainty though. Okay. So this is the accounting for contingencies, both contingent assets and liabilities. When we have to measure provisions, either because of a contingency or otherwise, certain principles have to be remembered. Provision has to be first measured based on the best estimate. You can use the most likely method or you can use the expected value method. but you will have to measure these provisions based on best estimate on a pre-tax basis. Should you do the present value workings? The answer is yes. If the payment for a provision is to be made at or beyond 12 months, then present value workings will also be done. You will have to recognize based on the present value if the payment is to be made at or beyond 12 months. If the payment is made within 12 months, then no present value working is required as such. Next you go to certain rare cases where even after all of these data, you are unable to measure the provision. So, for example, you have a company which is new, in which case it can probably use as industry data to measure the provision, let us say for warranty. However, if it is in a new industry altogether where there has been no past competitor as well, in which case it becomes very difficult to measure the amount of provision. So in extremely rare circumstances, if you are unable to even measure the amount of provision, then the standard over here mentions that you will have to give a disclosure in the notes that you are unable to measure the provision and hence you are not recognizing it in the books. Two special cases in the standard is first on onerous contract, that is a burdensome contract. What do we mean by an onerous contract? Onerous contract is a burdensome contract where the burden of fulfilling the contract or completing the contract is greater than the benefits that you will get from the contract. So, for example, you have taken a contract to buy certain goods at the rate of rupees 5 lakhs and you now decide to discontinue your business. In which case, what will you do with that order where you have taken non-cancelable order, for example, of 5 lakh rupees? In which case, you will have to take those goods at 5 lakhs and probably sell it at a lower price, let's say 4 lakh 50. In which case, the benefits on the goods, which is 4 lakh 50, is less than the cost, that is 5 lakhs, and hence 50,000 over here is a loss. It's a burden. If you can negotiate with the seller to cancel the contract, the seller will charge a cancellation penalty, for example 60,000 or 40,000. The unavoidable loss on this contract is, if let us say the seller charges 60,000, then you will kind of buy the goods at 5 lakhs, sell it at 4 lakh 50, then 50,000 is your loss. That is unavoidable in nature. So the unavoidable loss on fulfilling the contract is greater than the benefit, so that for that 50,000 you will have to create a provision for losses on the onerous contract. That is first thing. Second is the provision for restructuring. What do you mean by restructuring? Restructuring is similar to closure, termination, etc. That is what you call as restructuring. So in case of restructuring, when do you create a provision for restructuring? Well, when there is an obligation to restructure. When is there an obligation to restructure? If there is a legal or a constructive obligation. A legal obligation to restructure would be arising, for example, due to a court order, whereas a constructive obligation to restructure will arise probably due to a detailed formal plan which is approved, and that plan is either implemented or that plan is communicated. So there is a constructive obligation and you will create a provision. At what amount will you create a provision? Well, all the directly attributable expenses which are linked to termination, which are linked to closure should be included. So legal fees, banker fees, termination expenses that you are paying to your employees whose jobs are getting terminated will all be a part of the provision for restructuring. However, expenses which are linked to continued operations, something like relocation expenses which are linked to your continuing business and not necessarily linked to your termination or closure, or cost of setting up new systems at the new geography that you are going to operate, all of these are costs linked to continuing operations and not long costs linked to closure, and as a result they will not form a part of your provision for restructuring. So this largely takes care of your provisions and contingencies. The next standard that you go to is Ind AS 38, which is on intangible assets. Now this is a smaller version of Ind AS 16, which is on property, plant and equipment. So when we are looking at the intangible assets, what is the distinctive features of intangible assets? Three of them. First, they have to be identifiable, that is either separable or giving a contractual license or a right. Second, they have to be non-monetary, and third, they have to lack physical substance. If all the three criteria are satisfied, then it is an intangible asset. Lacking physical substance means you cannot touch, feel, see. Non-monetary means that they do not have a fixed or a determinable contractual value that they give, and identifiable means that they give they can either be separated out and sold separately, or they are arising out of a license or a contract or a law. For example, Maruti has a 40% market share in India. This 40% market share cannot be separated and sold. So that market share is not separable. Again, that market share is not out of a license that Maruti has. It is out of probably the work, the goods that Maruti sells, and as a result, this is not arising out of a license as well. So market share cannot be shown separately in the balance sheet of Maruti. However, something like a patent or a copyright can be separated out and sold separately. Telecom license is a license which is arising, which can be shown separately because it is identifiable. Now, if these three conditions are fulfilled, then an asset is considered to be intangible. Merely because it is intangible, should you recognize it in the books? Not necessary. If it is intangible, then over and above that, you have to see whether the asset is under your control. So, human resources, for example, in general are not controlled by the entity, and hence human resources cannot be shown as intangible assets. Second, does it give future economic benefits like research expenses? At least in the research phase, they are not sure whether they will give future economic benefits or not, and hence research expenses are not capitalized. In fact, they are taken to the P&L account. And lastly, and very importantly, the cost has to be measurable. For example, if there is a company like Hindustan Unilever, there are hundreds of brands that Hindustan Unilever has, like Surf Excel or Close Up, etc. Now, how much is the cost that the company has incurred to kind of build a brand? Now, that is very difficult to determine the cost that the company has incurred to build a brand, and as a result, the cost over here is not measurable reliably. And since the cost is not measurable reliably, well, these self-generated assets are not recognized in the books. Purchase goodwill is recognized, but self-generated is not, because the cost for this self-generated goodwill is not measurable reliably. Next, you go to special cases for intangible assets, most notably the research and development case. So, what is research phase? Research phase is considered to be the ideation phase. Research phase is considered to be the ideation phase, where you have an idea, like you want to find a solution or a cure for HIV/AIDS. So that is an idea that you have. Expenditure incurred during the research phase has to be expensed to the P&L because we don't know whether we will get future economic benefits or not. Development phase starts when the research phase ends. So if your idea, you now think that there is a molecule and this molecule can cure HIV/AIDS, that is when you start developing it, doing clinical trials, etc. That is a development phase. So the expenditure in the development phase can be capitalized, provided there is technical feasibility, provided legally we believe that there will be some benefits, provided there is financial feasibility and cost is measurable. If all of these conditions are fulfilled, the expenditure incurred in the development phase can be capitalized. Otherwise, the expenditure in the development phase will also be expensed to the profit and loss account only. So over here, the expenditure which is incurred in the development phase is capitalized subject to conditions. Expenditure in the research phase always expensed to the P&L account. The standard also clarifies that if you are not sure whether it is research or development, then you treat it as research and expense it to the profit and loss account. One of the things that you have to remember for intangibles under development is you cannot amortize it till the time it is ready for use. However, at each balance sheet date, you will have to test it for impairment. So you will have to find the recoverable value and test it for impairment annually. What about amortization for intangible assets? Well, amortization for intangible assets depends on whether the intangible asset is a finite life or an indefinite life. So if the intangible asset is a finite life, maybe something like a legal life, then the standard says you will have to amortize it over the finite life on a systematic basis, and if there is no systematic basis, then on a straight line basis. The standard gives a clarification that in all cases, revenue-based amortization in general is not considered to be an appropriate amortization base. Revenue-based amortization is not permitted except for very rare cases, it is not permitted. So, systematic basis cannot say that we will amortize the intangible in the ratio of revenue. No, you can use other bases like units of production, WDV, SLM, some other bases, but not the revenue. For intangibles with an indefinite life, like trademarks, brand names which are acquired, for example, they might have an indefinite life. Then the standard says that if there is intangibles with an indefinite life, then you will not amortize it over any time frame. Like in the older standard AS26, you would have amortized it over 10 years. In this says you will not amortize it. Like land, you do not amortize. In a similar way, you will not amortize this. However, even these assets, you will test it for impairment annually. So which are the assets which are tested for impairment annually? Typically, assets are tested for impairment when indicators exist. However, intangibles under development, intangibles with an indefinite life, and goodwill under business combination. These are the three assets which are tested for impairment annually. All other principles for intangible assets are similar to that of tangible assets, like initial recognition will be at cost, barter will be based on the fair value, if there's deferred payment at the cash price equivalent. Subsequent expenditure if it increases life or efficiency capitalized, otherwise you take it to the P&L account. Subsequent valuation using cost or evaluation model, and amortization as the case may be. The only additional clause that the standard has put in for intangible assets over and above tangible assets over here is you can follow the revaluation model only if and only if the fair value for the intangible asset can be determined from an active market. So if you can determine the fair value of an intangible asset from an active market, then we can consider that to be under evaluation. Otherwise, for other assets, the evaluation model is prohibited for intangible assets. Okay, next we will go to Ind AS 40, which is on investment property. Investment property is land or building or both, which is owned by the entity or taken as a right of use asset with the primary intention of earning rental income or capital appreciation or both, and it is not held for the purpose of own use or not held for the purpose of sale. So when we look at investment property, it is only land and building. So if you are owning car for the purpose of renting out, that is not investment property, that is under PP. Land and building which is owned by the entity or taken under lease, that is you are lessee, so you will recognize a right of use asset, and given out, now you become a lessor as an operating lease. The primary intention is to earn rental income or capital appreciation or both, and not for your own use. So if I am buying a classroom for my own teaching, that is PP, own use. If let us say Oberoi Realty is buying, let us say, buildings for the purpose of sale in the ordinary course of business, they are real estate companies, that is inventory. However, if someone tells me there is a lot of appreciation, if you buy a plot of land, let us say in Ahmedabad, I decide to buy a plot of land in Ahmedabad, I probably don't have a coaching center there, I want to buy there because of the capital appreciation I think it is going to happen, in which case over here that is investment property. Land, building or both, acquired primarily with the intention of earning rental income or capital appreciation or both. So the standard over here gives additional guidance for special cases, like if there is a vacant property or a property under construction, how will the accounting happen? Well, the accounting for a vacant property or a property under construction will be based on initial accounting, at least will be based, thankfully I think now there is some peace, at least momentarily. So the initial accounting will be based on the intention. So if you ultimately intend to use it for your own use, then it will be taken as PP. If you ultimately intend to give it out on rent, then it is investment property. But what if the use is undetermined? If the use is undetermined, the standard over here mentions that you will show it as an investment property. Now, a special case over here is also if there is an asset which has dual use. So if there's a 5-floor building, 2 floors are for your own use, 3 floors are rented out. In such cases, the first 2 floors are separately saleable from the last 3 floors, and hence you will show the asset proportionately. So let's say if there's a 5-floor building of 50 crores, 20 crores will be shown as PP, own use. The remaining 3 floors, so that is 30 crores, will be shown as investment property. However, if you have let us say a house which has 5 rooms, out of which 2 rooms you are using for your own use, and the remaining 3 rooms, let us say you are giving out on rent as paying guest, etc. Can you still do proportionate? The standard says no. Why? Because you cannot sell the house proportionately. There's a single entrance, you either sell the entire house or you sell none of it. You can't just sell 2 rooms. And hence the standard says if you are recognizing the asset, this asset has to be, if you are recognizing this asset, proportionately it has to be separately sellable. It has to be capable of being separately sold. However, if it is not capable of being separately sold, it will be entirely recognized. It will entirely be recognized as a PP unless the own use component is considered to be insignificant, in which case, in rarest of the rare case, it can be investment property. Otherwise, there will be no prorata. It will entirely be shown as PP. Aja. Why are we having a separate standard? Well, in the balance sheet, you will show investment property as a separate line item. Apart from that, the working over here is slightly different. Well, when you look at the accounting for investment property is same. Initial recognition will be at cost. Subsequent expenditure will be added if it increases life or efficiency. Depreciation will be done on building. Everything remains the same. However, the subsequent valuation which you could have done using the cost or the revaluation model, Ind AS prohibits revaluation model for investment property. Just for perspective, international accounting standards permit the fair value model, but they say if there's a fair value model, international accounting standards will take the gain or loss to P&L. We don't believe that the gain should go to the P&L if it is not realized, and hence we have prohibited the fair value model. Instead, the recognition will be based on the cost model only. So the recognition of the important thing over here is an accountant has to follow the cost model only for investment property. He is not permitted to take the revaluation model. However, because investment property is for investment, we are obviously interested in knowing the fair value, and hence the standard says that you will disclose the fair value in the notes to accounts. In the notes, you will give a disclosure for the fair value, the method which is used by the valuer, whether the valuer is a qualified person or not. We will disclose all of that in the notes. However, in the books, you cannot recognize the fair value. So that is about Ind AS 40. Next, you have Ind AS 41. This is the last within the 1 to 41 series. After that, the 100 series will start. So when we look at Ind AS 41, Ind AS 41 is on agriculture. Agriculture, what are the items that are covered? First, these are biological assets other than bearer plants, which are used for agricultural purposes. Second is agricultural produce at the point of harvest. And third is government grants, which are linked to biological assets. What is not covered? Well, bearer plants, because they are covered under Ind AS 16. Agricultural produce after the point of harvest, because it goes under inventory. Or other tangibles and intangible assets which are linked to agriculture. For example, tractors which are linked to agriculture is under Ind AS 16, or licenses which are linked to agricultural produce is also linked to Ind AS 38. So, what is agricultural activity? Well, agricultural activity is doing something with a biological or a living asset in order to generate agricultural produce, or in order to generate more biological assets, or for the purpose of selling. So you are either breeding fish, or you are selling the fish, or you are converting it into agricultural produce, whatever it is. So this is an agricultural activity. In agricultural activity, you will manage biological transformation like growth, death, reproduction of the biological assets, and you will also manage harvest. Harvest is the cessation of life process like slaughter, or it is plucking of a fruit from a tree, is like harvesting, detaching it from the agricultural produce. Now we are having a separate accounting standard for this because of the distinctive nature of these biological assets. For example, biological assets reproduce. If they reproduce, how will the accounting happen for new assets that are born? Because the cost model says you have to show them at cost, and hence you cannot really determine the cost of the new calves born from the cows. And as a result, the standard says that the biological assets over here have to be recorded at initial recognition at their fair value less cost to sell. So if a new calf is born, you will recognize a new calf at the fair value less cost to sell. That will be the debit. So calf account debit. 2, you will recognize the gain in the profit and loss account. At every subsequent balance sheet as well, the recognition will be at the fair value less cost to sell, and the difference, if any, will be going to the profit and loss account. Gain or loss, whether it is realized or unrealized, will be taken in the P&L. There is no revaluation over here, and because you are necessarily showing these assets at fair value, you do not need to separately depreciate these assets. Fair value is generally assumed to be determinable. However, in rare cases, if the fair value is not determinable, then the standard over here mentions that in case the fair value is not determinable, you can show them at cost. But if you are showing them at cost, then you can even show the depreciation separately as well. So that is possible. But if you are not showing it at cost, then fair value, it will automatically depreciate. If the value reduces, the fair value will keep on falling year after year. In case required by the question, you will also need to give a disclosure between the fair value changes due to price, fair value changes due to age. All of this is linked to biological assets. Agricultural produce is like the wool from the sheep is agricultural produce, or the mango from the mango tree. Mango tree is a bearer plant, but mango is the agricultural produce. These are the agricultural produce. Agricultural produce at the point of harvest. Agricultural produce at the point of harvest should be recognized as per Ind AS 41. Why? Because actually this is inventory. However, inventory says initial recognition should be at cost. Now it is next to impossible to find the cost of the wool on the sheep or cost of the individual mango on the tree. And hence the standard says that, okay, we want to show it as inventory, but we need a starting point, and hence at the point of harvest, when you are detaching, At the point of harvest, when you are detaching, you will recognize this at the fair value less cost to sell at the specific point of harvest. Are we clear with this? So over here, biological assets will be shown at fair value less cost to sell at initial recognition as well as at subsequent balance sheet date. However, if it is agricultural produce like a mango, like a wool, they will be recognized at fair value less cost to sell at the point of harvest. But then at every subsequent balance sheet, they are inventory and hence they will be recognized at the initial cost or NRV, whichever is lower. The last part of the standard involves government grants. So when we are looking at the government grants, these government grants are grants linked to biological assets. So for example, if you have taken a grant linked to cow, this will be covered under Ind AS 41, not under Ind AS 20. Why? Probably if you cover it under Ind AS 20, this will be a grant linked to assets. And these grants will be deferred in the ratio of depreciation. The problem is for cows, there is no depreciation and hence Ind AS 20 would fail. And hence a separate guidance is given in Ind AS 41 itself. So Ind AS 41 over here mentions that in case there is a grant which is linked to a biological asset, then this biological asset over here, we will not cover under Ind AS 20, we will cover under Ind AS 41. If it is an unconditional grant, the entire grant will be taken to the P&L account immediately. If it is a grant which is linked to the satisfaction of future conditions, then you will recognize it in the P&L as and when the conditions are satisfied. If the conditions are satisfied after 5 years, you recognize it after 5 years. If the conditions are satisfied over 5 years, then you will recognize it over each of the 5 years. So this kind of takes care of Ind AS 41. You have to remember the life of the asset in all of these cases is kind of irrelevant. Okay, so that takes care of the 1 to 41 series. You now jump into the 100 series. I'll just be back in a minute, please. Okay, so we'll go to the next standard, which is Ind AS 101. Now this is on first time adoption. Now this is, to be honest, a fairly complicated standard. A lot of students find a lot of difficulty over here. You will just have to remember the important pointers and move ahead. Do not really invest an inordinately high amount of time on this. So when you look at Ind AS 101, this is for first time adoption, for entities who are actually first time transitioning into Ind AS. For them, what is the transition date? Transition date is a date which is the earliest date of the earliest period presented for the first Ind AS financial statements. So if your first Ind AS financial statements are for the year 1819, then what is the transition date? The transition date is the first date of the earliest period presented. So along with 1819, you will in all likelihood be presenting 1718. So the first date of 1718, that is 1st of April 2017, is considered to be the transition date. So this will be the transition date, and on this date you will have to prepare the balance sheet as per Ind AS. So when you are preparing the balance sheet as per Ind AS, on 31st March 2017, that is just a day before the transition date, your balance sheet will be as per previous GAAP. That is the accounting which was previously used. In all likelihood, that will be AS, accounting standards. The accounting which was previously used for your presentation in India is considered to be the previous GAAP. So previous GAAP over here will be, let us say, the accounting standards AS. So as per previous GAAP, the entire balance sheet would be prepared as per accounting standards. Now you want to prepare everything as per Ind AS, the Indian accounting standards, in which case you will have to do 4 activities. First, you will have to de-recognize items which were recognized in AS but not permitted in Ind AS. So for example, if you have created a proposed dividend which was there in AS merely because a board has proposed, Ind AS does not allow that. Ind AS says dividend can be recognized only once it becomes an obligation, that is once it is declared. So you will de-recognize the proposed dividend. Recognize something which is required as per Ind AS but was not recognized under AS. So for example, liability or equity component in case of convertible bonds are required as per AS, Ind AS, not as per AS. So you'll have to recognize them into your accounts. Reclassify something which was required under Ind AS and was done separately under AS. For example, under AS there was nothing called as investment property, but under Ind AS there is an investment property, so you will have to reclassify it. And lastly, the most important part, which is remeasurement. Remeasure based on Ind AS principles unless a separate deemed cost exemption is provided. What do you mean by deemed cost? Deemed cost means a surrogate, a proxy for actual value as per Ind AS. Because Ind AS is a different accounting policy as compared to AS, Ideally, if nothing was provided, you have to retrospectively restate every item as per Ind AS and accordingly determine the opening balances as on 1st April 17. However, that may be very tedious and hence standard gives certain mandatory exceptions and optional exemptions. So over here, there are a lot of them. The important of them would be on share-based payment, where the standard says that for options which have vested already, not yet exercised as on the transition date, you can either take the previous gap values or you can take the fair value as per Ind AS. For unvested options, the standard does not give you a choice. It says you have to take the fair value as per Ind AS only. Second is foreign exchange. In case of FCTR, foreign currency translation reserve, it says that you can either retrospectively restate as per Ind AS or reset it to a zero value. Third, it says about a foreign exchange gain or loss, which was under para 46A of AS 11, which was for losses, foreign exchange gains or losses on long-term loans, which could have gone in the PNL or which could have been gone in foreign currency monetary item translation difference account as per AS. If you have remembered it, well and good, otherwise chhod do. In such case, the standard says that you can either continue with the previous gap treatment of taking into the foreign currency monetary item difference account, or you can shift to Ind AS, which says you have to take it to the PNL. So that choice is given. Third, you have the PP. So the property, plant and equipment, intangible assets, investment property, investment in subsidiaries, etc. can either be shown by restating as per Ind AS or a deemed cost can be adopted. The deemed cost over here can be calculated as the previous gap carrying value or the fair value as on the date of transition, or you can retrospectively restate. Otherwise, the previous gap carrying value is permitted, or the fair value as on the date of transition can also be permitted as the deemed cost. Sir, but if there are certain differences, like the previous gap carrying value is 100, the fair value is 120, where will the 20 go? The 20 will go against the retained earnings. Typically, the difference, if any, due to transition adjustments, is not treated as gains or loss in the statement of P&L. They are directly taken into the retained earnings only, a reserve adjustment. Another special case is on business combination. So when we are looking at business combinations, the standard over here gives you a choice. The standard mentions that you can either restate the business combinations from a particular date that you select, or you can take a choice of not restating past business combinations but applying Ind AS from the date of transition. However, if you select a particular date, let's say 1st April 2005 you have selected, then all business combinations after 1st April 5 have to be restated. Before 1st April 5, if you don't restate, that is fine. Non-controlling interest as per AS could not be negative, as per Ind AS, for example, can be negative. So how will the non-controlling interest be accounted? Well, it depends on the business combination choice that you have taken. So if you have decided that the past business combinations have to be restated, the non-controlling interest will also be restated as per Ind AS. But you have taken a choice that you want to continue with the previous gap carrying values for past business combinations, then your non-controlling interest will also continue based on previous gap carrying values only, and there will be no retrospective restatement. A few other important items are like compound financial instruments. In case there is compound financial instruments, then you will de-recognize the carrying value of the loan, convertible loan that you have shown, and instead recognize the liability component as well as equity component, whose balances will be based on the values that you determine based on the date of transition. So you will find the liability component and equity component at the date of original issue. Then you will prepare the amortization table for finding the liability component as on the date of transition. Equity component remains the same. The difference, the balancing figure, if any, again will be adjusted against the retained earnings only. Another important adjustment over here can be linked to estimates. Now the estimates over here will be based on the position as on 1st April 17. Yes, currently you are in the year 18-19, date of transition is 1st April 17, so you will have the benefit of hindsight, you will have the benefit of seeing what has actually happened in the 1 or 2 years. You will not consider that for estimates. So you thought based on the position as on 1st April 17 that the bad debt provision is 200. Actually, you saw ultimately that the bad debts actually became 250. Will you revise your estimate at 250? The answer is no. You will continue based on 200 only, because at 200 was correctly determined, appropriately determined based on the value as on the date of transition. There was no separate adjustment. It was correctly and fairly determined. So estimates will not be revised unless there was an error in making your estimate in which case it can be revised. Another thing can be, let us say, investment in a joint venture. As per AS, in a joint venture, proportionate assets, proportionate liabilities are shown. As per Ind AS, a single line item, investment in joint venture is shown. So that investment in joint venture is shown as a single line item under Ind AS. So the proportionate carrying value of all the assets and liabilities as per the joint venture, proportionate consolidation, will be taken as the value for the investment. If, let us say, you have financial assets which are recorded using amortized costs, this is a loan, let us say, of 1990, it's a 50-year loan. 20 or 30 years have gone by, 20 years are remaining. You don't know the effective interest which was prevailing in 1990. Earlier, you did not have this concept of amortized cost. Now, under Ind AS, you have this concept of amortized cost. It is not possible for you to effectively determine what the effective rate of interest would be 30 years back. So, the standard says you either retrospectively restate and find the amortized cost based on the values as on 1990, or you take the fair value as on the date of transition. You cannot take the previous gap carrying values in such cases. Last part, for government grants, the standard also has a similar logic. It says that in case you have information available with you as on the date when the grant was secured, in which case you will retrospectively restate the grant. If information is not available, you will prospectively continue based on the previous gap carrying value of the grant as it is. So, we have discussed a lot of items, a lot of them. The important ones have kind of discussed with you, but there are a lot of them. You don't need to go through all of them. If you just glance through also the important ones, it should ideally suffice. Next, we go to Ind AS 105. This is non-current assets held for sale and discontinued operations. Now, what do you mean by non-current assets held for sale? It can be PP, it can be intangibles, it can be investment property which you intend to sell. Typically, you are holding these assets for the purpose of use in the ordinary course of business, but sooner or later, some or the other day, you might need to sell them. And if you want to sell them, you will classify them as non-current assets held for sale under Ind AS 105. Now, when can a particular asset be classified as a held for sale asset under 105? It can be provided the assets are available for immediate sale in the present condition. So, first point, assets are available for immediate sale in the present condition. Second, the sale is highly probable. When can we say that the assets are available for immediate sale in the present condition? We can say that if subpoint 1, you don't need to do any renovation or refurbishment on the asset can be sold as it is. And secondly, the asset is not critical to your ongoing operations. You can sell them and still your ongoing operations will not be affected. Sometimes what might happen is the asset is required. When the asset is to be sold, it is probably requiring a regulatory approval, which is customary or which is required. The party is ready to sell it, but for the buyer to acquire it, a legal approval will have to be taken. The standard says the asset is still considered to be held for sale, held for immediate sale, because legal approval is customary. It is to be taken. The parties are ready to sell it. It is not that you have to renovate it or stuff. The parties are ready. The approval is the legal approval which is pending. So, that is when the asset is considered to be available for immediate sale in the present condition. Second, the sale has to be highly probable. When we say that the sale has to be highly probable, 5 conditions are tested over here. First, the appropriate level of management should be committed to the sale plan, like the director should be committed. Second, an active process to find a buyer has been initiated, like we have appointed brokers, agents, etc. Third, the price should be reasonable as compared to the current market price. Fourth, a very important condition, the sale process is likely to be completed within 12 months. And lastly, withdrawal from the sale plan is considered unlikely. If all of these 5 conditions are satisfied, that is when we say that the asset, the non-current asset, is available for sale. If the non-current asset is available for sale, then you will recognize it initially at, you will first find the carrying value after applying all indices on the date of reclassification. You will apply the standard on PP, borrowing cost, everything. After applying all indices, you will find the carrying value as on the date of reclassification to non-current asset held for sale. And then you will compare this with the fair value less cost to sell. Select whichever is lower. Once the asset is classified as a non-current asset held for sale, it has to be shown separately as a separate line item in the balance sheet, and depreciation will stop. So why are we doing this? Well, we are doing the accounting which is very similar to that of inventory. You do not depreciate an inventory and you show the inventory at the lower of cost or NRV. A similar working is done for a non-current asset held for sale because you are holding it for the purpose of sale, but you can't show it as PP because you're not holding it for use. You cannot even show it as inventory because you're not holding for sale in the ordinary course of business. And hence the standard over here mentions that you will in such cases show this as a non-current asset held for sale using Ind AS 105 principles. Show it at the lower of carrying value after applying all Ind AS or the fair value less cost to sell. Depreciation post that will stop. You will show this as a separate line item. Now, this is for a single asset. Like in impairment, there could be single asset and there is a group of assets which was called as CGU. Here, that group of assets is called as a disposal group. So, if I want to dispose just one of my benches, that is a non-current asset held for sale. But if I want to dispose my entire classroom, which comprises of benches, which comprises of projectors, which comprises of cameras, which comprises of computers, which comprises of building, air conditioners, that is a group of assets that I want to sell as it is, that is called as a disposal group. So, if there is impairment testing which is required for a disposal group, the principles that you use are going to be similar to the principles for CGU. That is, you will calculate the carrying value of the entire disposal group, compare that with the fair value less cost to sell of the disposal group, and if the carrying value is greater, then there is an impairment under Ind AS 105. This impairment also will first be allocated to goodwill, and excess, if any, will be allocated to other assets in the ratio of their carrying values. Sometimes these groups of assets sometimes can be called as a discontinued operation. What do you mean by discontinued operations? These are assets which are held for sale or assets or a component of an entity which has been disposed of. So if there's a component like a division, a component or a line of business which you are holding for sale. So is classroom a line of business? Generally no. Because if I sell one classroom does not mean I'm ending my coaching activity. I'm still doing coaching. I have 5 other classrooms. However, if I have 5 classrooms and I put all the 5 on sale, that is a discontinued operation. I'm discontinuing coaching. Maybe I do my other business like practice, restaurant business, I will continue. But coaching, I'm discontinuing that. That is considered to be a discontinued operation. What will happen if there's a discontinued operation? Well, the standard says that in case of a discontinued operation, you will show the profit or loss which is earned during the period from the discontinued operation as a separate line item in the P&L as well. Remember, when there's a disposal group or a simple non-current asset held for sale, you do not do anything in the P&L account. You just give a separate disclosure in the balance sheet and end the story. But when we look at a discontinued operation, apart from all of this, you will have to separate out and find out how much is the profit which was earned during the year from the discontinued operation. Show that separately, show its tax impact separately as well. Okay, so that I guess takes care of Ind AS 105. Next, you go to Ind AS 108, which is on operating segments. So this is also a disclosure standard. The segments appear in your notes to accounts. This is a separate disclosure in the notes to accounts. The operating segments over here are dependent on someone who is called as the CODM, the Chief Operating Decision Maker. Now, who is a Chief Operating Decision Maker? He or she is a person who is responsible for making critical decisions which are linked to your operation, which is who is called as a Chief Operating Decision Maker. He is the ultimate authority for taking the operating decisions. Can be someone like a CEO or a COO, Chief Operating Officer, or an executive panel who is responsible for making the topmost operating decisions. So, what is an operating segment? An operating segment is a segment which is a component of an entity which is capable of generating revenue. So, cost centers like head offices, etc., cannot be operating segments. But let us say divisions which are capable of generating revenue, even if it is a startup, as long as it is capable of generating revenue, can be operating segments. Second, these segments are viewed separately, distinctly by the CODM, Chief Operating Decision Maker, for resource allocation and performance evaluation. So, CODM tracks their performance regularly. And third, discrete financial information is available. So, 3 things. First, it should be capable of generating revenue. Second, the CODM should track it separately. And third, discrete, separate financial information should be available. So, that is a segregation of cost, revenue, etc. should be available. In which case, they are operating segments. So, basically, this is based on what the CODM believes, and you will recognize the operating segments. Now, it might happen that CODM views segments at a very, very
granular space. Like a CODM of Maruti might view the data for each of the car models separately. However, a lot of characteristics of passenger cars are similar. And since the characteristics, let us say, of the passenger cars are similar, the CODM over here might view them separately, but we don't want to show them necessarily separately from an investor standpoint. So over here, an investor may want to look at aggregate data. So over here, economic characteristics have to be seen. Just a second. Now, investors may be interested in looking at the overall aggregate data, and hence the standard gives certain aggregation criteria. What do we mean by aggregation criteria? We will be able to aggregate segments. We will be able to aggregate segments over here based on the similar characteristics. So the characteristics over here, if the nature of production, products and services, distribution network, manufacturing processes, regulators, if they are similar, then they can be aggregated. For example, Tata Motors might have various car models like the Indica, Indigo, etc. You can aggregate them into the passenger car segment. Various trucks it might have can be aggregated into the commercial vehicle segment because they have similar characteristics. So you don't need to show each model separately, you can aggregate them. Even after the aggregation criteria, so over here, like you have CODM, discrete information expected to earn, that is operating segments. Then you have aggregation criteria, and then you have reportable segments, the quantitative thresholds. Now, this is really important. This is one of the most important parts of the standard. That okay, after you have done aggregation as well, do you need to show all of them? Well, if they're material, yes. But how do we figure out whether they're material or not? The standard gives you quantitative, numerical thresholds. It says that if your segment revenue is greater than 10% of the combined external and internal revenue, then you are a big segment. If your segment assets are greater than 10% of the overall segment assets, then you are a big segment. Or if your segment result or profits is greater than or equal to the higher of the 10% of absolute segment profits or absolute segment losses, then you are a big segment. So one of the three has to be satisfied. You have to be greater than 10% of the segment revenue, profits or assets, in which case you are a reportable segment. However, if you are smaller than 10% in each of these cases, then you are not a reportable segment, in which case you can be shown along with other segments in the others category. Okay. Now, management might want to show a particular separate segment separately. Is the management permitted? The answer is yes. Even if it does not meet the 10% threshold, the management is still permitted to show these assets separately. Also, for a huge group like a conglomerate, it might happen that there are very few segments which cross the 10% barrier. So the standard has imposed another rule that the segments that you have selected should at least comprise of 75% of the external revenue. If they do not cover 75% of the external revenue, then you will have to keep on adding segments till the time 75% of external revenue has been covered. This is how you identify and disclose the segments. Remember, while preparing segment report, the segment numbers, whether it is segment assets, revenue or profits, they're all operating segment numbers. So something like interest, etc., which is financing in nature. Non-operating items like taxes, etc., are to be shown separately. The numbers, the values that you take is based on what the CODM uses. So if the CODM uses LIFO to measure inventory, in your books you must have used FIFO. But still in the segment report, you will measure the inventory based on LIFO only. That is what the CODM uses, and then probably give a reconciliation if required. The last part of the standard involves the preparation of a segment report. So what are the contents of a segment report? You'll have to first show segment revenue with the breakup of external and internal. Then the segment profit. However, the total of the segment profit will not be equal to the net profit because segment profit is the segment revenue minus allocable segment expenses. In your net profit, there might be various different things like even non-operating items like interest, or unallocable items like MD salary may be unallocable, or taxes. So you will have to show a reconciliation on why your segment profit does not equal to your net profit. This is the income statement. Then you have to go to the balance sheet. So you'll have to show the segment assets along with the reconciliation with total assets, segment liabilities and equity along with the reconciliation of the total. Additional information also needs to be given about capital expenditure as well as depreciation. Also data about major customers, if possible, should be shared. Lastly, this is the primary segment data that you have given. If you are a company which is operating in multiple businesses in multiple geographies, you can even give data about secondary, additional segments. So when we look at secondary or additional segments over here, you can just give summary disclosure. So if you have given the main disclosure for your business segments, for geography, you can just give summary disclosure like what is the revenue from various geographies, what is the assets in various geography, and what is the capital expenditure in various geographies. You don't need to necessarily give the data about profits. So that takes care of segment. And then before you go to the last two big standards of 115 and 116, we will go to 113, which is on fair value measurement. Now, India, as you would have seen, is really obsessed with this concept of fair value. Everywhere you go, you will see fair value appearing from here or there, and hence the standard has decided to put a dedicated standard which will guide on determination of fair value. So what is fair value over here? Fair value is considered to be the exit price. It is the exit price to transfer an asset or a liability in the appropriate market. So this is the selling price, the exit price in the appropriate market. What is the appropriate market? Well, it can be the principal market or the most advantageous market. What is the principal market? It is a market where the quantity, the volume is by far the highest, largest as compared to all other markets. So for example, if there was no NSE, then for stock markets, BSE, Bombay Stock Exchange, had volumes which were significantly higher than every other exchange, then BSE could have been the principal market. However, if BSE and NSE have equally big volumes, then there are two markets, that is BSE and NSE. So in which of the markets will you get the highest net sale proceeds is considered to be the most advantageous market. Most advantageous market is basically the market that you operate. Now you might not be operating in the London Stock Exchange, तो उसका stock market का कितना transaction cost है STT देख के मतलब नहीं. You are operating in the Bombay Stock Exchange. So among the relevant markets like the BSE and NSE, if you were to sell a particular share or a particular good, what will you get in hand? Well, the price for the assets minus transportation cost. Well, shares don't have to be transported, but things like mangoes, for example, may need to be transported, minus the transportation cost minus the transaction cost. So that will give you the net sale proceeds. Transaction costs are like brokerage, transaction taxes, etc. Transportation cost is the physical transportation cost. So the most advantageous market is a market which gives you the highest net sale proceeds after considering both the transportation as well as the transaction cost. However, once you determine what the most advantageous market is or what the principal market is, the fair value is calculated as a price as determined minus only the transportation cost. Transaction cost is not determined because if you subtract the transaction cost, what you will get is fair value less cost to sell, or the NRV loosely speaking. This standard is on determination of fair value. Fair value over here will be the price in the appropriate market, which is either the principal or the most advantageous market as the case may be, minus the transportation cost. If you want to find the fair value less cost to sell, then from that number you can also subtract the transaction cost if required. So that is about the appropriate market. Now, in case of non-financial assets, you will try to measure the fair value for a non-financial asset based on what you call as the highest and the best use. So if there are multiple uses for a non-financial asset like a land, then the highest and the best use based on the usages in the geography or in the market will be considered. The standard at the end gives you guidance about the valuation method. A particular asset, like for example a share, can be valued using various methods like the Gordon's formula, Walter's formula, P multiple approach, various methods looking at the market price. Which method should you use? The standard over here says that यार यहाँ पे आपने बोला price minus transportation minus transaction, price कहाँ से आएगा? Well, price can be calculated based on the valuation method which maximizes the use of observable inputs and minimizes the use of unobservable inputs. What are observable inputs? They are inputs which are actually derived from an observable market data where you don't have any discretion. Whereas unobservable inputs are actually based on forecasts, which you can kind of tweak around, which you can kind of manipulate as well. So when we look at the observable inputs and unobservable inputs, the standard gives you what you call as a fair value hierarchy. It segregates the fair value into three main headings: the fair value hierarchy, level 1 category inputs, level 2 category, level 3 category. So when we look at the level 1 category inputs, these are inputs which are which are quoted market prices of identical assets. So if you have a share of Jet Airways, the market price of Jet Airways is level 1 category input. If you are having 24 karat gold, the market price of 24 karat gold is level 1 category. Level 2 is the quoted market price of similar assets, not exactly the same. So if you have a 23 karat gold, but the market price is available for 24 and 22, then you will take the average of 24 and 22 to kind of find an approximate price for 23 karat gold, in which case that is a level 2 category. And level 3 is financial forecast, which means when you look, for example, for something like a Gordon's formula, you have to predict the cash flows, you have to predict the K, you have to predict the growth. That is not available from market data. That is financial forecast. So that is regarding level 3 category inputs. That is the fair value hierarchy. The valuation technique that you select should maximize the use of observable inputs and minimize the use of non-observable inputs. Ideally, given a choice, you will directly take the quoted market price if it is available. So if quoted market price for Jet Airways is available, you cannot come and say that मेरे को नहीं लग रहा है this Jet Airways price is fair. I think Gordon's formula will give you a better method. Not permitted, because you have to select a valuation method which maximizes the use of level 1 category inputs, that is quoted market price, and minimizes the use of level 2 category inputs. Few valuation techniques have been suggested over here. The valuation techniques can be market approach, where you take the a P multiple, for example, of a comparable company, apply it to your EPS and find the value. Or it can be income-based approach, where you forecast the income and try to find the value today as a present value of future incomes or cash flows. Or it can be the cost or asset approach, where, like in mutual funds, you take the NAV. So there are various methods that are possible. Now what you are left over is largely these big standards like revenue, lease, financial instruments, business combinations, consolidation, and share-based payments. So tomorrow's class, we'll try to dedicate probably 20-25 minutes on each of them. So you have a fair amount of time for discussion for each of these standards. Today we have some time, so I'll just kind of do the last two very sundry topics which are there in your syllabus, not very important. The two sundry topics that we have, first is CSR, Corporate Social Responsibility, which is governed under Section 135 of the Companies Act. The applicability of CSR is applicable to companies, every company which is operating. It can even be a Section 8 company who in the immediately preceding year has either a turnover of greater than or equal to 1000 crores, a net worth of greater than or equal to 500 crores, or a net profit of greater than or equal to 5 crores. In which case you will, if any of these limits are met, in which case you will be required to follow CSR. When I say you have to follow CSR, what are the compliances that has to be done? First, you'll have to set up a CSR committee. Easy. You have to disclose the CSR work done as a part of CSR report in the annual report. Easy. And thirdly, you will have to spend a minimum of 2% of the average profits of the last 3 years for CSR. So this is the CSR spending. While doing CSR spending, you have to remember that you can do CSR spending for eligible activities which are given in Schedule 7 to the Companies Act, which may be items like slum rehabilitation, women empowerment, education, medical support, or contribution to funds like Swachh Bharat Kosh, PM National Defence Relief Fund, PM CARES Fund, etc. These are Section 7 eligible CSR activities. The standard has imposed, not the standard, the company law has imposed certain restrictions like if you are doing activities in the ordinary course of business, that is, you are selling your goods at a consensual price, that is not treated as CSR because you can't distinguish that from sales promotion. If you are doing CSR activities for your employees, again, that is staff welfare, cannot be CSR. If you are contributing to political parties, it is not treated to be CSR. And if you are contributing to something which is outside India, it is again not considered to be CSR. How will the accounting for CSR happen? Well, this is dependent on a guidance note for CSR, which is issued by the institute. As per the guidance note, the standard says that if there's a shortfall in CSR, like your profits are 100 crores, average profits, and you had to spend 2% of that, that's 2 crores, you ended up spending only 1.5 crores, then for the remaining 0.5 crores, you'll have to create a provision. Sir, why do we have to create a provision? Well, because the law is very stringent. The law says that if you don't spend that money, you will be subjected to penal provisions. You will have to spend it. Sir, but nahi spend kiya to, then that 0.5 crores has to be deposited in an unspent CSR account for an ongoing project within 30 days. Or it has to be deposited in an eligible fund. If you don't have an ongoing project, it has to be deposited in an eligible fund like PM Cares funds or a Swachh Bharat Kosh within a period of 6 months. If you don't do that, stringent penalties on companies, officers, etc. are in place, and as a result, over here, you are required to create a provision for 0.1, 0.5 because you are under an obligation. What if you have overspent? So, for example, you have to spend 2 crores, you ended up spending 2.5 crores. Then for the excess 0.5 crores, now you are permitted to show that as a prepaid at your choice. If you want, you can show that as a prepaid as per the standard. Earlier वैसा नहीं था, अभी अपने को allowed है उसको prepaid दिखाने का, because you have paid 0.5 more, which can be adjusted in the future. We have to also remember that the expenses that we are incurring for CSR activities, if we earn any income out of it, that income has to also be used for CSR. For capital assets which are constructed like schools, etc., if the capital asset is allowed as a CSR activity, the depreciation on that capital asset will not again be treated as CSR, otherwise double counting ho jata. And then, lastly, when does a company enter into CSR? We have discussed that in the immediately preceding year, based on the net worth, turnover, and profits. But when does a company exit CSR? Well, if in the immediately preceding 3 years, not just 1 year, in the immediately preceding 3 years, the company does not have a turnover of more than or equal to 1,000 crores, net worth is less than 500 crores, and net profit in all the 3 years is less than 5 crores, that is when it can exit CSR. A fairly new provision has also been enacted whereby the law has mentioned that if your CSR spending is less than 50 lakhs, then you don't even need to constitute a CSR committee, otherwise a CSR committee is required. Next, you have integrated reporting, not very important, barely does it come. Integrated reporting is a framework which is given by IIRC, that is the International Integrated Reporting Council, which is a council of regulators, accountants, etc., which has a broad base of an annual report. It says that what we currently prepare is only a financial report. However, what investors are interested is in how much is value created. So value can be created financially, that is through profit, net worth, etc. But value can also be created non-financially. So when you non-financially would mean intellectual capital, social capital, what you're doing for the environment as a whole, what you're doing for the country as a whole, वो सब भी आपको देखना चाहिए for the society as a whole. And hence value creation is to be viewed at a broader sense. Part of it will be financial information, part of it would be non-financial information. So the essential feature over here is the 6 capitals that have to be covered at least in an integrated report. First is the financial capital. Second is manufactured capital. Financial capital is like the balance sheet and P&L. Manufactured capital is how much output you are generating. So how many barrels of oil or how many minutes of usage have you generated during the year for the country as a large. Intellectual capital, how many patents have you registered? What innovation have you done? Human capital, how much training have you done for your employees? How much of the skill development have you done? Social and relationship capital, like how much have you done for the society which lives near you? And natural capital, what have you done to conserve the environment? All of these have to be disclosed, and there is no specific rigid format like Schedule 3, which is a slightly boring format for a lot of people. There's no rigid format over here, and as a result, companies, and you can see Reliance, Infosys, almost all of these big companies do prepare integrated reports these days. All of these companies prepare integrated reports, and there's no rigid format. Yes, for the financial part, there's a rigid format, but for other than that, there's no rigid format. So, do companies have to prepare this? Well, the answer is no. Again, you have to give a lot of information about your outlook, your strategy, what are the inputs used, what is the processes or the outputs that you are expecting, your strategy, outlook, risks, all of these have to be outlined. Is this mandatory? Well, as per SEBI regulations, the top 500 companies in India, listed companies in India, are recommended to have the integrated report, though it is not mandatory. It can apply to for-profit as well as non-profit, though it is largely made for for-profit enterprises. It can even apply to not-for-profit enterprises as well. Okay, so I guess that leaves us with around 6 important sections, which we will try to cover to the best extent possible in the next session. So that should be it then. Thank you very much for your time and patience, and I will see you tomorrow then.
Okay, so welcome everyone and welcome to the next session for your financial reporting. So today we would be largely discussing the remaining topics, and these are the important topics. All of them are important. So I think we are left with around 6 or maybe 7 topics, and we'll try to cover each of them in around 20 to 30 minutes. So there is revenue recognition, there is leases, there is business combination, consolidation, and financial instruments, share-based payments. So these are the major topics, and this is our agenda for today. So we'll first start with the two standards on revenue and leases. So when we look at revenue recognition, this is covered under Ind AS 115. The core principle that Ind AS 115 has is that we should try to recognize revenue in a way that depicts how we are performing the performance obligations, and at a price which represents the price that we expect to receive, like what you call as the standalone selling price. Now, for which the standard has prescribed a 5-step model for recognizing revenue. First, you have to identify the accounting contract. Second, you have to identify the performance obligations. Third, you have to determine the transaction price. Fourth, allocate the transaction price to each of the performance obligations. And fifth, finally, recognize the revenue. The first and the second step are not very important, but third, fourth, and fifth are fairly important from an exam standpoint. So when we look at the first step, it is the existence of a contract. When we look at an accounting contract, there should be a clear understanding on what is the goods or services to be rendered, what is the consideration to be received, what is the amount that is to be paid, and it should be reasonable that the amount will be received. In which case we consider that there exists an accounting contract, and if there exists an accounting contract, then you can go ahead with the revenue recognition process. The second step over here is performance obligations. So performance obligations are basically promises. So over here, if you are selling an AC, and along with the AC you are selling, let us say, warranty as well as servicing, you are promising to deliver the AC, to give free service, as well as to give free warranty, in which case there are 3 promises. So how will we identify promises? Well, promises, that is performance obligations, are to be considered separately if they are considered to be distinct. Now, how do we figure out whether they are distinct or not? For promises to be distinct, they should give separate benefits, which is generally assumed. However, they should not be separately identifiable. A very important point over here is that they should not be separately identifiable. Now, when do we say that they are not separately identifiable? First, if they are not a part of a larger integration activity, like if you are constructing a power plant and you're doing all of these activities in order to construct a power plant, that is a single performance obligation. All the activities within them are not distinct. They are part of a single performance obligation. Or you are working on the customer's assets. So for example, you are doing some painting jobs on the customer's house. That is a part of a single performance obligation because you are working on the customer's assets, doing a significant modification. So if you are doing, let us say, a renovation work on the customer's assets where you're doing a significant modification, customization, then that customization is considered to be a single performance obligation. And largely, the promises are not highly interdependent. If all the 3 conditions are not satisfied, that is when we say that the performance obligations are distinct. And if they are distinct, then you will recognize revenue for each of them separately based on when they are actually fulfilled. Now, a few special cases are also there in case of performance obligations, like what happens in case there is consignment arrangements, in which case you will recognize the revenue when the consignee sells the goods to the ultimate third party. What if there is principal and agent? Well, in case of principal, you recognize the gross revenue. In case of agent, you just recognize the commission. When do we say that an entity is a principal? Well, if it is primarily responsible for discharging a particular responsibility, it is principal. If it is just acting on behalf of some party, it is considered to be an agent. If there are non-refundable fees like one-time charges, the accounting for these non-refundable fees is going to happen based on the nature of these fees. So if these fees are tied to a performance obligation, for example, then you join a gym, you pay a non-refundable admission fee against which you are given a welcome kit. So you should recognize revenue for the non-refundable fee when the welcome kit is actually delivered. If it is not really linked to a particular performance obligation, then you would recognize it over the tenure of the contract. So this is about performance obligations. The second
step. Now the third step over here is the transaction price. So what do you mean by transaction price? Transaction price refers to the gross value of the consideration that an entity expects to receive. The gross value of the consideration that an entity expects to receive for the consideration for the services that the entity provides. In this value, you will not take the money that the entity collects on behalf of someone else. So for example, if you are selling your goods for 100 rupees and there is an 18% GST, you collect 118, that is not the transaction price. 18 is collected on behalf of someone else, and hence that is not a part of your revenue. Your revenue will be based on 100 only. So this is fixed transaction price. However, is it possible that the transaction price may have some variability? Yes. So if there's variable consideration, should you include that in transaction price? Well, you will, provided it is not constrained. What do you mean by constrained? Well, if we believe that if we include the variable consideration and there is a possibility that it will have to be reversed in the future, then it is said to be constrained. For example, if you don't have enough past experience, you have a variable consideration like a performance bonus on a project, but you are constructing this project for the first time, in which case we are not very sure whether we will be earning that performance obligation or not, in which case the variable consideration is said to be constrained. And if it is constrained, then you will not include it in the determination of the transaction price. However, if it is not constrained, like you have sufficient experience in the past of completing such projects on time, then variable consideration is not considered to be constrained, in which case, in such cases, the variable consideration will also be included as a part of the transaction price. Now, how will you measure that variable consideration, especially because it is variable? The standard recommends two methods. Either the variable consideration over here can be measured using the expected value method, which is a probability based weighted average, or it can be measured using the most likely method, where if you have multiple outcomes, let's say two outcomes, whichever of the two is most likely is the value you will take. In case of transaction price, a few special cases will exist, like what if there is sale of goods which is subjected to returns, in which case the standard says that you will expect that based on your past experience how many goods will actually be sold. So if there are 100 units which are sold during the month and you believe that 30 of them will be returned, then for the remaining 70 you will recognize the revenue, and for the 30 you will create a refund liability along with an asset which is like a recovery asset, where you say that you will recover the money back. Then a special case is for significant financing component. So if there is a significant financing component that arises if the gap between the performance obligation being rendered and the consideration being received is more than 12 months. So if there's a significant amount that is going to be received before or after 12 months from the date when performance obligation is rendered, this is considered to be a significant financing component. The general rule is whenever the performance obligation is discharged, at that time or around that time money should be received. But if the money is received beyond 12 months or before 12 months, then there is a hidden loan, and in such cases you will have to make adjustment for the interest. Interest over here is to be calculated based on the rate, the incremental rate for a separate transaction, or if that incremental rate for a separate transaction is not available, then based on the internal rate of return or IRR of these items. A few exceptions have also been given, like if the difference is due to factors other than, let us say, financing, or if it is due to certain variability like sales based royalty, or if it is due to goods which are at the customer's discretion. In all of such cases, you will recognize the revenue without considering the significant financing component. In other cases, you will have to consider the significant financing component as well. Then you have a few other cases in transaction price, like non-cash consideration, that is a barter. In case there's a barter, you will recognize the sale based on the fair value. Just a second. In case there's a barter, you will recognize the sale based on the fair value of the consideration that you are expecting to receive. So because the standard says that the revenue should be recognized based on the consideration expected to be received, you will recognize a barter based on the consideration that is expected to be received. And if that is not possible, if that is not determinable, then based on the fair value of the goods and services or standalone selling price of the goods and services that you are rendering. Then you have consideration payable to a customer. Usually consideration is payable by the customer. However, if the consideration is payable to the customer, like for example, there is a sale on Flipkart and you are let us say OnePlus, and OnePlus wants to sell its goods on, let's say, Amazon or Flipkart. So the customer over here is Amazon, the seller over here is, let us say, the phone manufacturer. Now Amazon says that apart from what I'm buying, let's say 10,000 phones from you, you will have to pay for my advertising cost. OnePlus agrees to pay for the advertising cost. So this is a consideration payable to the customer. Now the standard over here says that if that consideration is payable to the customer, like Flipkart, OnePlus is paying to, let us say, Amazon, in such case we consider that this is a payment that is made to the customer, and if the payment is made to the customer, are we getting some distinct goods or services? Like for example, are we getting actually advertising which is distinct for us? If yes, then you recognize that advertisement expense separately. For example, you pay 10 rupees for advertisement and you get 100 rupees for the phones, then 100 is recognized as revenue and 10 rupees is recognized as advertising cost, provided that is a fair value. However, if there is no distinct goods or services, then the standard mentions that you will recognize the net revenue, that is 100 rupees minus 10, and hence the net 90 rupees will be recognized as revenue in such cases. If the fair value over here of these goods or services that are distinct is actually not equal to the amount that you are paying. So if the fair value is, let us say, 2 rupees and you are paying 10, then 8 rupees will be reduced from the revenue and 2 rupees can be shown as a distinct expense. Okay, so this is about step number 3. Next we go to step number 4, which is allocation of transaction price. Now the rule over here is you can allocate the transaction price to each of the performance obligations in the ratio of their standalone selling prices. So what do you mean by standalone selling prices? Standalone selling prices is the observable price that an entity expects to receive if they sell a performance obligation, a product under a performance obligation alone. So if I'm Voltas and selling air conditioners along with free servicing along with free warranty, how much amount do I expect to get if I sell only service, or if I sell only warranty, or if I sell only AC? That is the standalone selling price, which is the observable price. However, if an observable price is not available, then what will we do? Then we will use various methods, like we can use the cost plus profit margin method, or you can use the competitor's price subjected to certain adjustments, or you can do the residual method. Residual method means if there are 3 promises and you can find the standalone selling price of 2 of them, the third one can be taken as a balancing figure. Now, while applying residual method, you have to be careful that you should first allocate the discounts, if any. So if there are any discounts which are attributable to a smaller bundle, let us say to 2 of these performance obligations, you will first allocate the discounts and then you will try to find the balancing figure. Again, the residual approach should be applied if you cannot determine the standalone selling price because the goods are not sold alone, or even if they are sold alone, there is a big range of prices. Only then will you apply the residual method. The rule that you have to remember while allocating transaction price is you have to remember that at the time of allocation or after allocation, the consideration that is allocated to each performance obligation should be something which an entity reasonably expects to receive on these performance obligations. If that consideration, as per the rule that you have followed, does not give you the value that you reasonably expect to receive, then the allocation should not be done in let us say in the ratio that you've determined. You'll have to find a different mechanism or different rules to allocate the transaction price. Now, a few special cases which are linked to the transaction price allocation would be, let us say, customer loyalty points. So something like discount vouchers, gift vouchers, or customer loyalty points. If I have to let us say sell a shirt and along with that give some points or give some discount vouchers, I'm considered to be in the 2 performance obligations. One is a promise to give the shirt and one is a promise to give the points or the discount vouchers, which can be redeemed by the customer at a later date. So you'll have to find the fair value of each of these performance obligations and then allocate the transaction price to the shirts, that is the goods sold, as well as to let us say to these points. So that is how you will allocate the transaction price to the performance obligations. Last step is revenue recognition. Now, when can revenue be recognized? Well, the standard says that revenue can be recognized when the performance obligation is discharged. That is when the control of the goods or services is transferred. Now, this control can be transferred over time or it can be transferred at a point of time. When will it be considered that the control is transferred over time? Well, control is considered to be transferred over time if, sub point A, there is a simultaneous transfer of these goods. So the service provider renders and the consumer consumes the benefit. If there's a simultaneous transfer, then we can say that the then the revenue should be recognized over time. Control is transferring over time. So for example, if there's a coaching industry and as a professor teaches, the student over here is considered to receive the benefits simultaneously. How will we understand whether the whether the benefits are received simultaneously? Well, hypothetically, if a service provider had to terminate an agreement midway and a new service provider has to come in, will he start all over again or will he start where the old provider left? So in case of teaching, if a professor is replaced, then the new professor will generally start from where the old professor left. So that is simultaneous transfer. Whereas in case of something like an audit, if an auditor leaves midway, the new auditor that comes will have to actually redo almost the entire assignment. So that is not a simultaneous transfer. Second, if we are doing some work on the customer's asset, so these are like renovations, etc., which are doing on the customer's asset only, in which case the performance obligation is considered to be discharged over time. And lastly, if the goods that you are giving have no alternative use, either due to practical limitations or due to legal restrictions, they have no alternative use, and you are going to get the cost that is incurred plus a reasonable profit margin. So if, let us say, India places an order for Rafale jets with Dassault Aviation in France, let us say Dassault is going to give the delivery of jets 5 years later. However, the Indian government has mentioned that Dassault cannot sell these jets to anyone else, and even if the contract has to be terminated midway, Indian government will pay the cost that is incurred plus a reasonable profit margin, in which case Dassault can recognize revenue over time. It does not need to wait till the time delivery of jets happen. What is the revenue recognition at a point of time? Well, if the conditions for revenue recognition over time are not fulfilled, that is when you will recognize revenue at a point of time. So first you will check if the revenue is to be recognized over a period of time by looking at these three factors, and if all of these three factors are not satisfied, then revenue is to be recognized at a point of time. The point of time over here will be the point where, let us say, you deliver these goods or deliver the services, the ownership transfers, the legal transfers, title transfers. Basically, that is a point in time when the revenue has to be recognized. Achha. Now, a few special cases over here will be something like a repo transaction, where you might enter into a contract where you are selling the goods and then agreeing to repurchase these goods back at a later date at a predetermined price. The standard believes that in such a case, the control does not really transfer to the buyer. If you are agreeing to sell the goods at 100 and agreeing to buy it back at 110 after 1 year, that's more like a loan transaction and not like a sale transaction. Or if you are selling it at 100 and agreeing to buy back at 90, then it's more like a lease transaction, and the 90 that you are receiving is like a security deposit. So that is not a sale but a loan transaction. Another special case over here can be something like license of an intellectual property. So in case of license of IP, the standard gives specific guidance for point of time versus period of time. So if you are taking access to what you call as a dynamic IP, that is, an IP can change over the tenure, the provider has no obligation to you directly. In such cases, you will recognize revenue over time. So for example, there is a club like Chennai Super Kings or Mumbai Indians, and let us say we kind of take the merchandise rights for this club. Now if Mumbai Indians does well, probably the sale of our merchandise will increase. We are the official merchandising partner, so I get that intellectual property. If Mumbai Indians does not do well in the matches, then probably our merchandise sales will not be as high as well. Now, Mumbai Indians is under no performance obligation with us to win the IPL. However, as Mumbai Indians performs, the value of the intellectual property, that is the merchandising rights that we have, might kind of change. And as a result, this is considered to be dynamic IP. If it is dynamic IP, then if I have a 3-year right, then over 3 years, or if I have given a 3-year rights, then the revenue will be recognized over the 3-year time frame. However, if it is a point in time, which means if it is a defunct franchise, like let us say Cochin, which was a franchise earlier, it is no longer there. I'm actually giving the rights to kind of manufacture and sell, let's say Cochin t-shirts, the Cochin team, IPL team t-shirts, which is no longer playing. For whatever reasons, let us say if someone wants to take those rights, then I'm giving what you call as a static IP. I'm not really giving them an IP that can change because the team is not going to play, in which case the revenue has to be recognized at the point of time. They may have a 3-year rights, we will not recognize it over 3 years, we will recognize it immediately when the license is given. You should also look at service concessions or toll roads, which are not PP. However, if there is a contractual right to receive an unconditional contractual right to receive cash, then they will be treated as financial assets. However, if there's a right to collect toll, but not a contractual right to receive a fixed amount of toll or a fixed amount of consideration, then it is treated as an intangible asset. So these are special cases that you should be aware of. At the end, you have some guidance about contract cost. Contract cost can be of 2 types. There can be contract acquisition cost and contract fulfillment cost. Contract acquisition costs are costs which are incremental in nature. So these are incremental costs which are incurred if the contract is obtained, and which will be avoided if the contract is not. So for example, costs like sales commission will be the cost that you incur if the contract is obtained. You will not incur if the contract is not. Similarly, contract fulfillment costs are those costs which are incurred to fulfill the terms of the contract, in which case these are the costs which are incurred to fulfill the requirements or necessities of the contract. What is to be done? Well, contract fulfillment cost, you will see if it is covered under a separate standard. Like if you have to buy computers or software, it is covered under Ind AS 36 or Ind AS 16 or 38 as a case may be. However, if there are certain costs like data migration or designing which are not covered by a separate standard, then they will be covered under Ind AS 115 contract fulfillment cost. So the contract acquisition cost or contract fulfillment cost which are covered under Ind AS 115 can actually be capitalized and then amortized over the contract tenure. Provided the contract tenure is more than 1 year, they can be capitalized and amortized over the contract tenure. If the contract tenure is less than 1 year, you will directly take them to the profit and loss. So this largely takes care of a quick revision for Ind AS 115. Next you go to Ind AS 116, which is the standard on leases. Now this is a youngest standard, at least which is there in our syllabus on leases. Now what is a lease? Lease is another term for rental arrangement. And what is a feature of a lease? In case of a lease, we get a right to direct the use. We have a right to use. We don't own the asset, but we have a right to use an identified asset. What is an identified asset? An asset which is physically distinct. You can pinpoint and identify that this is a classroom on this floor in this building, which you have a right to use, not any classroom in any floor in any building. So you have a right to use an identified asset for some consideration for a specified period of time, which is the lease term. So in order to determine that there is a lease, there has to be an identified asset. An identified asset is something which is either explicitly mentioned in the agreement, or it can be implied that there is only one asset which can fulfill the requirements of the agreement. So this is something which is necessary. There has to be an identified asset which has to be physically distinct. It is fine if the asset is not yet manufactured, but once it is manufactured, it has to be physically distinct. In case the asset is capacity driven, like bandwidth, pipeline capacity, then you should have taken on rent substantially all of the capacity for you to be saying that you have leased the capacity. So there has to be an identified asset, and that identified asset, on that identified asset, you should have a right to direct use. What do you mean by right to direct use? You should be getting substantially all the benefits from the usage of the asset. That can be direct benefits on selling goods by using that asset, indirect benefits like subsidies that you can get on using the asset, or even incomes from subletting the asset. All of that should flow to you. Secondly, you should be in a position to direct usage, which means the decisions on how and for what purpose the asset is going to be used should be taken by you. In such a case, we will say that there is an identified asset and you have the right to direct use on that identified asset, in which case there is a lease. if there is a lease, then what should you do? Well, there are a few key terms that you should aware before you go to the accounting, and also the possibility of assessing a lease contract where there are multiple lease or non-lease components. So for example, if there's a lease contract where you are giving or you are taking, let us say, a car on rent along with a driver, a chauffeur driven car, then there is an identified asset, let us say the car and a driver or a chauffeur, which is not an asset. I mean, it's a service that you are getting, or a building along with the maintenance. So the building is an identified asset, whereas the maintenance is not an identified asset. It's basically an expense or an income, as a case may be. So over here there is a lease component, which is the car, and a non-lease component, that is a driver, or a lease component, that is a building, and a non-lease component, that is let us say the maintenance. There can also be multiple lease components, like you can have building along with the machinery which is given on rent together, in which case what does the standard mention? The standard mentions that you have to separate out all the lease components. So if you are giving out on rent the building and the furniture, so there's building which is an identified asset, furniture which is also an identified asset, in which case you will have to separate out the lease components. Unless they're highly interrelated, you will have to separate out the lease components. Ideally, you should also separate out the non-lease components, like maintenance also should be separately taken, driver should also be separately taken. However, there is a practical expedient, also called as a shortcut, where the standard says that if you want, you may not separate out the non-lease component, but lease component, if they are not highly interrelated, they have to be separated out. Now, if you are paying a single amount, how will you allocate that price to the lease as well as the non-lease components? The standard says that this allocation will be in the ratio of the standalone price. Standalone price over here would be the price if only the building was given on rent, or the price if only the furniture was given on rent, that is, or only the maintenance was taken, that is the standalone price, and you will allocate whatever is the total price to each of the lease as well as non-lease components in the ratio of the standalone price. Next, you discuss a few key terms like what is inception date, what is commencement date, what is lease term, what is lease payments, etc. When we look at inception date, this is the date when either the lease agreement is signed or we have principally agreed and become committed to the principal terms of the lease. What is the significance of the inception date? It is the date when one can say that whether a lease contract contains a lease or not is identified. Second is commencement date. What do we mean by commencement date? Well, commencement date refers to the date when you start using the asset. You may pay the lease rent before or after that, it does not really matter, but commencement date refers to the date when you get the ability to direct the usage of the asset. So if you get the ability to direct the usage of the asset from July, but there is 1 or 2 months of rent-free period and you are starting to pay rent from September, your commencement date is July and not September. What is the significance of the commencement date? Well, commencement date refers to the date when you will start recognizing the right of use asset along with the lease liability. Second, we understand what is meant by the lease term. Lease term is the non-cancellable period in the lease plus the renewal period or the period covered by cancellation, provided it is reasonably certain that the renewal will be exercised or the termination will not happen. So if there's 5 years non-cancellable plus 5 years renewable, 5 years which is non-cancellable will be a part of the lease term, but for the last 5 years you will see whether the lessee has an economic incentive to renew or an economic incentive to continue, that is not to terminate. In such a case, if the facts of the case show that the lessee has an economic incentive to continue, then the renewal term will also be considered to be a part of the lease term. So your non-cancellable period plus the renewal period together will be considered to be a part of the lease term. Okay. Next, you have lease payments. What all will be a part of lease payments? The fixed lease payments will definitely be a part of lease payments, which include the in substance fixed lease payment. That is, it might be appearing variable, but in substance they are fixed, minus lease incentives if any. So if the lessor is paying anything to the lessee, then the lease incentives will be subtracted. Variable lease payments will be included only if they are linked to a rate like the inflation rate or LIBOR, or an index like a CPI index. All other variable payments like if they are linked to sales or output or production, will not be a part of the lease liability determination. If you are paying rent, which is variable in nature, so it is based on the quantity that you are selling, then at the end of the year, once the quantity has been sold, you can show a variable lease payment as an expense in the P&L. It will not affect the lease liability determination. However, if the variable lease payment is linked to a rate, like an interest rate or an inflation rate, or an index, like again an inflation index or an interest index, then and only then you can include that in the lease payments and the lease liability working. Next, you have purchase options. So if there is payments that you are making under the purchase options, that should be considered. Or if there is a payment which is being made under or if there's a payment which is being made for termination and you are reasonably certain that the termination is going to happen, then all of these are going to be taken as a part of this payment. So payments for purchase options, if you are reasonably certain that the purchase is going to happen at the end of the lease term, or payment for termination, if it is reasonably certain that the termination is going to happen, will be considered. At the end, there is a residual value guarantee. So if there's a specific guarantee for paying a particular amount, a one-time payment, it has to be included in the lease payments. Next, you have a few other terms like initial direct cost, as well as the interest rate implicit in the lease, or also called as the discount rate. Initial direct cost is the cost which has to be incurred, let us say for example over here, by the lessee, which is directly attributable because you are entering into lease, like the registration fees or brokerage, which you will not incur if the lease does not happen. Next, you have the discount rate, which is the interest rate implicit in the lease, which as a first preference should be the IRR. If it is determinable, IRR of the lessor. If it is determinable, you are in the books of the lessee, but if you can determine the IRR of the lessor, which you can in certain cases like hire purchase, then you can take the interest rate implicit in the lease as the lessor's IRR. But if that is not available, then you take the lessee's incremental borrowing rate. So if you are unable to figure out what the lessor's IRR is, then you will take the lessee's incremental borrowing rate, and the lessee's incremental borrowing rate will be taken as a discount factor. So all of this will kind of culminate into accounting. And how should you account for lease? Well, it depends on whether you classify the lease as a short-term lease or a lease of low value item, in which case a specific rule will apply, and in all other cases some other rules will apply. So the general principle over here is, unless you are a short-term lease or a lease of a low value item, you will have to recognize the right of use asset as well as the lease liability. At what value will you recognize it? Well, the lease liability is recognized as the present value of all the future lease payments over the lease term. So lease term, if it includes a renewal period, you can also take that. Lease payments, if it includes a purchase option or variable lease payments linked to index, you will also take that. And the discount rate will be either the lessor's IRR or the lessee's incremental borrowing rate. So the present value of these will give you the lease liability, and this lease liability should be recognized. So that will be credited. Corresponding to that, you will recognize what you call as the right of use or ROU asset. The ROU asset over here is to be recognized at the lease liability plus or minus few adjustments, like plus initial direct cost, plus present value of site restoration if any along with the lease, plus or minus the payments that you have received or you have made prior to the commencement date. So that will give you the right of use asset. How does right of use asset subsequently change? Well, it will be depreciated over the lease term or the useful life of the asset, as a case may be. So if there's a purchase option and you are going to become the owner of the asset, then you will depreciate it over the entire life of the asset. However, if there's no purchase option or you are not going to use the asset beyond the lease term, in which case you will depreciate it over the lease term only. The ROU asset can also be tested for impairment, like you do test a regular asset for impairment. How will a lease liability change? Well, lease liability changes like on the basis of amortized cost working. So you will have the opening lease liability, to that you add the effective interest rate, the effective interest, subtract the coupon payments if any, and then you get the closing. So that is your lease liability workings. Now this is the workings that you have to do unless you are under a recognition exemption, that is, you are a short-term lease, that is, the lease term is less than 12 months, or you are a lease of a low value item. Now low value has not been defined. However, items like computers, laptops, printers, office equipment can be treated as low value, whereas items like cars, building, land, etc. will be treated as high value items. So unless given otherwise, we will not assume a particular item to be low value. If the lease is a short-term lease or lease of a low-value item, then you do not need to create a ROU asset and a corresponding lease liability. For example, if you were to go to Goa and take a bike on rent for 7 days, that does not really justify, I mean, that is also a lease. You are getting a right to use the bike. However, I mean, just for 7 days, it does not really make sense to create an ROU asset and a lease liability, and hence the standard says, okay, it's fine if it's a short-term lease, you may not create the lease liability and the corresponding right of use asset. Okay, in all other cases, you will have to create a right of use asset along with the lease liability. Now, this is the accounting in the books of the lessee. In certain cases, there can be a lease modification as well, or a lease remeasurement as well. What do you mean by a lease modification? If there is a change in the terms of the lease, we have to check whether there's a lease modification. That is, do the changes in the terms create a new right of use asset? So for example, you had a ground floor, now you take the first floor, that is, you are getting additional right of use, and is that at the standalone price of the first floor? If yes, the modification is treated to be a new lease. Like, you will not change the lease of the ground floor, you will let it account for as it is. For the first floor, you will now create a separate ROU asset with a separate lease liability at the standalone price. However, if one of the two conditions are not satisfied, that is, it's either not at the standalone price or there's no additional right of use, then the lease modification will not be treated as a separate lease. Instead, it will be treated as a modification of the existing lease. In which case, there are 6 circumstances which are possible. There can be increase in the lease rent or decrease in the lease rent, increase in the scope, that is area, or decrease in the scope, that is area, increase in the lease term or decrease in the lease term, which was not earlier agreed. If the lease, if one of these 6 are happening, you will have to adjust the lease liability and also correspondingly adjust the right of use asset. Usually, if there is, for example, an increase in the rent or an increase in area or increase in let us say the lease term, we treat it as if there is a new asset that is acquired, and hence it is like an addition. So your ROU asset will be debited, lease liability will be credited by the amount of the changes. However, if there is a decrease, for example, in scope or decrease in the lease term, it is like a derecognition. It is like a part of the asset being sold, in which case you will debit the lease liability, credit the ROU asset, but at the same time there will be a potential gain or loss as well, because there is a derecognition which is happening. So decrease in scope and decrease in lease term can get slightly complicated. In case there is no modification in the lease, so you have not changed any terms of the lease, however, because of events happening in the future, there are changes in either the lease term or lease payment. So for example, over here, you thought that renewal period will be exercised, now you think it will not be exercised. Or you thought purchase option will be exercised, now you think it will not be exercised. You thought that there will be a particular variable payment, now the variability is no longer there, so it becomes a fixed payment. All of these are changes which are called as remeasurements. So in case of remeasurements also, you have to find the lease liability, the revised lease liability, compare it with the original lease liability, the difference of the two you will adjust, and the corresponding effect will go to the ROU asset. For lease modifications, you always have to take the date which the discount rate as a rate which is prevailing on the date when the modification happens. Whereas in case of lease remeasurements, in case the remeasurement is happening due to a purchase option estimate change or a lease term estimate change, in these two cases, you will take the revised rate as on the date of modification. However, if it is due to other factors like changes in the residual value guarantee amount or changes due to the in substance fixed lease payment, etc., then you will continue with the original rate. A point which is specific to COVID-19 over here is that if there is a modification which is done by the lessor and the lessee due to COVID-19, 4 specific pointers are given. In such a case, you will not kind of take the revised rate, you will not adjust the ROU asset, you will take the original rate only, you will adjust the lease liability and take the effect directly in the P&L. What are those 4 points? First, the lease changes should be a direct consequence of COVID-19. Second, there should be no increase in the lease rent, that is, the lease rent can be reduced or it can remain substantially the same, like it can be deferred, that is, it is remaining substantially the same, but it should not increase overall. And third, the lease concessions should not extend beyond 30th of June 2022. Last, there should be no other substantive changes in the lease. If these 4 conditions are fulfilled, then you will adjust the lease liability, and then instead of adjusting the ROU asset, you can directly take the effect, the one-time effect in the profit and loss account. You will not really adjust the ROU asset. You don't even need to find the revised rate, etc. That is only for COVID-19 in the books of lessee. All of these are accountings in the books of lessee. In the books of lessor, the concept of finance and operating lease is retained. If you go to see in the books of lessee, we have not discussed anything regarding the finance or operating lease, but in the books of the lessor, the concept of operating and finance lease remains. So what is a finance lease? Well, it is a lease where substantially all risks and rewards which are incidental to the ownership are transferred to the lessee. When can we say that there's a finance lease? Well, if the ownership is transferred, like hire purchase, or there's an option to transfer ownership at a very low or a concessional price, or if the lease term covers a major part of the economic life, that is more than 75%, or if the present value of minimum lease payments substantially cover the fair market value, that is more than 90%, or the lease of a highly specialized nature which cannot be used by any other entity. In which case we treat it as a finance lease in the books of the lessor. In all other cases, it is treated as an operating lease. If a particular transaction is treated as a finance lease in the books of the lessor, you will derecognize the asset and create a lease receivable. This lease receivable is created at the net investment amount. Net investment is calculated as the present value of gross investment, and gross investment is the minimum lease payments plus the unguaranteed residual value as well. Unguaranteed residual value typically is the expected residual value minus the guaranteed residual value. Over here, you will take the present value of this gross investment to find the net investment. A term over here which can also come sometimes is what is unearned finance income. The difference between gross investment and net investment is considered to be the unearned finance income. In the subsequent accounting for the lessor, there is no asset, so there will be no depreciation. However, there is a lease receivable. So lease receivable is like a financial asset, which you account for using amortized cost. So you will add the effective interest and subtract the payments or the receipts that you have received, and you will keep on showing the lease receivable. In case there is an operating lease, then you will not derecognize the asset. It will continue to remain with you. On the other hand, you will show the rental income that you have received as an income. So your entry in each subsequent year will be bank account debit to rental income, and this rental income will go to the profit and loss account on a straight line basis unless any other systematic basis is more clear. Depreciation will continue if applicable, because the asset is no longer derecognized in the books of the lessor. It is continued to be recognized in the books of the lessor. So this broadly takes care of the accounting for the books of the lessor. A few special cases like sublease. In case of sublease, an intermediate entity which is taking an asset on lease and then subleasing it to someone acts as a lessor also and lessee also. He acts as a lessee because he takes the asset on rent, and he acts as a lessor because he subleases it down. So how will the accounting happen? Well, the accounting will happen when he is a lessee. When he takes the asset on rent, he will create a ROU asset and a corresponding lease liability. When he subleases it down, he will see whether the sublease is for a major part, and the major part over here is compared with the lease term. So for example, if the asset is 40 years, you have taken it on lease for 5 years and you sublease it down for 4 years, in which case you have a right of use for 5 years, out of which you have subleased it for 4 years. Is that a major part of the life? Yes. You compare 4 with 5 and consider this to be a major part of the life, and hence the sublease is treated as a finance lease. On the other hand, if the sublease is only for 1 or 2 years, then you are not subleasing it for the major part, in which case the sublease over here will be taken as an operating lease. Okay. A very important case over here is the case of sale and lease back. So when we look at sale and lease back, there's an entity which is selling the goods and then leasing it back immediately. What does the standard mention over here? Well, in case the control of the goods has been transferred, then you will recognize the sale and the gain on the sale, and the lease back you will recognize the right of use asset. If the control is not transferred, then it is more like a loan transaction, not even a sale transaction. So when you own an asset and you are selling it, ideally there will be a gain on sale, but at the same time there is a lease back, and hence you are having a right of use asset. So over here the asset is not fully sold, it is not fully derecognized. It is just sold or derecognized to the extent of the rights that it is given up, because you are the owner, so you had the absolute rights earlier. Now you have given up a few rights, but you still have the rights of use. So in such cases, The standard over here requires you to find the present value of the dedicated lease payments which are towards the lease. The present value of these dedicated lease payments will be compared with the fair value. So for example, the fair value of the asset today is 30 lakhs and the present value of the dedicated lease payments is 15 lakhs. In which case we will say that, well, that means for an asset which is worth 30, we are agreeing to pay 15 in today's terms, and hence 50% of the rights are retained. So whatever is the carrying value today, uska 50% you should continue to show. The remaining 50% you can derecognize and create a gain or loss on this derecognition as well. While doing all of this, at the beginning you have to see whether the sale and leaseback is at market terms or off market terms. So how will you determine that? Well, usually you compare the selling price with the fair value. So if selling price is greater than fair value, you are getting more money now than what is fair. So the standard over here believes that there must be a hidden loan for the excess element, or if the selling price is less than the fair value, in which case you are paying less, and that may be because the remainder, the gap, is due to some prepaid rent. So rather than you getting the full value and then paying a rent advance, you are paying the net amount only. So you will have to account for this hidden loan or the prepaid rent in the manner prescribed. Okay, that largely takes care of the sale and leaseback part as well. There are a few other things like transitionary effects which are not really important, at least in the current scenario, because the standard is already 2 or 3 years old. There is a full retrospective, a modified retrospective 1, modified retrospective 2, various approaches which are given for transition. So that largely takes care of the standard on lease. Next you will go to the business combination standard. So business combination has to be viewed along with consolidation. So when we look at business combination, this is covered by Ind AS 103. Now what is business combination? Business combination refers to the acquisition of control over a business. So there are 2 essential ingredients over here. First is business, second is control. So what is business? Business is considered to be a set of integrated activities whereby an entity uses inputs, through a process generates outputs. What are inputs? Inputs can be something like skilled labor, assets, etc. Processes can be like operating manuals, skilled workforce which are capable, who know what is to be done, operating value in such a way that they are generating output, or like a startup who have the ability to generate output. So what is the essence of business? Processes, to be honest, is the essence of business. The standard over here had got some amendment where a few points were taken in order to determine whether a particular set of activities is business or not. So there was a concentration test. What do you mean by concentration test? If what you are paying is concentrated in a single group of assets, then it is more like an asset acquisition and not a business acquisition. However, when you acquire business, you get a group of assets and not just a single asset, then it may be a business combination, provided there exists processes. That is, there are inputs as well as workforce, in skilled workforce or critical processes in place, in which case there is a business. However, if there are, loosely speaking, there are no inputs or no processes in place, in which case we say that it is still an asset acquisition, not a business purchase. Like a radio station which is there, which is stopped operations. If you acquire that radio station, you would have no processes, you just have a few equipments and buildings. So that is like an asset purchase and not a business purchase. But if you operate a running radio station where you acquire the radio station which is operating, people know how to operate, the skilled workforce in place, that is like a business acquisition. And if it is a business, it will be covered under Ind AS 103. However, if you just acquire a 2, 3, 5% stake in a company that is a business, will that be a business purchase? No. You have to acquire control over a business, and control refers to the ability to direct the relevant activities. Control refers to the ability to direct the relevant activities. And how do we get that ability to direct relevant activities? Now this is defined under Ind AS 110 on consolidation. We'll be discussing it now. It is defined under Ind AS 110. Control is obtained when an entity over here, so this is business and all of this assessment in business, all of this is there in your study materials. So I'm not really, you don't really, I mean, you can go to the ICI study material and all of these are charts directly from the institute study material only. So when we look at control, what are the essential ingredients of control? We will do that in consolidation, but the essential ingredients of control is that you should have the power to direct the relevant activities. Power comes from substantive rights that you might have, like more than 50% stake, to direct the relevant activities, the important activities which affect the return. Second, there has to be exposure to variable returns. So lenders cannot be said to have power because lenders are not exposed to variable returns, they are exposed to fixed returns, and there has to be a linkage between power and the variable returns. Like a CEO may have the ability to direct the activities in certain cases, but that is derived ability through its employment contract. He is not acting as a principal, in fact he is acting on behalf of the shareholders, so his power is derived power, not his own power. However, shareholders are considered to have absolute power, so there has to be linkage between power and the variable return. So you should be getting power through your ownership, in which case we are said to have control. Loosely speaking, from a student standpoint, if there is more than 50% stake, we can be said to have control, and if you have control over a business, then there is a business combination. If there's business combination, Ind AS 103 will apply in the SFS as well as the CFS in case there is amalgamation, absorption, etc. when the selling company closes. Or if there is a consolidation, that is you acquire stake in a subsidiary, let's say 80% stake, then in the standalone books it is like an investment purchase, but in the consolidated books it is like a business purchase. So over here, in case of Ind AS 103, when we acquire control over a business in the consolidated financial statements, let us say if there's a subsidiary relationship, 103 will apply. So if Ind AS 103 applies, what will happen? Well, before we proceed, there are scope exclusions. That is, if there are pure asset purchases, 103 will not apply. There has to be business. And second, if there's a joint control or a joint venture, again Ind AS 103 will not apply. Ind AS 111, which is on joint arrangements, will apply in such cases. So over here, if there is a business combination, what will happen? Well, unless we show that this is a common control combination, other business combinations will be accounted for using the acquisition method. And what are the main steps in the acquisition method? There are 6 steps. First, you have to identify the acquirer. Typically, acquirer is a person who pays the PC, but that is not necessarily the case. There may be certain reverse acquisition cases, and hence the acquirer is considered to be the group of the shareholders who acquire control over a business. That is what you call as an acquirer. In case there's a reverse acquisition, the group of shareholders who ultimately acquire control is considered to be the acquirer. Second is the acquisition date. Acquisition date refers to the date when control is acquired. What is acquisition date? Well, the date when control is acquired, that is, you get the ability to direct the relevant activities. There may be a lot of dates, like the date when offer was given, date when board of directors accepted, date when shareholders accepted, date when money was paid. Basically, the date when you get control over the board, the date when you get ownership of the shares, this is the date when you get the ability to direct the relevant activities, and hence this is the date when we say that the control is acquired. So that is considered to be the relevant date for a business combination in case of acquisition. Sometimes there is step-up acquisition, like you might acquire 20% stake, then another 15% stake, then another 30% stake, then another 15% stake. Basically, the date when you acquire control over a business. So at 20 you don't have, at another 15, that is 35 you don't have, at another 30, 35 plus 30, that is at 65% you get control. So the date when you get control, that is when you acquire, let us say that 65% stake, that is when Ind AS 103 will apply, not on the other dates. That is the second point, that is the acquisition date. The third point is purchase consideration. Purchase consideration refers to the payment that you make to the owners of the selling company, not necessarily the shareholders. Usually the shareholders are considered to be the owners, but that is not necessarily the case. Like equity shareholders can be owners, preference shareholders may not be owners. So payment that you are making to owners, for example, the equity shareholders will be considered as let us say the PC. Apart from that, there may be other owners as well, like for example ESOP owners. They are also classified as within other equity, and hence payments which are made for ESOPs can also be taken within a part of let us say PC. So payment that you are making to the owners is considered to be a part of purchase consideration, that is PC. Now what all variations can happen. So at what value will you recognize PC? Well, you will recognize PC at the fair value of the consideration that you are paying. So whatever is the fair value of the consideration paid is considered to be PC. Sir, what percentage of acquisition is generally considered for control? Well, as per Ind AS, no percentage has been defined. As per Ind AS, the moment you get the ability to direct the relevant activities, you get control. In certain companies, if you have a 45% stake and the remaining stake is held by hundreds and thousands of shareholders, there is still control. However, in certain cases, when we look at companies, control will exist if there is greater than 50% stake. If nothing is given in the question, from a student standpoint, greater than 50 is said to be control. Okay, so when we are looking at purchase consideration is to be determined at fair value. This can be fair value of let us say the shares issued, or the fair value of debentures or preference shares or equity shares, whatever. The fair value of the consideration that you are paying is taken to be PC. You can even pay cash. Now this is standard items. The special cases over here can be deferred consideration, which is you are acquiring the business now, but the payment is going to be made after, let's say, 2 or 3 years. In such a case, you will try to find the present value of the deferred consideration and include that in the PC. Or contingent consideration, that is, payment is going to be made in the future, but that is dependent or contingent upon some future factors which we don't know how they will shape up. So in the current scenario, you will recognize it at fair value, considering all the probabilities, all the possibilities. So contingent consideration should be a part of PC at the fair value. Deferred consideration should be a part of PC at the present value. Lastly, you have share-based payments. So in case there are replacement awards, that is, if Tata has acquired a controlling stake in Jaguar and Land Rover, JLR's employees have some ESOPs. So let us say the vesting period was 5 years and 2 years have already gone by, in which case if Tata Motors acquires that ESOP scheme and in return issues its own ESOPs, that is called as replacement awards, in which case the new ESOPs that you are issuing should also be a part of PC. But the part of this new ESOP fair value is attributable to service already rendered, but a part of it will be attributable to service which is going to be rendered by these employees to the combined entity, and hence you will have to allocate this fair value of the replacement award. So the fair value of the original awards on the modification date into the vesting period served, in our example 2, upon the longer of the original vesting period, that is 5 years, or the revised vesting period. Let us say 2 years was already there plus another 2 years, that is 4. So the longer of the two will be taken as the pre-combination attribution. So if the fair value of the original award was 50, then 50 into 2 by 5, that is 20 rupees, will be attributable to the pre-combination element, which will be a part of PC. Let us say on replacement you are paying new awards which are worth 60 instead of 50, then 60 minus, let us say 20, which was attributable to pre-combination element, will be the post-combination awards, and this 20 which is there in the post-combination will be attributable over the remaining vesting period. Okay, so this is about purchase consideration. Purchase consideration is to be determined at the fair value. Next you go to net assets. Net assets are to be taken over again at the fair value. You will take over 100% of the net assets because you acquire control. This is irrespective of the percentage stake acquired. Even in case of net asset, there are a few special cases, like what about contingent liabilities or indemnification assets or in process research and development or customer rights, etc., which are not appearing in the books of the selling company. Should you consider them as a part of the net assets taken over? Yes. If a separate fair value is attributable, then these contingent liabilities or in process research and development or customer rights, etc., should be recorded at the fair value as a part of the net assets. While determining the net assets, you should also check for a tax rate. So if a tax rate is given in the question and the book values and fair values of these assets are given, then on the net assets that you are taking over, you will have to calculate deferred tax. So if the net assets carrying value is greater, carrying value meaning the fair value as per Ind AS 103, if that is greater than the tax base, that is let us say the carrying value in the older books, then there is a deferred tax impact. It will be a deferred tax liability. If it is the other way around, it may be a deferred tax asset, but you have to see that. a lot of adjustments come for deferred tax along with business combination. But net assets are to be taken over at 100% based on the fair value as on the date of acquisition, irrespective of the stake that you acquire. Now this creates a problem because your PC may be for an 80% stake, however you have taken over 100% of the net assets. Then the remaining 20% is attributable to what you call as non-controlling interest or NCI. Now when we look at the NCI, at what value should you measure the NCI? Well, two methods are possible. First, you can measure the NCI at the fair value, or you can measure the NCI using the proportionate net assets method. So when we measure the NCI, let us say at fair value, then this NCI over here, which is measured at the fair value, will be the fair value of the shares that are held by NCI. So if there are 100 shares in the selling company, 80% have been acquired, 20% have not. So this is 20 shares into the market price of these shares. So that is a fair market value of the NCI, or it can be calculated using the proportionate net assets method, where you don't look at the market price of NCI. Instead, you look at the net assets, the fair value of net assets, that into the NCI percentage will give you in such a case give you the NCI. Both methods are possible. In case you show the NCI at fair market value, then the goodwill that you get will be the full goodwill, whereas if you decide to show the NCI at proportionate net assets method, then the goodwill that you get will be the partial goodwill. How do we calculate goodwill? Well, goodwill is calculated as a purchase consideration, let us say for an 80% stake, plus a non-controlling interest, let us say for a 20% stake, minus the net assets of 100%. If the difference comes to be positive, it is goodwill. If the difference comes to be negative, then the standard says that this is extremely rare. Why would someone sell the business at a value which is lower than the net assets? And hence you might have made a mistake. So it requires you to reassess the PC, the NCI, the net assets, everything. If even after the reassessment the number comes to be negative, then you will show this depending on whether there were reasons due to which such a change has happened or not. So if there are reasons, so for example, in the earlier day, a few years back, let's say the US banned TikTok, and it said that TikTok has to be sold to a US party within, let's say, 30 or 60 days. Now TikTok will be under distress to sell within 30 or 60 days, in which case it is possible that the buyer might be acquiring TikTok under distress, and hence there is a gain. So that is called as a gain on bargain purchase, which will be shown as a part of other comprehensive income, that is OCI. Gain on bargain purchase as a part of other comprehensive income, OCI. It is at the end of the day accumulated inside a capital reserve, but it is shown as a part of gain on bargain purchase. However, if there are no reasons attributable because of which you are getting this at a lower price, then you are going to credit the capital reserve. You will not credit the gain on bargain purchase, you will credit the capital reserve directly. Okay, so these are the 6 steps in case of acquisition method. A few other cases are also provided, like what if there is a composite purchase consideration. When we say, so we have charts over here from the institute for share-based payments, for contingent consideration, for net assets, etc. So what are the special cases? Well, sometimes it might happen that you are paying a composite consideration, like you are acquiring a business, and along with that acquisition you are settling an existing, let's say, non-contractual relationship like a lawsuit, or a contractual relationship like an existing license, or you are creating a new relationship like you are requiring a founder, director to continue for a specified number of years. The standard over here says that these composite values will loosely be recognized as their separate fair values, and they have to be separated out from the purchase consideration. They will not be a part of purchase consideration. If you are paying 1 crore and out of that 10 lakhs is attributable to an ongoing lawsuit, then 90 lakhs is for the business, the 10 lakhs is to be taken for the lawsuit. Aja, this is broadly about business combination. Then we have something called as a common control combination, which is covered under an appendix to Ind AS. So what do you mean by common control combination? Common control refers to a situation where the controlling shareholders, both before as well as after the acquisition, continue to remain the same. That is when we say that there is a common control, and this common control is not temporary, it is not transitory. If there is a common control, then the accounting will be done using the pooling of interest method, and under the pooling of interest method, all assets and all liabilities are to be taken over at their book values. No new assets or liabilities are to be created. Secondly, the purchase consideration over here will be settled in the form of shares only. There will be no other purchase consideration mechanism. The securities issued will also be at the issue price, that is the book value. We will not look at the fair value because the assets and liabilities are also taken over at the book value, so the shares issued are also to be taken at book values. A very important consideration over here is that you will also take over the reserves. In the usual acquisition method, we do not take over reserves, but here we will take over the reserves. In case of a common control combination, reserves are taken over, except in case of demerger, they are not taken over. In all other cases, these reserves will be taken over. Now, the difference between purchase consideration and the net assets taken over usually is taken under goodwill or gain on bargain purchase. But the common control combination is more of a restructuring. It is not really an acquisition of control of someone else's business. You continue to remain in control of the business which you were earlier controlling as well, and hence the difference between the PC and net assets, in case it arises, cannot be taken as goodwill because you cannot create a goodwill on transacting with your own self. However, it will be accounted for using the reserves. So over here you will create a separate account called as capital reserve on restructuring, and whatever is a gain or loss will be adjusted in the capital reserve on the restructuring in case the PC differs from the net assets. At the end, there is demerger. Demerger, you will have to study how the demerger happens. So in one of the cases, a division is demerged into a new company and the new company issues shares to the selling company, in which case the new company becomes a wholly owned subsidiary of the selling company, in which case this is like a common control combination because the business of the selling company, which was earlier controlled by the purchasing company directly, now through a subsidiary is also controlled, and hence it is a common control combination. However, if the company puts a separate division and this division issues shares to the shareholders of the selling company, then you will have to see if there were any controlling shareholders in the selling company. So in the selling company, if there was a shareholder who held 90% stake, then 90% of the shares in the new company will also go to that same controlling shareholder, and as a result over here both of these entities are going to be controlled by the same person or entity, and hence there is still a common control combination. However, in case there are hundreds and thousands and lakhs of shareholders, none of them holding even a 5% stake, then when you issue shares to these shareholders, that is not going to give them any control, because if they don't have control in the first company, they will not even have control in the second company. If there's no control, there's no question of a common control. In case there is a demerger, then you will take over all assets and all liabilities in the books of the purchasing company at book values if it is a common control combination, at fair values if it is a business combination. In case of common control combination, balancing figure if any will be going to the capital reserve, however on restructuring. However, in case of business combination, the balancing figure if any will go to either the goodwill or to the capital reserve or to the gain on bargain purchase. So this is some detailing which is pertaining to demerger. Now, apart from that, the standard might also require you to do certain workings for reverse acquisition. So what happens in case of a reverse acquisition? You will first have to identify the acquirer, which is the reverse acquirer. Second, you have to determine PC. PC in case of normal acquisition is payment which is made to the owners of the selling company. However, in the reverse acquisition, what appears as a selling company legally is actually the acquiring company, whereas what acquires as the acquiring company legally is what is the selling company. So PC refers to the payment which is made to the owners of the acquiring company based on the legal acquirer. Legal acquirer is the accounting acquirer. So you have to be careful in the PC determination. Similarly, the net assets are the net assets of the accounting acquirer which are being acquired, and hence goodwill is calculated accordingly. While you prepare the consolidated balance sheet, you have to remember that the consolidated balance sheet is prepared in the name of the parent. However, it is showing continuing financial statements of the legal subsidiary. So the accounting acquirer, it is as if the accounting acquirer continues. All the reserves of the accounting acquirer, let us say, will continue. So that takes care of business combination. Next, you have consolidation for a subsidiary. Now, consolidation is a standard which is an extension of the business combination standard. So different professors or different people have different method to solve consolidation. As long as you're getting the same ultimate answer, it should not really have a problem ideally. So consolidation is covered for subsidiaries under Ind AS 110, joint operations under Ind AS 111, and joint ventures as well as associates under Ind AS 28. So when we look at subsidiaries, there is a full consolidation method that is suggested. For joint operations, proportionate consolidation method, and for joint ventures as well as equity, as well as investments having significant influence, an equity method is to be followed. First, we'll do the full consolidation method, which is applicable for subsidiaries. Consolidated financial statements are mandatory as per the Companies Act as well as per Ind AS, so you will have to prepare them. So we will have to prepare these consolidated financial statements. Now, under the consolidated financial statements, what do we have to do? Well, under the consolidated financial statements, you will consolidate all assets, all liabilities 100%. Irrespective of the stake that you have, 100% consolidation will happen. And because you have an 80% stake and you are consolidating 100%, for the remaining 20%, you will create a non-controlling interest. Non-controlling interest will appear as a part of equity, as a separate disclosure, a separate line item within equity. The non-controlling interest will appear. Next, you look at goodwill. Now, when you consolidate, in the separate financial statements of the parent, there will be investment in the subsidiary, and in the subsidiary's financial, there will be equity share capital and reserves. The standard over here mentions that the investment in subsidiary will be eliminated against the parent's share in the equity share capital as well as pre-acquisition reserves of the subsidiary. So this will help us in creating goodwill. And what will happen to the post-acquisition profits? Well, the parent's share in the post-acquisition profits will be consolidated in the consolidated P&L. The NCI share will be added to the NCI, and pre-acquisition profits are to be eliminated. Remember, when let us say you acquire a company, let us say in 2015, the profits up to 2015 are actually purchased by you. They are not earned by you under your control, they are purchased by you, for which you must have paid a PC, and hence they are kind of eliminated. Whereas the profits after 2015, that is your date of acquisition, are earned under your control and hence they should be consolidated. So, considering these main principles, 100% consolidation for assets, NCI to be created either using the proportionate net assets or fair value method. From the separate financial statements, the investment in the subsidiary needs to be eliminated against the parent share in the share capital as well as the pre-acquisition reserves, and the balancing figure will show the goodwill or capital reserve, and the post-acquisition profits will be consolidated based on the share, both in the consolidated P&L as well as in the NCI. Okay, so what should be the steps that you should ideally follow in a consolidation process? Again, different people have different steps. I would recommend you follow your steps. If you are comfortable, then you can follow these steps. Otherwise, you can follow the steps which you are most comfortable with. First, you will prepare the format, the skeleton of the Schedule 3 balance sheet. You will keep the numbers missing, but you will prepare the entire format of the Schedule 3. Next, you will prepare the consolidation notes. When you prepare consolidation notes, you will write down each asset, each liability of the parents and the subsidiaries. You will keep some space for the adjustments, and you will write all assets, all liabilities which are appearing in the parent as well as subsidiaries books, except for equity share capital of the parent and subsidiary, and reserves of the parent and subsidiary, and investment in subsidiary. Except for these three items, everything will be written. Then you show the equity capital, which is the equity capital of the parent, and then you prepare, that is the second step. Now you prepare the third step, where you prepare three very important working notes which are really important from an exam standpoint. First, the consolidated reserves or the consolidated other equity section. Over here, you start with the standalone parent. Write that number and leave around 8 to 10 lines. Next, you go to the cost of control or the statement for calculation of goodwill. Here, you start with the cost of the investment and the parent's share in the subsidiary's equity share capital. So, if I've paid 100 rupees for an 80% stake, so 100 is the cost of investment. Against that, you get a share in the parent's subsidiary's net assets or net worth. So let us say 80% of the share capital of the subsidiary. The remaining 20% is attributable to the NCI. So leave around 8 to 10 lines and then prepare an NCI statement or an account where you show the share in NCI. So once you have done all of this, you have considered the parent's share capital in the note for equity share capital. You have considered subsidiary share capital in the note on goodwill as well as NCI, and you have considered investment. So there were, I think, 5 items which are missing. Parent's capital, which is now considered, subsidiary's capital, which is now considered, parent's reserves, which are considered as a starting point, and lastly, subsidiary's reserves, which are not yet considered, and investment in subsidiary, which is also considered. for goodwill calculation. So the only thing that you're left remaining with in step 4 is the analysis of reserves and the adjusting entries for the adjustments given. When you do analysis of reserves, analysis means that whatever are the reserves, you attribute it between pre and post and then between parent and non-controlling interest. How do you attribute it between pre and post? Well, you can start with the balance which is available as on the date of acquisition. To that you can add the profits which are earned post acquisition less dividends which are paid if any, and hence that will give you the balance of the retained earnings which is shown in the income statement. That balance, based on the adjustments, you might be said that this balance is 1000, out of which 400 existed as on the date of acquisition, so the remaining 600 is post acquisition. So that 1000 will be split 400 pre, 600 post. Now it might happen that there are certain adjustments which are given, like fair value adjustments. We'll do that. Upstream or downstream inventory adjustments or dividend adjustments. A lot of these adjustments are given. If they are given, we'll give effect to that first. If nothing is given, we will directly take this 600 and 400 and then attribute it to parent and NCA. Where will these numbers go? Well, the parent share in the pre-acquisition profits will go to working note 2, that is the goodwill working. The NCI share in the pre-acquisition profit will go to the NCI. Next, the parent share in the post-acquisition profits will go to working note 1, that is a consolidated P&L, whereas the parent share or the NCI share will go to the NCI. Once this is done, you have given effect to the remaining reserves as well as the adjustments. What are the adjustments? We can study. Once that is done, you have given effect to everything. So you'll try to take the totals, give effect to any remaining adjustments, and then post everything in the schedule 3 balance sheet. So this is the process. Step number 1, prepare the schedule 3 balance sheet. Step number 2, prepare notes containing assets, liabilities and parent share capital. Step number 3, prepare working notes on consolidated reserves, on goodwill, on NCI. Step number 4, try to analyze the profits or the reserves between pre-acquisition and post-acquisition. Whatever is pre has to be subjected to adjustments, and then whatever is the amount will be transferred between parent and NCI. Again, what is post, transferred between parent and NCI after considering the adjustments. The pre-profits parent section goes to the goodwill working. The post-profits of the parent section goes to the consolidated reserves. Okay, we have discussed what control means. Then we will figure out what are these consolidation adjustments. So when we look at consolidation adjustments, negative non-controlling interest. Is it possible to have negative NCI? Yes. In the AS, you are not allowed to have negative minorities because minority interest was shown as a separate line item between shareholders' funds and liabilities. Liabilities cannot be negative, whereas owners' funds can be negative, like there can be a huge P&L debit balance. Now, since NCI is a part of equity because it has a residual interest, then NCI can be shown as a part of equity and it can have a debit balance as well. Fair value adjustments, which I would reckon are very, very important from an exam standpoint. So this is a case where as on date of acquisition, the land, for example, is 500, whereas in subsidiaries books, the land appears at 100. Now, merely because someone acquires a 100% stake in my company, I don't have to remeasure assets and liabilities. Subsidiary is a separate legal entity. It continues its legal operations and will continue showing land under the cost model at 100. In which case, what will you do with the remaining 400? Well, we will say that if you are paying 500 rupees as PC and 100 is the value of the asset, then the remaining 400 is goodwill. Is that correct? No. Are you paying the extra 400 because of the reputation? No. You are paying this 400 for the land, and hence that 400 has to be adjusted with the land. So 400 you debit. What will you credit? Well, you could have credited any reserve like a revaluation reserve, fair value reserve. Institute over here credits the P&L because ultimately this profit is a pre-acquisition profit. It has already arisen prior to or on the date of acquisition, and hence pre-acquisition profits have to be eliminated. So we take it directly in the P&L, the pre-period P&L, though it can also be shown separately under the revaluation or other fair value reserves. Once you take this land or building at 500, that is 100 plus 400, you also have to remember that subsequently depreciation should have been on that 500 in the CFS. However, in your SFS, you have taken depreciation based on 100 only, and hence for the remaining 400, that is a fair value adjustment, you have a subsequent adjustment that is 400, let us say the useful life is 10 years, then it is 40. And this 40 will be adjusted from the post-period profit and loss account. A similar fair value adjustment is also possible for inventory, is also possible for payables. Then you have goodwill adjustment. This you would have done probably in the impairment standard as well. So when we look at goodwill, goodwill can be partial goodwill, goodwill can be full goodwill. In case goodwill is impaired and that goodwill is partial goodwill, then typically you will write off the loss only against the parent because NCI does not have any share in the goodwill. However, if it is full goodwill, then you will write off the loss both against the parent as well as the non-controlling interest. Unrecognized profits on intergroup transactions. So when we look at intergroup transactions, there is debt P selling, let us say, goods to S, this is downstream, or S selling goods to P, which is upstream. So if on the balance sheet date, if goods worth 100 were sold at 120 and these goods remain unsold, then the inventory of the subsidiary will appear at 120 and the P&L of the parent will comprise of profits of 20. In which case, in the SFS that is correct, you can earn a profit by transacting with outsiders, let us say that is your subsidiary. But in your CFS, that is wrong because you can't earn a profit by transacting with your own self once you merge P&S, and hence, to the extent these goods have remained unsold in the books of the subsidiary, you will eliminate the inventory. Where will the second effect go? You will eliminate the inventory by 20 rupees. So inventory will be credited by 20. Where will the second effect go? Well, the second effect will go to the consolidated profit and loss account because this is on downstream transaction, and for downstream transaction, that is parent selling to subsidiary, the entire profit of 20 is in the books of the parent, not in the books of the subsidiary. On the other hand, if it is an upstream transaction, that is subsidiary had sold goods to the parent, in such a case, the profits will be in the books of the subsidiary and the profits of subsidiary belong both to the parent and the non-controlling interest, and as a result, you will adjust it while analyzing reserves. So while analyzing reserves, let us say your post-acquisition reserves are 600, to which you will adjust or deduct, as a case may be, accumulated depreciation in order to find the carrying values. Okay, so this is about goodwill adjustment. Unrealized profits on intercompany sales adjustment as well, which is downstream or upstream, sale of fixed assets or machinery. Uniform accounting policies. Well, if uniform accounting policies are not there, then we'll have to restate the financials of the subsidiary to bring it in line with the uniform accounting policies of the parent, and then consolidation can happen. Different reporting dates. Typically, the reporting date over here of an Indian company is 31st March. However, if you are a subsidiary of a foreign company and that foreign company, let us say, has a 31st December year ending, in which case, what do? Do you again prepare financials for 31st December, then again for 31st March? The standard says no. If the financials of your US subsidiary, for example, which you want to consolidate, US subsidiary has a 31st December year ending, you have a 31st March year ending. So if the financials of the US subsidiary are, let us say, anywhere within 3 months old, so from 1st January or 31st December onwards, then you can take the same numbers subjected to certain adjustments for material items like fire, flood, etc. However, if the gap is more than 3 months, then you will have to prepare your entire new balance sheet as on 31st March. You cannot take the old balance sheet after making just merely material adjustments. Intercompany elimination can be for items like debtors or creditors, bills payable, bills receivable. You will eliminate these bills receivable, bills payable, etc. Then you have intercompany loans, so that can be loans given, loans taken as well. Then we have the dividend adjustment. Now, the general rule for dividend is if it is paid out of the pre-acquisition profits, you have to adjust it. If it is paid out of the post-acquisition profits, you don't need to do any adjustments because the effects will automatically be considered. So if dividends are paid out of pre-acquisition profits, then we have to see what the parent has done. Typically, the parent would have credited it to the profit and loss account. Now, dividend paid out of pre-acquisition profits is nothing but distribution of pre-acquisition profits. These profits existed as on the date of acquisition, and hence while you find the goodwill, you have to take the share of the undistributed profits as on the date of acquisition, but you also have to take the share of the distributed profits as on the date of acquisition, and hence you will pass an adjusting effect where you will reduce the effect of the parent share in the consolidated dividend from the consolidated P&L, and second effect will go against goodwill. Like you add the share in pre-acquisition undistributed profits, you will also add the share in the pre-acquisition distributable profits. That will help you in calculating goodwill correctly. So these two adjustments, not uniform policies, I'm sorry, different reporting adjustments and dividend adjustment. are important from an exam standpoint. If there is bonus, it is not really important. You can just reverse the effect of bonus and then solve. If there's a stake sale, there are two possibilities. Stake sale can result in loss of control or no loss of control. If it results in a loss of control, then you will eliminate all the assets, all the liabilities attributable to the subsidiary, also the NCI, also the goodwill. And if some part of the investment is retained, let's say 15%, 20%, 25%, then for the part of the investment that is retained, you will create a separate investment account, and this investment will be either at the fair value or the proportionate net assets value. It will not be at new cost. It will be at the proportionate carrying value of the asset just a day before or the fair value. Acha. However, if there is no loss of control, then the assets and liabilities will not be derecognized. You earlier had a 100% stake, now you have an 80% stake. So for 20%, you will not derecognize the assets and liabilities. Instead, you will continue to show the assets and liabilities in the same manner. And for the 20%, you will create a non-controlling interest or NCI as the case may be. The balancing figure, if any, will directly go to other equity, not to the statement of P&L, not to goodwill, because it is an owner-to-owner transaction. Then you have additional stake purchase. In case of additional stake purchase as well, you will not create any new goodwill. In fact, if there is an additional stake purchase, then you will not even add it to the net assets because the net assets are already at 100%. Then what will you do? Well, you treat it as a purchase of NCI. So NCI will be debited and the net assets will be credited by whatever is your impairment amount. Chain holding question. So a couple of times the institute has asked chain holding. So what happens in chain holding is P having a subsidiary S1, having a subsidiary, let us say S2. In which case, let's say P has a 60% stake in S1 and S1 has an 80% stake in S2. Does P control S3? Well, it depends. So over here, what students will end up doing is that they will do 60 into 80. This is 48%. वो गलत है. Control is your ability to direct the relevant activities. With a 51% stake, can S1 direct S2 to act in a manner it desires? Well, yes, and hence S1 has control over S2. Now P has control over S1, and hence indirectly P also has control over S2. On the other hand, if, for example, the parent has a 60%, parent has a 60% stake, the subsidiary over here, let us say, has a 40% stake. In which case, does the subsidiary have control, or does the parent have control over the subsidiary? No. The parent in such cases does not have control over the subsidiary, in which case there will be no consolidation. However, in case when you look at, let us say 51% stake, still one can say parent does not have control. However, that is not necessary. So if you do 60%, then P can direct S1 to act in a manner that P decides, and because S1 has 51% stake, forget the arithmetic working. Since S1 has 51% stake, then 51% of S1 S2 is controlled by S1, and hence 100% of S2's assets have to be consolidated irrespective of the 51% stake held. In case of chain holding questions, it is very interesting to calculate NCI, especially for the final subsidiary. The NCI over here will be based on indirect stake. So the parent's effective stake or parent's share in the net assets. This is not taken for assessment of control, but parent's share in the net assets, for example, is 48%. However, NCI, that means if 100% are the assets and 48% is going to the parent, that means the remaining 52% is going to the non-controlling interest or NCI. So this is how you calculate NCI. Also, while preparing the goodwill, you generally take the cost of the investment. Investment appears in the books of the parent, you directly take the full cost. But if investment is appearing in the books of the NCI or in the books of S1, you have to remember that all assets of S1 are attributable both to the parent and NCI, and hence if there's 150 rupees appearing in the books of S1, then that 150 entirely cannot be taken for the parent for goodwill calculation. Out of that 150, 80% is attributable to the parent, 20% is attributable to the NCI. So what is attributable to parent will be taken for the goodwill working, but what is attributable to the NCI? Well, investment as a debit balance, NCI as a credit balance. So over here, if you were to eliminate the investment, you credit it, then what are you going to debit? Well, you're going to debit the NCI. And as a result, the NCI's share in investments will actually be eliminated and not appear in the final consolidated balance sheet. Apart from that, there are a few adjustments on, or a few cases on disclosure items like what is an investment entity, like a venture capital or a mutual fund whose main business is to invest in multiple entities. If you are a investment entity, remember, then you are allowed a choice to show these investments even if it is a subsidiary using FVTPL principles in the CFS. You may not do full consolidation because your investors don't really care about the assets and liabilities, they really care about the fair value. So you can show this at fair value for profit and loss account only for investment entities. Okay, so these adjustments you should be doing, especially the three adjustments that we have marked. That is a fair value adjustment, not the different reporting dates actually. The unrealized profits. This is upstream or downstream adjustment, and the dividend adjustment. These are the most important. It is almost certain that you will get an adjustment from these in your exams. Okay, so we will stop for a 5-minute breather over here, and after that we do joint arrangements. There is the big financial instruments, and then there is the share-based payment section. Okay, so we will stop for around 5 minutes, and in exactly 5 minutes we resume. Okay, so we'll go to the last lap of our revision. There is joint arrangements, joint ventures and associates. So this is covered under Ind AS 111 and Ind AS 28. So when you look at joint arrangements are made up of joint arrangements are arrangements which have joint control. And when we say joint control means either there is a requirement for a unanimous decision making for parties who are jointly controlling, and then there is collective control. So in case there is a joint arrangement, then you can either have a joint operation or a joint venture. What do you mean by a joint operation or a joint venture? Typically, when there is a separate legal entity in the middle, there is a joint venture. So if two parties are coming together, forming a company, and through that company doing business, that is a joint venture. However, if there's no separate entity in the middle, it is typically a joint operation. There are certain exceptions to the joint venture, but broadly you can remember this rule. How will the accounting happen? Well, in case of joint operation, the accounting will happen using the proportionate consolidation method. So you will proportionately consolidate all assets, all liabilities. That is the proportionate consolidation method. However, in case of joint venture, the accounting will happen using the equity method. Equity method is defined under Ind AS 28 and is to be used for joint ventures as well as for associates. Now, what are associates? Associates are companies over which an entity is supposed to have significant influence. And significant influence means participation in the policy making, representation on the board, etc. Significant influence is considered to exist at a 20 or greater than 20% stake, in which case we can say that there is a significant influence. And if there is a significant influence, then we can consider that that there is an associate relationship. And in the CFS, associate relationship has to be accounted for using the equity method. Now, this is an important method. What do we mean by an equity method? Well, the equity method over here refers to a situation. The equity method over here refers to a situation where you are measuring or valuing investments not based on their initial cost, not based on their fair value, however, based on how the business is performing. Like when we look at Ind AS 109 financial instruments, you typically recognize the assets and liabilities at their fair values. Fair value through profit and loss, fair value through other comprehensive income, but at fair values. Now, when Honda had a joint venture with Hero, it was never bothered with the market price that Hero Honda has. It was more interested in how many bikes it is selling, how much profit it is generating, and hence the true measure of these business investments is the performance of business and not the performance of the market price. And as a result, we do not consider the fair market value. We don't keep them at cost. In fact, we start them at cost and then add the share in the profits or share in the equity, which means what all goes in the equity. It can be profits, it can be other comprehensive income items, it can be any other reserves, anything which affects the other equity or equity share capital should be considered. So if I've acquired a 40% stake in a company by paying 400 rupees, subsequently this company earns 300 rupees. Now 300 rupees में से 40% मेरा है. So 300 to 40%, 120 should be added
into my investment irrespective of whether dividend is paid or not. Acha. So that means 400 I've invested and that investment yielded 120, let us say 120 for me, 300 into 40%. If dividend is paid, that will reduce the value of investment. It is like opening balance plus interest minus coupon paid. Whenever coupon is paid, you reduce your closing balance in amortized cost. In a similar way, when dividend is paid, that is like recovery of your investment here. And hence, if let us say 100 rupees is paid as dividend, 100 into 40% we are receiving, then we are saying that okay, 400 was our initial investment plus 120 based on the accrual of profits earned minus 40 that we have recovered, and hence whatever is the remaining is considered to be my carrying value. So the carrying value over here will be the carrying value of the investments, and the carrying value of the investments will be using the equity method, which is calculated as the initial cost of the investment plus share in the profits or share in the other equity or other comprehensive income items. All of these, whether it is FCTR, whether it is revaluation, all of these will be considered. So you will add the share of profits and reduce the share of dividends, if any, in the consolidated financial statements. Now, what will you do with goodwill? See, you are not eliminating the investment, you are just measuring it using a different method. You are not eliminating the investment, and as a result, goodwill to tabhi aata if you eliminate the investment and instead recognize the assets and liabilities. Here, assets and liabilities are not taken over. You don't take over the assets and liabilities of the associate or the joint venture, you just show the investment but using a different method. So if assets and liabilities are not taken over, goodwill cannot be created as a separate line item in your ledger. However, it may be the case that you have actually paid a premium and that premium is a part of your investment value. So the company that you have acquired had net assets of only 700. So ideally you should have paid 700 into 40%, that is 280. However, you ended up paying 400. So that 120 that you extra paid, which is a part of investment, which is actually attributable to goodwill. So what you have to do is you have to identify and disclose the goodwill. So you will show the cost of investment, let us say 400 into bracket including goodwill of 120. You are not going to separately show goodwill as a separate line item. You will just show a disclosure. You will identify and disclose the goodwill under the equity method. After that, you will add the share in the post-acquisition profits minus the share in dividend if any. Now, a couple of points that needs to be discussed is if there are losses, well, the accounting for losses is going to be the same as that of profits. Like if there were profits, you add the share in post-acquisition profits. If there are losses, you will reduce the share of the post-acquisition losses from your investments. You have to ensure that the value of your investments cannot become negative. I mean, if there are losses, it will reduce the value of the investment, but your investment value cannot become negative. It will go down to zero at best. It cannot become negative. What if there are intercompany items? Like intercompany debtors and creditors. If there's parent and in the books of the parent, the associate is a creditor. In the associate's books, the parent is a debtor. Will we eliminate these intercompany items? The answer is no. So we used to do that for subsidiary. Yes, we used to do that for subsidiary because the assets and liabilities of the subsidiary were taken over. So in the consolidated books, at one place you will see the debtors, in one place you will see the creditors, and hence you will eliminate them. Here, the assets and liabilities of associate are not taken over. Yes, in your books, the associate is probably a creditor, but associate's assets and liabilities are not taken over. And as a result, you will not do any intercompany elimination for intercompany debtors, creditors, bills, etc. If we look at, let us say, unrealized profit on upstream or downstream inventory adjustments, well, one can say that we do not take over assets and liabilities, yes, but we do take over profits and we do take over our share of profits, and hence, as per the institute's recent study material, what you will do is, whether it is upstream or it is downstream, you will have to eliminate your share of profit. So if there's an intercompany transaction on account of which 10 rupees of profit is generated, 10 mein se aapka 40% share, so 4 has to be eliminated, so profits will be debited by 4. The problem is what will be credited. Well, if it is a downstream transaction, then what is happening is the profits are in the books of the parent and the investment of the inventory of the associate is overstated. Inventory of the associate is not taken over and hence you cannot credit the inventory. Instead, you will say that the carrying value of the associate will have effect of all the net assets, net worth of the associate, and hence you will consider the investments. Your entry will be profit and loss account debit to, let us say, investment in associate. On the other hand, if it is upstream, the profits are in the associate. However, that has an impact on the inventory of the parent, and as per ICI's recent study material of May 21,
they have adjusted it against the value of the inventory, because inventory of the parent appears in the CFS, so you adjust that unrealized profit in through the inventory, and I would suggest you follow the same treatment as well. So that is largely about the equity method and joint ventures. The next part that you go to is the all important financial instrument standard, which is Ind AS 109. Now, when we look at financial instruments, what are financial instruments? Well, financial instruments refer to contracts, or financial instruments are basically instruments which create a financial asset for one entity and a financial liability or equity for the other entity. So we need to understand, what do we mean by financial asset, what do we mean by financial liability, what do we mean by equity? Well, financial assets refer to assets which can be cash, which can be equity investments in another entity, which can be, most important, any item which has a contractual right to receive cash or another financial asset. Like in debtors, you have a contractual right to receive cash. Investment in bonds, investment in debentures, investment in preference shares, we get a contractual right to receive cash. Loans and advances, we get a contractual right to receive cash. They're all financial assets. Or you can exchange financial assets or liabilities on terms which are potentially favorable for the entity. Like for example, option contracts. If you're a call or a put option holder, you have entered into a contract where you can exchange assets or liabilities on terms which are potentially favorable to you. Next, if there is settlement in own equity instruments, if that settlement happens for a fixed number of entities' own equity instruments at a fixed price, then it is considered to be equity. However, if there is any variability in the number or variability in the price, it will be a financial asset if you are going to receive them. It will be a financial liability if you are going to issue them. So basically, cash, equity instruments of another entity, contractual right to receive cash, settlement in own equity instruments for a variable number or variable price for own equity instruments, all of these will be financial assets. Examples of financial assets can be equity shares of another entity, cash, bank balance, deposits which are given, loans given, investment in debentures, investment in bonds, all of these. Even derivatives, especially currency or currency derivatives, equity derivatives, or bond derivatives, if they are favorable. So if they are giving us benefit, they are asset. If they are giving us losses, they are liability. Commodity derivatives in certain cases. So basically, usually if these commodity derivatives are gross settled, yes, you can take them to be financial instruments. But if they are net settled in cash if they are gross settled, you will not take them as derivatives. In fact, we will say that is a contractual right to receive another commodity, and hence it will not be a financial item. But if it is net settled, that is net in cash, then you will take it as a financial instrument. Financial liability is the opposite thing. Well, financial liability over here would be something where you have a contractual obligation to deliver cash or another financial asset, like creditors, loans taken, debentures issued, all of these you have a contractual obligation to deliver cash. And if the settlement is happening in own equity instruments, then for a variable number or a variable price, the variability over here makes it a financial liability. Even derivatives which result in losses can be taken as financial liabilities. A few special cases you have to be aware of is income tax is not a financial liability because it is a statutory obligation. Constructive obligations again are not financial liabilities because they are statutory, contractual. They are not contractual in nature, they are constructive in nature. Warranty, etc. is also not a financial liability because it is a contractual obligation to repair, not to deliver cash. Prepaid expenses is not a financial asset because it is a contractual right to receive services like rental or advertisement or insurance, but it is not a contractual right to receive cash, and hence they will not be financial instruments. For commodity derivatives, the general rule that you have to remember is if they are gross settled, they are typically held for your own use, and if they are held for own use, they are executory contracts, they will not be covered under Ind AS 109. On the other hand, if they are net settled in net cash, then they will be covered under Ind AS 109, will be taken as per FV TPL. We will study that because they are derivatives. Now, an important thing over here is figuring out how do you deal with, let us say, preference shares or debentures. Well, you will look at the features of preference shares or debentures. So if these preference shares or if these debentures have interest or dividend which is mandatory, then there is an obligation to pay. So that is in the nature of financial liability. But if this dividend is non-cumulative or discretionary, then it is in the nature of equity. If you look at principal is redeemable. That is a feature of a liability. There is a contractual obligation to deliver cash. That is a feature of a liability. But if the principal is perpetual, irredeemable, that is a feature of equity. And when you look at conversion, if it is a convertible instrument which can be converted for a fixed number of own equity shares, that is equity. If it is converted into a variable number of own equity shares, it is a liability. Again, within fixed number, if let us say there is convertibles which are compulsorily convertible, yes, you will have to settle in your own equity shares for a fixed number of shares, that is equity. But if it is optionally convertible, and let us say the option is with the holder, then if the holder demands cash, you will have to pay cash. So there is a liability, but the holder has an option to demand shares, and hence there is an embedded derivative inside. This is in case of debentures and preferences with various multiple features for which some theory questions might come. For settlement in own equity instruments, you have to remember the fixed for fixed test. So if the settlement is happening for a fixed number of shares at a fixed price, then it is in the nature of equity. In all other cases, it can either be a financial asset or a financial liability, as the case may be. So this is about the basic definition of a financial asset, financial liability. Then you go to the classification. Classification of financial assets can be at amortized cost, at FVOCI, fair value through other comprehensive income, or FVTPL, that is fair value through profit and loss. For financial liabilities, the classification can be either at amortized cost or FVTPL. There is no fair value through other comprehensive income. And for equity, there is no classification choice. Equity is to be recognized as the value determined initially. When will you show a financial asset at amortized cost principal, at FVOCI and FVTPL, for which the standard over here, the general principles, there is a lot of technical language over here, but the general principles is that assets that are shown at amortized cost are typically those assets which are held up, which are intended to be held up to maturity and which are in the nature of debt. Whereas assets which are under FVOCI are again assets which are in nature of debt, like debentures, etc., but they are intended to be sold before maturity, and FVTPL will have everything else. Everything else will go over there in simple language. In technical language, there are two tests that you have to do. First is the SPPI or CCFC test. SPPI is solely payment of principal and interest. CCFC is contractual cash flow characteristics test. Either of these mean the same thing. So if the contractual cash flows from the instrument are solely interest and principal, then we will consider this to be satisfying the CCFC test. This is typically for debentures. Second is something called as a business model test. Business model is the manner in which you decide to manage your assets. So over here, if the contractual cash flows are in the nature of interest and principal, like which is there for investment in debentures, investment in bonds, debtors, etc., then you will go to the business model test. If the contractual cash flows are not in the nature of principal or interest, like investment in equity shares or mutual fund units, in which case you will directly go to FVTPL classification. But if the contractual cash flows are in the nature of principal and interest, solely in the nature of principal and interest, then you go to the next characteristic, that is a business model. If the business model is for collecting only, which means if the instrument has 5 years, we will collect all the cash flows over 5 years. Then it is like intending to hold till maturity, and the classification will be amortized cost. However, if the business model is collecting and selling, that is you also intend to collect, let us say for a few years, let us say 3 years, but after that you intend to sell. And as a result, the business model is collecting and selling both, in which case it is FVOCI classification. So loosely speaking, amortized cost are debt instruments which are intended to be held up to maturity. FVOCI, debt instruments which are intended to be sold before maturity, not held for trading but sold before maturity. Everything else will go under FVTPL. The standard specifically mentions that under FVTPL, that is fair value through profit and loss account, derivatives should be taken unless such accounting is applied. You will specifically consider your assets which are held for trading, that is acquired with the purpose of intention to sell it in the immediate future, and any financial instruments which are classified or designated at FVTPL to prevent an accounting inconsistency or an accounting mismatch, which is not as important. So by default, investment in equity shares will go under FVTPL. Now this is where a lot of companies have a problem, that your investment in equity shares are very volatile, and if you show it at FVTPL, a lot of volatility enters your income statement, and hence the law gives an option. It is an unconditional and irrevocable option which is given at the time of initial investment in each equity shares. So the option is that you can show these investment in equity shares as fair value through other comprehensive income. You can show them at FVOCI, and you do not need to show it at FVTPL. This is an one-time option, no conditions attached. So instead, in case you want to show equity investments at FVOCI, you can show them at fair value through other comprehensive income, but this choice has to be taken at the time of initial investment or initial recognition of equity shares. It cannot be taken subsequently. Okay, so this is largely regarding the financial assets classification. Contractual cash flows are considered to be in the nature of principal and interest, where these cash flows are compensating a person for a basic lending arrangement. Like a basic lender expects compensation for time, that is inflation, expects compensation for credit risk, that is higher the credit risk, that is a risk of default, he will charge a higher interest. Lower the credit risk, he will charge a lower interest. And lastly, a reasonable profit margin. So that is for the contractual cash flows to be in the nature of basic lending. If some other characteristic is there, like for example, it is linked to oil prices or gold prices, a lender does not expect return in line with the gold prices, and hence CCFC test not fulfilled. Business model test is an overall test based on how you intend to manage the overall portfolio. Like a bank might have a portfolio of bonds due to its SLR requirements, statutory liquidity ratio. A bank like HDFC might say that, okay, I want to buy and sell these bonds whenever the opportunity arises, business model of collecting and selling. SBI might say, okay, yaar, we don't really want to earn a lot of profits or spend a lot of time behind this bond portfolio, we'll focus on our core business. So we will let them mature and paisa aayega, we'll again invest in bonds. This is business model of collecting only. So it depends on the facts of the case and the management intention. Okay, once you figure out how the classification would be for financial assets, you go to the next important leg, which is accounting. How will you account for financial assets? Well, it depends on the classification. So the initial recognition for assets which are either at amortized cost or FVOCI will be at fair value, or FVTPL, the initial recognition will be at fair value. Now this is a very marked departure from what you do in other standards. Like in other standards, you do the initial recognition to appear at cost. Over here, initial recognition is not at cost, it is at fair value. Achha, if you have acquired the transaction in a fair market at a fair price, then the cost will equal the fair value. However, if the transaction happens off market, like a transaction between an employer and an employee where the employer is given loan at a concessional rate, or let us say between a parent and a subsidiary, or between a lessor and a lessee, or between the government and the entity which takes a grant from the government, these are transactions which may not happen at fair terms. In such case, you will have to determine the fair value, and fair value is typically determined as the present value of future cash flows, considering the market rate on similar instruments as a discounting factor. If the transaction is at fair terms, what you have paid is exactly the fair value. If not, then you must have paid, let's say, 100 rupees and the fair value might be 70 rupees. Then what do you do with the remaining 30 depends on the nature of the transaction. Like for employer-employee, the balancing figure may be staff welfare. For lessor-lessee, the balancing figure may be, let's say, like prepaid rent. For government and the beneficiary, let us say it may be a deferred grant, for example. Or between the parent and subsidiary, it may be investment in the subsidiary. So there can be various things, but you will have to find a balancing figure in case the transaction is off market, and that is because the initial recognition is not at cost. The initial recognition happens at fair value, and fair value is usually based on the present value of future cash flows, taking the market rate of a similar instrument as a discounting factor. Next, you go to transaction cost. usually you add transaction cost at the time of initial recognition, which you will in case of amortized cost, in case of FVOCI. However, in case of FVTPL, everything goes to the P&L, and hence at initial recognition you will take even the transaction cost to the P&L. At every subsequent balance sheet, amortized cost will be shown, amortized cost assets will be shown at the amortized cost, that is the opening balance plus the effective interest less the coupon or the principal payments, and that will give you the closing balance. So that will be the amortized cost balance. Slowly you will go from let us say the purchase price to the redemption value, slowly, because your intention is to hold till maturity. On the other hand, in FVOCI, at every subsequent balance sheet you will show these assets at fair value. Where will the gains or losses go? Well, they will go in a separate fair value reserve called as FV reserve, which is a part of other comprehensive income. Whereas in FVTPL items, the difference in the fair value, whether it is upward or downward, will go in the P&L. So for example, there's investment in bonds where the initial value was 100 and at the end of the year it is 120, then 20 rupees will go as fair value reserve as a part of other comprehensive income. If this was investment in shares which were shown at FVTPL, then this 20 will go as a fair value gain in the profit and loss account. While doing FVOCI, there are two sub classifications. One is there can be investment in bonds, that is FVOCI debt, and second there can be investment in equity shares, that is FVOCI equity. So in case there is investment in equity shares, that is FVOCI equity, then you will still take the 20 appreciation in the fair value reserve. However, that will go as a part of non-reclassifiable OCI. Whereas if it is debt, the 20 rupees will go in the fair value reserve, but that will go as a part of the reclassifiable OCI. What does it mean? It means that when you sell this bond, the balance of let's say 20 will be transferred to the statement of profit and loss, other income. Whereas when you sell the equity share, which is classified as FVOCI, then the 20 rupees will be transferred from the fair value reserve and taken directly to the retained earnings. So this is FVOCI equity, it will directly be taken to the retained earnings. When we look at FVTPL items, fair value through the profit and loss account, then whatever is the difference, that difference will be taken in the profit and loss account. Fair value through profit and loss account, difference will be taken in the profit and loss account. There is no reclassifiable, non-reclassifiable, it is directly going in the profit and loss account only. Interest for amortized cost as well as FVOCI will be calculated using the effective interest method, and the effective interest method over here is the actual rate, it is the IRR, internal rate of return, that you are really earning on the investment and not just a coupon rate. Effective interest rate is basically the internal rate of return. It is usually given in the question, but if it is not given, you can calculate it using the effective interest method or the IRR method, that is a trial and error method. Okay, so this is largely regarding the classification and accounting for financial assets. Okay. When you look at financial liabilities are also having a similar working, just that in financial liabilities there is no CCFC test, there is no business model test, which means there are around 5 or 6 liabilities which have been told to be shown at FVTPL. Everything else will be at amortized cost. Which are those items? First, there is derivative financial liabilities. Second, there is liabilities which are held for trading. Third, these are liabilities which are designated at FVTPL to prevent an accounting mismatch or an inconsistency. Fourth, contingent consideration that arises as a part of business combination. Fifth, financial guarantees. Sixth, continuing involvement assets. So these are continuing involvement approach items. So these are the items which have to be shown using FVTPL. Everything else will be at amortized cost. So your entire universe of loans, debentures, everything will be using the amortized cost principles only. So how will the accounting happen? Well, initial recognition here as well will be at fair value. If it is amortized cost, then fair value minus the transaction cost. It is a liability, remember, liability is a credit balance, transaction cost will have a debit balance, and hence you will subtract it. Asset has a debit balance, transaction cost also has a debit balance, so you add. But here there is liability which is a credit balance, transaction cost has a debit balance, so you will subtract net. If it is FVTPL, then you will show the initial value at fair value and the transaction cost will be taken to the profit and loss account. At every subsequent balance sheet under amortized cost method, you will show the liability at amortized cost. In the FVTPL method, you will show it at fair value with the gains or losses being going to the profit and loss account. In the P&L, effective interest will be taken in the P&L in case of amortized cost method, and the actual interest will be taken or actual payments will be taken in the FVTPL method. This is about financial liabilities largely. When we look at the last item, which is equity, equity has none of such headaches. Equity says that the value that you determine initially will remain the same. No fair value, no amortization, nothing, it remains the same. So the value determined at initial recognition will remain the same. You will not subsequently do a FVTPL, you will not subsequently do an FVOCI, you will not subsequently do any amortized cost, it will remain the same at initial recognition. A summary for transaction cost would be that what will you do with transaction cost? Usually, if transaction cost is for a financial asset, then you will add the transaction cost to the financial assets which are shown at FVOCI or at amortized cost, and the transaction cost on financial asset at FVTPL will be taken to the P&L account. If it is transaction cost on financial liability, you will take the transaction cost in the P&L for FVTPL liabilities and deduct it from the financial liabilities at amortized cost. And if it is equity, then if it is a primary issue, if it is linked to an actual issue of equity shares, you will reduce it from other equity like from securities premium. However, if it is for transaction cost for an already existing issue like an offer for sale for existing shares, then the transaction cost goes to the P&L. Once you understand, let us say, the accounting, etc., you will go to compound financial instruments. Now this probably is one of the most important parts of the standard. You are now in the books of the issuer. There is an issuer of a convertible bond or a convertible loan. Now this issuer, when he issues a convertible bond, this convertible bond is a compound financial instrument. So that is, it is neither only a liability nor is it only an equity. So how do you account? Well, in the older standards, you would have directly shown it as a convertible bond, which is a part of liability. Index believes that that is wrong because a part of this convertible bond is a liability, a part of the convertible bond is actually equity, and hence you have to do what you call a split accounting. You will try to split the liability and the equity components. The liability component is calculated as the present value of future cash flows, which are in the nature of liability. So for example, you are under a contractual obligation to pay interest, so that is the present value of all future interest payments. And if it is an optionally convertible instrument, then you are also under a contractual obligation to pay for the principal if the holder demands, so that is also in the nature of liability. But if it is a compulsorily convertible instrument, you are not under any obligation to pay for the principal. You will definitely give shares, but you are still under an obligation to pay for the coupons. And as a result, you try to find the present value. The discount factor over here will be the required rate of return on a similar non-convertible instrument. So if there's a similar non-convertible instrument, then that will be taken as a discount factor, and considering that, you will try to find the value of the liability component. So if your total issue price is 100 and the liability component comes to 90, then the remaining 10 that the investor must have paid is because of the equity option that is there. And hence at initial recognition, you will find the equity component as a balancing figure. Liability component will be measured as a present value of future cash flows, which are in the nature of liability. Interest is usually in the nature of liability because it is a contractual obligation to deliver cash. Principal is in the nature of liability in case of a optionally convertible instrument. In case of compulsorily convertible instrument, it is not in the nature of liability. And the discount factor over here will be the market rate of interest on similar instruments which do not have the conversion option. So if there was no conversion option, then how much would I require? That is the discount factor. So your journal entry will be bank account debit, let us say 100, to liability component 90, which will be shown along with non-current liabilities, to equity component 10, which will be shown under along with other equity. At each subsequent balance sheet date, the liability component will be accounted for using amortized cost method. So whatever that 90 is plus the effective interest less the interest coupon gives you closing. Slowly it will come towards a redemption value or to a zero value depending on whether it is compulsory or optionally convertible. Equity component remains the same, it does not change. At the last date, if the conversion option is exercised, your entry will be liability component account debit, equity component account debit to equity share capital to securities premium. If the redemption option is exercised, your entry will be liability component account debit to bank, and the equity component will be reversed, taken into something like retained earnings. It is like lapsing of the conversion option. So a few special cases can be considered over here, like what if there is transaction cost? So if there is transaction cost in a compound financial instrument, that transaction cost will also be attributable separately, proportionately to the liability as well as equity component. you will deduct it from the liability, and since there is a fresh issue, you will deduct it from equity as well. In certain cases, there may be an early redemption. In case there's an early redemption, then what you did at initial, so at 2014 you issued, in 2019 it was going to redeem, but we agreed for an early redemption, let us say in 2017. Then in 2017 you will again find the liability component, again find the equity component, and then try to find the gains or losses on settlement of the liability component, which will go in the P&L, and settlement of equity component, which will go to the retained earnings because it is settlement of an equity transaction. Acha. So this takes care of compound financial instruments. Next, there are a few not really important. There is a regular way contract. What do you mean by regular way contract? Regular way contract is a contract which in the regular way settles after a specified number of days. Like in BSE, if you were to enter into a contract to buy shares today, there's a T+2 settlement. It is now changing to T+1, but largely it is T+2, in which case after 2 days you will get the share. So is that a forward contract? No, it's a regular way of a spot purchase. In such cases, the standard allows you to follow what you call as trade date accounting. That is, you show the purchase as well as the sale on the trade date and not on the date when it comes into your demat account. Or you are allowed to follow the settlement date accounting. That is, you will show the asset in your books only when it comes in your demat account, not on the date when you trade it. And you remove the asset from your books when it goes out of your demat account, not when you do the trade. Typically, almost everyone follows the trade date accounting, but if you do the settlement date accounting, you will pass the entry for the receipt and the derecognition of the asset when the settlement actually happens. On the balance sheet date, you will show the gains or losses under the settlement date accounting in the same manner as you do for the trade date accounting as well. Okay. Then you have certain principles on derecognition, but before that, let us discuss some parts about derivatives and embedded derivatives. What are derivatives? Well, derivatives over here are sub point 1 based on an underlying asset. Second, they are expected to settle at a future date, and third, the amount that you pay initially is nil or insignificant. Derivative financial assets are accounted for using FVTPL. Derivative financial liabilities are accounted for using FVTPL, whereas derivative equity instruments will be shown at the fair value at initial recognition and then it will not be remeasured. Sometimes these derivatives may be embedded inside a host contract. So the separation principles for embedded derivatives is, if these derivatives are embedded inside a host contract, and the host contract, a convertible debenture, the debenture is the host contract and the option to convert is the embedded derivative. So if they are embedded inside a contract which is accounted for as a financial asset, the standard says there is no separation required. So for an investor in convertible bonds, he does not need to separate the option as well as the bond separately. He can show it as investment in convertible bond. However, if there is a liability which is underlying, like a bond issue or a non-financial item or equity, then separation is required if the economic characteristics are not closely related. A derivative, if shown separately, will meet the features, and we have not shown it at FVTPL. In such cases, separation is done, and that is why we also separate the liability and equity component. The standard gives you two special cases, one for loans taken with prepayment option, where we check whether separation is to be done or not, for which we compare the fair value, we compare the amortized cost had there been no prepayment option with the prepayment price. And secondly, there is a foreign exchange derivative which is embedded in a foreign currency purchase or sale, which you separate provided they are not closely related. Very stringent conditions are given over here. So in practice, almost every time they are closely related. One of the common conditions over here is the contract should not be in the currency of the parties to the contract. So usually the contract is almost always in the currency. So if the Indian person is dealing with the US party, the contract is either in rupees or in dollars usually. So in such case, separation is not needed. However, if the Indian person is dealing with the US party and the transaction is in yen, yen is not the commonly traded currency as well, not used in the environment of these two countries, then a separation will be needed, for which we will separate out the forward contract, separate out the goods in the local currency and do the working. Some complex steps are given over here, for which we have a separate video as well. You can refer that separately. Aja, After this derivatives, you have something called as derecognition. So when we are looking at derecognition, there can be derecognition of financial assets, derecognition of financial liabilities. When will you derecognize financial assets? Well, when the risks and rewards of the assets or the control of the asset is given up. Not just necessarily when the asset is sold, or the risk and reward is given up. For example, when you do bill discounting, there's a risk of the cash flows go? No. So when you discount bills, you should not derecognize the bills because the risk of the cash flow is still with you. Yes, you have given the possession of the bills to the bank, but if the bank is unable to collect it, the bank will remove that money from your account, and as a result, the risk of the bill is with you. So bill discount is largely a loan contract. Similarly, when we look at factoring, if there is recourse factoring, that is, if the factor is unable to collect money, the factor will collect from the debtors, he will collect it from you. In such a case, there is really no sale. बोलने के लिए अपने debtors factor को transfer कर दिया, but the factor can collect money from you, and hence the risk of these debtors are still on your head. The risk of the debtors is still on your head in such cases. So there should be no derecognition, but if there is a non-recourse factoring, which means even if no money is collected, the factor cannot come back or have recourse to you, in which case derecognition should be done. It is important to understand what happens in case of a sale and a repurchase arrangement. So that is a repo contract. If there is a sale and an agreement to repurchase, in reality the control of the asset does not go because the risks and rewards will come back to you. It is a sale and a repurchase, provided the repurchase is at a fixed price. That is, if the sale is at 100, repurchase is at 110, then the 10 rupees is like interest. However, if the repurchase can be at a variable price, which is probably linked to the fair value, then you can account for a sale and a repurchase separately as well. For securitization transactions, the derecognition will happen provided you have entered into a contract whereby you are going to give all the cash flows that you are going to collect to someone else, which is a typical feature of securitization, without any material delay, and you cannot pledge, sell or transfer that asset. So in such a case, even when you are actually collecting the cash flows, you are supposed to derecognize the asset because the risks and rewards are actually transferred to someone else. This is largely about financial asset derecognition. Financial liability derecognition is slightly more important. Financial liabilities should be derecognized when they are discharged. Now, when will we say that financial liabilities are discharged? Well, basically when they are paid off or when they are waived off. However, in certain cases, it is possible that financial liabilities, that these financial liabilities that you are going to pay, they are substantially modified. So in case of substantial modification of these financial liabilities, what should you do? The standard gives you guidance. It says that you see whether the modification is substantial or not, like loan renegotiation. So you see whether the modification is substantial or not. If the modification is substantial, that is the difference between let us say the present value of the modified cash flows at the old DIR and the current carrying value, if that difference is greater than 10%, we say that the modification is substantial. And if the modification is substantial, then you will follow extinguishment accounting. That is, you will derecognize the old liability, create a new liability, and recognize a gain or loss on derecognition as a balancing figure in the P&L. However, if the difference between the present value of the modified cash flows at the old DIR and the current carrying value is less than 10%, we believe that the modification is not substantial, and hence you don't need to follow extinguishment accounting. Instead, you can just modify the existing loan. You can either modify the carrying value, bring it to the present value of the modified cash flows, or you can modify the effective interest rate. So this is a slightly important section, the derecognition of financial liabilities part. Next you go to impairment. So when we look at impairment of financial assets, over here that impairment treatment is defined under Ind AS 109, and the standard mentions that the impairment will apply to financial assets other than FVTPL, because FVTPL does not have a contractual cash flow, so you cannot say that it is impaired because वो contractually आपको कुछ promise ही नहीं करता है देने को. So it is largely for FVOCI debt and amortized cost, in which case the amount that you are expecting, amount that you are contractually going to receive is different from the amount that you are expecting to receive, then there is an impairment. And if there is an impairment, it should be recognized. Now, impairment over here can be recognized at various levels. The standard says you don't wait till the actual impairment to happen. You follow what is called as the expected credit loss or ECL method. So under the expected credit loss method, you will try to find the possible impairment at each balance sheet date, starting from initial recognition. So every asset is subdivided, where impairment provisions apply, is subdivided into 3 subcategories: stage 1, 2 and 3. Stage 1 assets are those assets which don't suffer any change in their credit risk. So when you gave a loan, let us say to a company like Vodafone, you believe that the loan was good, it is still good. So you are in stage 1. Stage 2, if Vodafone, if you see recently, has been making a lot of noises that it may not have enough money to pay, etc. Vodafone is not yet defaulted, but there is a significant increase in credit risk going to stage 2. And third, if Vodafone actually defaults, then that is stage 3. That is impairment. The asset becomes credit impaired, like what Diwan Housing or ILNFS have done. So when we look at this 3-stage impairment testing, over here, various ways in which impairment loss can be measured on an expected basis, like probability of default. You can estimate what is the probability that a default can happen, or you can measure a loss rate based on your past experience, or you can make an aging schedule for something like debtors and try to find the loss. So over here, your expected credit loss for stage 1 assets will be based on 12-month expected credit loss. You don't have to do a very detailed prediction. You just see whether in the next 12 months you are expecting a loss. If yes, you create a provision. If no, you don't need to create a provision. If it is in stage 2, we don't just look at the next 12 months but the entire lifetime. Same is the case with stage 3. You try to predict the expected credit losses over the entire lifetime. The interest for assets which are in stage 1 or 2 continues to be recognized using the gross value of the asset. So over here, it can be that your 100 rupees is the value of the asset and 10 rupees is the provision. You will still continue to recognize effective interest on 100. However, the moment the asset goes in stage 3, then you will recognize interest only on the net value. So 100 minus 10, that is 90, only you will recognize the interest. This is for impairment. And I guess the last part over here is on hedge accounting. Not very important. Hedge accounting, remember, is optional. Even in practice, it is optional. Students in any case consider it to be optional, but even in practice, hedge accounting is optional. When can you follow hedge accounting? Well, if there is a hedged item, if there is a hedging instrument. Hedged item can be the underlying item, like investment in bonds, for example. Hedging instrument like a forward sale contract or a put option on that bond to protect the fair value of the bond. Hedging instrument, and there is an economic relationship between the hedged item and the hedging instrument. So if there's an economic relationship between the hedged item and the hedging instrument, and you have a proper risk management policy, proper documentation in place, then we can say that hedge accounting can apply. And if hedge accounting can apply, there are 3 types of hedges. That is a fair value hedge, cash flow hedge, and a hedge of a net investment in foreign operation. So you'll have to classify the type of hedge. Like a fair value hedge is a hedge which is taken to protect the fair value, like protecting the fair value of a bond. That is a fair value hedge. A cash flow hedge is a hedge which is taken to protect the interest, which is like the cash flow. And the hedge of a net investment in a foreign operation is like a hedge which is taken to protect the realizable proceeds that you will get from a foreign operation. The accounting for a fair value hedge is that the gain or loss, both on the hedged item as well as the hedging instrument, should ideally go to the P&L. Even if they are not going into the P&L, you will have to do it in such a way that you have to take the gain or loss on the hedged item as well as the hedging instrument to the P&L. Like an FVOCI bond, the gain or loss on the bond goes to the OCI, but the derivative gain or loss will go to the P&L, and hence we will take both the gains or losses in the P&L only. The only exception to this rule is if there is an investment in equity shares which is classified at FVOCI, then both the gains or losses on investment in equity shares, which will go in OCI, and the derivative will also go to OCI. This is for fair value hedge. For cash flow hedge, you are expected to create a hedging reserve and recognize the gain or loss on the hedge in the year when the cash flow happens. So you might take a forward contract for interest, for a loan, for fixing an interest for a loan that you are going to take in the next year. So it's a forward contract accounted for using FVTPL, and hence ideally the gain or loss on the forward contract will be recognized in the first year. Loan is still not taken, but the forward is there, so it will go in the P&L account. But interest will come in the next year. So instead of crediting the P&L for the derivative, you will credit the hedging reserve, and in the next year when interest will come, then the balance in the hedging reserve will be transferred to the P&L slowly. As and when the cash flows hit the P&L, that is when the corresponding gain or loss on the hedging instrument should go to the P&L. And lastly, in case of hedge of a net investment in a foreign operation, the accounting is similar to that of a cash flow hedge. That is, till the time you sell the foreign operation, the gain or loss, if any, on the derivative will go in the other comprehensive income. The moment you sell the foreign operation, the gain or loss on the foreign operation, that is FCTR, will go to the P&L. At the same time, the derivative gain or loss will also go to the profit and loss account. Okay, so that takes care of hedge account, financial instruments. CSR we have discussed earlier, and that leads you to the last chapter of our session, which is accounting for share-based payments, which is covered under Ind AS 102. Now, when we look at share-based payments, what is covered under share-based payments? Two things. There is equity settled plans, and then there are cash settled plans. What do we mean by equity settled plans? These are plans where the settlement is going to happen in own equity shares, like ESOPs. Cash settled plans are those plans which are going to settle in cash, but the amount of settlement is dependent or is based on the entity's own shares. So that is your cash settled plans. Now, how will the accounting happen? Well, in case of ESOP or in case of cash settled plans, that is SAR, stock appreciation rights, the standard mentions that if there's a vesting period attached, that is, vesting means entitlement. So if you want to get the options, you have to serve for 3 years, let us say, then you will have to quantify. Let us say, the fair value of these options, and these fair values will be spread over the vesting period on a straight line basis, because this is like a barter. The employee is rendering service, and in return you are giving the options. The employee is rendering service over 3 years, and as a result, the expense on account of these options should also be spread over the 3-year time frame. So when you are looking at these options, you will spread this over the 3-year time frame, and that will be on a straight line basis. So fair value in case of ESOPs will be determined on the grant date, and that will not be subsequently revised. Well, how will the ESOP be accounted? So let us say there is one employee, there are 10 options per employee, and there is 30 rupees, then 1 into 10 into 30, that is 300. 300 into 1 by 3 for the first year, that is 100. Your entry will be employee benefit expenses account debit to SBP reserve, share-based payment reserve, which is like stock options outstanding. Share-based payment reserve will be shown as a part of other equity, and employee benefit expenses will be shown as a nominal account, which is a part of your profit and loss. At every balance sheet date, you will transfer the balance in the EB to the profit and loss, because it is a nominal account. SBP reserve will keep on accumulating. During the exercise period, the balance in the SBP reserve will be there. Now, if the employee exercises the option, he will pay the exercise price. So your entry will be bank account debit with the exercise price. SBP reserve will be the fair value to equity share capital to the securities premium, because now the option is exercised. But if the option lapses, then you will debit the SBP reserve and credit the retained earnings, because it is a lapsing. The working remains the same in case of SAR as well, just that in case of SAR, the SBP reserve, like it is shown as a part of other equity, because it is own equity settlement. In case of SAR, you create an SBP liability, and remember, liabilities are remeasured at each balance sheet date. Own equity is not remeasured, liabilities are, and hence for SAR, you will take the fair value at each balance sheet date and not just the grant date. In fact, you will keep on remeasuring the SAR even after the vesting has happened. You will spread 1 by 3, 2 by 3, 3 by 3. For the expense, but even after that, till the time the SAR is actually exercised, SAR is share appreciation rights, cash settled plan, you will keep on remeasuring it based on the fair value. The settlement of SAR happens at intrinsic value, that is the difference between the market price as on the date of exercise minus the exercise price. So this is largely the basics of ESOPs and SARs. Sometimes these are transactions with employees. It can also happen with other than employees, let us say for goods or services, in which case you will recognize the transaction on the date when the risk and rewards of goods are transferred, or when the services are actually rendered. That is the timing. The measurement over here will be based on the fair value of goods or services, and if that is not determinable, based on the fair value of the options. In case of employees, that is not the case. You will have to measure it based on the fair value of the options only. You will never measure it at the fair value of employee service. Okay, there may be certain cases where there is group share-based payments. So in group share-based payments, what might happen is parent might issue options for an SBP plan of the subsidiary, or subsidiary might issue options in the SBP plan of the parent. In such a case, the accounting will be in the standalone books of the parent. If parent is issuing options to the SBP plan of the subsidiary, it is like an indirect investment in the subsidiary. In the books of the parent, the entry will be investment in S account debit to SBP reserve. In the books of the subsidiary, that is like an investment received. It's like a capital contribution received. So that is EB account debit, employee benefit expenses, to capital contribution. On the other hand, if subsidiary issues options in the share-based payment plan of the parent, it is like return on investment, which is like dividend. So in the books of the subsidiary, this is like a dividend distribution. So this is dividend account debit, let us say, to SBP reserve. In the books of the parent, where there are employees, the entry is EB account debit to dividend income, and this dividend income will go in the profit and loss account. This is for group share-based payment plans. Now, in case of ESOPs and SARs, there is a special case called as cash alternatives. So it might happen that you are issuing a plan where, like a convertible bond, you are giving an option to the employee that if he wants, he can settle in equity or he can settle in cash as well. So in such cases, the standard says that like you do separation of liability component and equity component, you will also do separation over here. You will try to find the fair value if all the on the grant date, if all the employees exercise in equity, in which case, let us say it comes to 1000. Fair value if all employees take the cash option, let us say it comes to 800, which means 200 additional is the value of the equity option. The standard over here says, like it says in case of convertible debentures as well, you take the liability component and the remainder will be equity component. So the standard says that, okay, you will account for this entire plan as if it is a SAR, but this is a SAR along with an additional cash option, the equity conversion or option, and the value of that equity conversion option is, let us say, 200. So the accounting will be based on SAR, so that 800 will be remeasured at each balance sheet date and will be spread over the entire vesting period, and the 200 which is there for the ESOP will be spread over the vesting period with no remeasurement. At the date of exercise, when the employee decides, let us say, to exercise in let's say cash, then the entry will be SBP liability account debit to bank. The balance in the SBP reserve will be transferred to retained earnings. If there is equity option, then in line with the ICAI solution, if you want to maintain consistency, you will debit the SBP liability only, credit the equity share capital and securities premium. So the law believes that the consideration of the shares issued is the liability foregone. What about SBP reserve? This law mentions that you transfer it from one component of equity to another. So the other component of equity can be retained earnings, can be securities premium. ICAI transfers it to retained earnings. You can transfer it to retained earnings for safety. Alternatively, you can also take it as a part of the share issue entry, where the balancing figure can go to the securities premium. Okay. Now, there is possibility that there is performance-based vesting. Usually, the questions that you see are on service conditions. That is, you have been told that you have to serve for 3 years, and if you serve for 3 years, the options will vest. However, there may be cases where there is performance conditions, and performance conditions may be market linked or non-market linked. What do you mean by market linked? It means the vesting happens based on the entity attaining a specific market price or the entity attaining a specific market price growth. That is market linked. Whereas non-market linked means the conditions are linked to performance, but the performance is not linked to market price. It can be linked to earnings, it can be linked to sales, it can be linked to production, but not to market price. The logical accounting is usually there in the non-market linked performance conditions, where the standard says that at each balance sheet date you will check whether the non-market linked conditions are expected to fulfill and the vesting is expected to happen. If vesting is expected to happen, you will also have to determine the vesting period, because here vesting might happen after 1 year, 2 years, 3 years, we don't know. You might have to estimate the vesting period as well. And accordingly, we can keep on changing these estimates, very logical. On the other hand, when you look at market linked performance conditions, Ind AS 102 mentions that the estimate that you have taken for the vesting possibility, whether it will happen, and the vesting period will remain the same. You will not change it at each balance sheet date, sir. Why? Because market price is the base on which fair value of the option is determined. The fair value cannot be remeasured, and hence the estimates that go behind the fair value calculation ideally should also not be remeasured, and hence you don't change the vesting period or you don't change the possibility of vesting in case of market linked performance conditions till the date of actual vesting. If the actual vesting happens earlier, then you can record it. If it happens later, you will spread it over 4 years only. The standard also has specific guidance for modification and cancellation. So in case, and graded vesting. What is graded vesting? It is phase wise vesting. So over here, if there are 100 options, vesting period is not 3 years blindly. It is 20% in the first year, 30% in the second year, 50% in the last year. Then in such cases, that is phase wise vesting, you will take this as if these are 3 separate ESOP plans. First for 20 options with a 1 year vesting and its corresponding fair value. Second with a 2 year vesting. Third with a 3 year vesting, and you will account it as if there are 3 separate plans. Next we have modification. Now modifications can happen when the management modifies the ESOP plan, and these modifications can be beneficial to the employees, these modifications can be adverse to the employees. So when we look at modifications which are beneficial to the employees, what are the modifications which are beneficial to the employees? Well, if you reduce your exercise price, for example, there is a modification which is beneficial to the employee. What does Ind AS 102 say? It says that if there is a modification which is beneficial to the employee, there will be an incremental fair value. The fair value of the old plan, let us say, was 10, the new plan will be 15, so that 5 extra is the incremental fair value, and that incremental fair value is to be treated as a separate plan, and the accounting for the original plan will continue as it is. You will not remeasure it, you will not modify it. However, you treat it as a separate plan with an incremental fair value of 5 and the remaining vesting period. Let's say the modification, it's a 3-year plan and the modification happens at the end of the first year or at the start of the second year. Then for the remaining 2 years, you will take that 5 as well and spread that 5. The original working will remain the same. If the modification is adverse to the employee, that is, you reduce, instead of reducing, you increase the exercise price, in which case you will have a situation where the fair value actually the incremental fair value will be negative. So your fair value of the old plan was 10, the new plan will be 8, for example, in which case you will have a negative fair value. So you can't do the accounting for a negative fair value, and hence the standard says that you will continue recording the old plan because you can't remeasure anything, but there will be no separate new plan, and hence you will ignore any additional working. So for beneficial modification, that is incremental fair value is positive, the accounting for the old plan continues as it is. The incremental fair value will be treated as a new plan. If the incremental fair value is negative, you will ignore the incremental working, the original working continues to remain the same. Lastly, when there is cancellation, cancellation is treated as acceleration of vesting, which means if the vesting period is 5 years and the cancellation happens at the end of the second year, you will write off the employee benefit expenses over 5 years in the first year, so 1 by 5, but in the second year the plan is cancelled, so you don't have 5 years, and hence the entire remaining expense 2 by 2, 2 years over 2 years will be taken. After that, usually when cancellation happens, you will have to pay a compensation, and that compensation is typically in cash, and hence you might have an SBP reserve, but this SBP reserve is going to settle in the form of let us say cash. So to the extent of fair value of the options, you will adjust that amount from the SBP reserve. So if the SBP reserve has 100 rupees and you are paying a compensation of 90, then that or the fair value of the options is 90, you are paying a compensation of 96, then the 90 will be adjusted from SBP reserve, and the excess, let's say if you are paying 6 rupees will be taken to the profit and loss account, so that you show the readers that you have paid a 6 rupees excess compensation. But there will still be, let us say, a 4 rupee balance in the SBP reserve. 100 ka option tha, 90 rupees was the fair value of the option, 6 rupees is taken to the P&L. So if there is any balance in the SBP reserve, I guess it will be 10 rupees, 100 minus 90 ka difference, then the institute has not told anything to be done over here. Ideally, it has to be transferred from one component of equity to another, so you'll transfer it to the retained earnings. So that kind of gives you an overall gist for cancellation as well. So this kind of takes care of a very, very quick and a general overview of your syllabus. We have tried to cover all aspects of, or at least all topics of your syllabus. I hope this video has been helpful, at least for your overall revision. At least you've been able to brush up on these concepts, or you can refer it at a time. where you have practiced it. Obviously it is not for first time revision, it is not even for midway revision, it is for exam time revision. And if you have done all the topics, kind of it would have clicked the right bells in your mind. So I hope this video has been helpful. Thank you very much, and wish you all the very best for your exams, and good luck. At an accounts paper. So when we look at an accounts paper, FR paper, it is undoubtedly the longest paper of your CA final. Among all the 8 papers, you ask any of your seniors and they will tell you the financial reporting paper is the most difficult paper to complete. So what do we do? Well, we have to time ourselves. Remember, we have to time ourselves. We have to say that if, let us say, we have 100 marks and we have 3 hours, that is 180 minutes, that is approximately 1.8 minute per mark. It has 1.8 minutes per mark. In which case, if it is a 5 mark question, typically you should have 9 marks, it's 9 minutes. If it's a 10 mark question, you should typically have 18 minutes and so on. This will largely fall in place except for questions which are linked to consolidation and business combination, which might take more time. Now, in order to compensate for that, you should be targeting finishing the smaller questions like accounting standard ones in probably lesser time. So accounting, this consolidation question typically takes around 45 minutes for a around 40 odd minutes for a 16 mark question. So that is a 10-minute deficit minimum that gets created over here. If you cross 40 minutes, you are going to have a really tough time. Keep a target of anywhere between 30 to 40, 30 being the best, 40 being the absolute maximum. Cut down the notes if you want to, but ensure that 35 to 40 minutes के अंदर आपका question खत्म होना ही चाहिए. The order of solving, should you start ever with a consolidation question? Never. Should you do this right at the end? Again, never. You have to do it at the middle of the paper. Otherwise क्या होगा? You are doing a consolidation question, you started at, let us say, 440 and आपके पास 20 मिनट बाकी, आप कंसोलिडेशन आधा करोगे, ना आपका गुडविल आएगा, ना एनसीआई आएगा, ना आपका कंसोलिडेट पीएनएल आएगा, आपको कुछ भी मार्क्स नहीं मिलेगा. You would spend 20 minutes and get 0 marks. So you do somewhere in the middle. If you do it at the beginning, it's nerves at the beginning. If you do it at the beginning, you will take a lot of time, and maybe if it does not tally, hell will break loose. So you will probably do it in the middle when you have got some rhythm, not at the end, because if you wait for the end, in all likelihood, you might not be able to complete it. And step-wise mark के लिए वो steps तो होने चाहिए ना, goodwill आप calculate करने चाहिए, NCI calculate करने चाहिए, तभी आपको उसका marks मिलेगा. Not otherwise. Remember that you should kind of do consolidation somewhere in the middle. When you solve sums, especially when you're doing cases, divide the cases into 3 parts. You don't have to specifically write 1, 2 and 3 or create paragraphs, but ensure these 3 points are covered. In the first part, you explain the law. You say as per Ind AS, so and so. Explain in your own words. That's absolutely fine. In the second part, you connect the law to the given case. So you can say, in the given case, so and so you will explain. And in the third part, you will conclude. Institute expects these 3 in your answer. You do not need to remember the paragraph numbers of indices. अब इंडेक्स नंबर याद रख लो, वो भी बहुत है. When you look at a practical problem, like an EPS problem, impairment problem, do we have to write a lot of theory? Not necessary. But these days we have been seeing slightly strictly checking. So what I would recommend is write a couple of lines explaining. So like if there's impairment, so you can just write as per Index 36, impairment arises if the carrying value is greater than the recoverable value, and then do the working. So you have explained the law. If you don't have the time, don't write the theory for let us say your numericals. You directly solve the sums. That is absolutely fine, because completing the paper is of paramount importance over here. Ensure you time yourself. No matter how many times I tell you, आप लोग हाँ यार हम तो finish कर देंगे, नहीं होता है financial reporting का paper. और बहुत if you even complete 90 marks, that is brilliant. So try to aim for 100. ऐसे भी 5-10 मार्क तो नॉर्मल लॉस अपन बोलते हैं. देयर विल बी सम क्वेश्चन जो अपने ऊपर से जाएगा तो नॉर्मल लॉस में निकल जाएगी, बट अदर देन दैट यू शुड बी एबल टू सॉल्व द अदर क्वेश्चंस properly. Start with the questions which you are the most comfortable with. Do not ever try a question which kind of can give you nerves. It is a first paper, and because it is a first paper,
स्टार्टिंग में आपको थोड़ा नर्वसनेस रहेगा, सो इट हैज टू कूल डाउन, एंड वो एक अच्छा क्वेश्चन आपको अच्छा रिदम दे देगा. So start with the question always which you are most comfortable with. Do consolidation somewhere in the middle. Divide the cases into 3 parts while you are writing the answer, and ensure that you time yourself. These are the important things that you have to remember. Apart from that, on the week before the exam, I would suggest you at least keep around 5 to 6 days bare minimum for financial reporting. Do not really cut down and say कि नहीं यार ये पढ़ेंगे वो पढ़ेंगे. आपका पहला पेपर है, खराब होता है, पूरा आपका रिदम तोड़ देगा वो. So if you have the time, why not spend that time and prepare the course to the best extent possible? So ensure that you kind of refer the material, discuss the course, revise it properly, and time yourself. So that should largely be it. At this point, what you should focus on largely is consolidating your strengths. If you don't understand something or something is appearing to be really difficult for you, leave it right now. Remember, your paper is of 100 marks. That's, you can go wrong. I mean, you need to score 50, so you can go wrong every alternate question and still pass. So I don't want that you invest your time right now in referring 10 different RTPs, MDPs. You have referred it already, best. If not, do not touch anything new. Try to do what you have done and consolidate your strengths. आपको अगर 70-80% ऑफ द चैप्टर्स भी अच्छे से आते हैं, उसमें से एग्जाम में क्वेश्चन आएंगे, अब वो सॉल्व करके आप आगे जा सकते हो. ऐसे भी आप देखोगे योर ट्रेंड इज वेरी स्क्यूड फॉर फाइनेंशियल रिपोर्टिंग. यू ऑलमोस्ट ऑलवेज गेट a 15 to 20 marks question of financial instrument, 15 to 20 marks question of consolidation, a 5 to 10 marks question of business combination. That is 40 marks here only. 8 marks, 6 to 8 mark question of share based payment, 45 marks. Around 8 mark questions of lease and revenue, 60 marks. तो यही चैप्टर्स के हो गए जो आपने आज पढ़े, 60 marks out of it. And all the other remaining indices that we did yesterday would comprise of the remaining 50-60 marks. So over here, your questions are very heavily skewed in favor of these 5 or 6 big topics. So आप अगर वो भी अच्छे से कर लो तो आपको आराम से अच्छे marks आ जाए. Other topics, yes, there are important standards like income taxes, impairment, PP. You have to do all of them. But अगर कोई चीज आपको प्रॉब्लम देता है तो आप उसको फटाफट गो थ्रू करके आगे निकल जाओ. Don't spend a lot of time here. The theory-based cases or theory-based questions in consolidation, financial instruments, business combination are lesser important. It should typically ask you numerical questions over here. The theory or case-based questions are relatively of lesser importance. ठीक है? Anything else? Any other questions that you want me to address? Any specific queries or doubts, or anything you want to ask? Just a second. Anyone? Okay. So that should be it then. I'll wish you all the very best. Study really hard. God bless you. Back yourself. Don't be too harsh on yourself. Give yourself that support. It is difficult, but it is not something which is not achievable. And anything that comes, anything that is valuable is not as easy. Back yourself. Be confident. And wish you all the very best. Take care. Bye bye.